Okay. Kelsey, what's this first slide say?
What is the point of 704C and 704B? Or stated differently, what is 704C and 704B a tax concept? 704B is intended to track the economic deal partners agree to when a partnership is formed. 704C is intended to track the difference between the economic deal, which was 704B, and the tax basis of the assets being contributed. Stated differently, the 704C and 704B concepts are tracking mechanisms.
Okay. And based on what we've said so far, is that 1% clear, 99% clear? Where do you stand?
Clear?
Brett, is it clear to you?
Clearer.
Clearer, which we're going to keep hammering this. Okay, so as long as those words, Sam. Oh, you're so fucking lost. You don't know what to do with yourself.
I'm not.
You're not?
No, it's not as bad as I thought. So
Your eyes are lying. But we're just going to give you the benefit of the doubt here, Sam.
thank you. I appreciate it.
Okay. Sam, what's this slide say?
Says what is a 704B capital account? It's a fair market value capital account. 704C capital accounts, tax basis. Why do we care? 704B, which is a fair market value capital account, tracks the value the partnership owes you. 704C tax basis is utilized to track required special allocations of income.
Okay, so for those of you that were in here for that call, I don't know who was in here and who was not because I wasn't taking any sort of role because I was focused in on what I needed to do. That $13 million that was associated with Standard is a required allocation. And as you saw, the capital accounts started at negative 20 million and ended at positive 15 million. That required allocation of 13 million is what drove my capital accounts to intersect and equalize. Okay?
Can I ask you one question on that?
Sure.
What was driving those two one-time pieces at the bottom of your 704C schedule?
At the very bottom,
Yeah,
which was Holstone and
yeah,
Four Corners.
yeah.
So there were three things, and this is worth knowing, and we might as well say it out loud right now because we're going to hammer on this a lot. And 704 is one of the things that is really worth knowing and happens to us on a regular and continuous basis. This happens all the time. So in that schedule, there were three buckets of assets. Okay? And I got this in here somewhere. I'm going to say 704C types of assets. Okay, and again, Austin, this is somewhere in here, but let's cover it, and we're going to cover it. Repetition doesn't hurt us at all. Okay, one is, I'm going to call it immediate / short-term recognition assets. Okay, and an example of an immediate or short-term recognition asset is going to be cash basis AR. So if I contribute $100 of cash basis AR to a partnership, and I have a fair value capital account of 100 and a zero tax basis capital account because I don't have any basis in that AR, and the company collects AR 100% in 30 days, and I contributed on January 1st. Does the partnership have $100 worth of income within that first month? It does. So Austin, if you put in $100 of cash, and I put in $100 of AR, your 704B and C cap accounts are 100 each. My 704B is 100, and 704C is 0. So that short-term or immediate recognition asset, the collection of that cash basis AR, is going to be a $100 income event to the partnership, and I'm going to get a K1 with that $100 required allocation. And I got, again, let's go back to agreed upon and required. We're 50-50 partners, so it's 50-50, all income split 50-50, but the required allocation on that cash basis AR or immediate / short-term recognition says The collection of that $100 AR is forced my direction from a special income allocation. Okay? The second type of asset is depreciable asset. Okay? And we're going to hammer on that. The third type is sold in the future type asset. And man, these are tax technical terms. So if you look this shit up, that's exactly what you're going to find. Sold in the future asset. So the first three lines of that schedule, we had that $13 million that was forced in our client's direction, correct? And then you had that depreciation that occurred. So we had a short-term immediate asset, which was inventory. We had appreciated inventory, which they gave us value in our 704B capital account. But when those hogs were sold, that 13 million had to come my way because there was a difference between fair value and tax basis. The second was the category of depreciable, which was the $3 million going to the $50 million cash contributing partner. Then there was a $1 million pickup that I was required to have on my side to make all that whole. And there, to fast forward, there's under depreciable, there's traditional with curative, and remedial. And what we were looking at was remedial on the screen. That's what that was. And we're going to talk about those three items.
Because you had assets that had like 5-year lives, 10-year lives, 7-year lives, and you guys were saying, hey, we're just going to agree, hey, we're going to give this over 10.
Yeah, but that has nothing to do with traditional with curative or remedial.
Okay.
That's us coming up with a reasonable methodology to cure the inherent gain that was associated with those assets. Those don't conflate those two.
Okay.
But then sold in the future means that the only time we're going to have a required or forced allocation is when that asset's sold in the future. So what each of these have in common is the only time a required allocation is going to kick in and has to be allocated to a partner is when a taxable event occurs with respect to that asset. So in our brief example, we have immediate short-term recognition. Well, in that case, what we were looking at, they sold their hogs. In our example, the cash basis AR was collected. So therefore, there's a taxable event associated with that particular asset. Depreciable asset. Well, does depreciation affect the tax P&L? It does. So you have a taxable event associated with a depreciable asset. So you have to have a runoff with respect to that depreciable asset to calculate that required allocation. The third category is sold in the future. And the partnership interest of the two assets at the bottom were partnership interest. We don't know what those are really worth. There's no allocation that's going to be required until we actually convert that partnership interest into cash or some other taxable event like a failed 351 or whatever else. Okay?
Before you keep going.
Yeah.
Earlier we talked about required and agreed upon.
Mhm.
So the agreed upon, so like you and Aaron would be 50-50 and that would hit your tax capital. And then the required in your $900,000.
But hold on, let's be clear.
That's where I'm.
Okay, so what Sam's asking, this is a good question. Okay, so we're going to stick with sold in the future for a second, which is the land they were talking about, correct? And I think we have a slide in here somewhere that's going to demonstrate this on some level. So I have a 704. Sorry. Here,
Hey, you're fine.
thank you. You knew exactly where I was going. You have 704C, 704B, and you have inherent gain, right? We all agreed that those were our categories, right? And then we had Aaron and Pete that did the land earlier, okay? And you had Pete and Aaron, you have Pete and Aaron, and you have Pete and Aaron, right? And we said the economic deal was $1 million, correct? 1 million. And we said Aaron contributed cash, right? Okay, so Aaron's tax basis and his contribution's $1 million. But mine was 100,000, correct? So your question, and I got inherent gain for Pete of 900 and Aaron of 0, correct? And you're like, well, wait a minute, what's this required versus not required, and how do I know what the hell to do? Okay, so now, what land falls into which category? Is it short-term immediate? No. Is it depreciable? Sold in the future. So that inherent gain is sitting there waiting to be to generate a required allocation, and the only time that's going to generate a required allocation is when? When it's sold. So now we can push that required allocation aside from the thought process, and going back to what we said this morning, an S corp requires no memory, because if this was shoved into an S corp, that inherent gain is going to be split on a per share per day basis, and Aaron's going to have $450,000 a gain, or whatever the number is, coming his way. But in a partnership, we have to have a memory. We have to do this calculation and say 704B, 704C, and inherent gain. So now we earn $100,000 of rental income. And you're like, well, what do I do? I got the 704E account, I got 704B, what do I do? Well, they both have, that falls into agreed upon. So now we're going to have 50K, 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 50K. Because the agreed upon is going to hit both accounts. And that's part of something called capital accounts maintenance, is what that's going to be. So agreed upon hits both accounts. So let's do it this way. Agreed upon hits both 704B and 704C accounts. Required only hits 704C.
I was getting tripped up on the word required and which one. I got it. Thank you.
Yep. Sam, who you want to call in?
Alyssa.
Melissa, what's this say?
Okay, the following examples are intended to lay the foundation to discuss 704C concepts. Okay. Fact 1. Pete owns land A with a fair market value of 10,000 and a basis of 1,000. So what is the fair market value of Pete's ground? And if he sold the ground, what is the amount cash Pete will receive?
Okay.
Do you want me to keep going through the questions or answer?
Answer the question.
Okay. So fair market value is 10,000. And if he sold the ground, what amount of cash would he receive?
He'd get 10 grand of cash, wouldn't he?
Yeah.
Okay. What's 2 say?
What is the tax basis of Pete's ground? Is that the 1,000?
Yep.
If Pete sold the ground, how much gain will be reported by Pete?
9,000.
Yep.
Okay. Okay. So what's this say?
Jeff owns land B with the fair market value of 10,000 with the tax basis of 10,000. So what is the fair market value? It's 10,000. If the ground were sold, how much cash would Jeff receive? 10,000. Question 2 was tax basis of Jeff's ground, also 10,000. If Jeff sold the ground for 10,000, what is Jeff's gain? None. 0.
Okay. Keep going.
Okay, same as fact pattern number 1. However, the land has appreciated from 10,000 to 20,000. Basis of the ground remains at 1,000. So what is the fair market value of Pete's ground?
Yep.
So 20,000.
Yep.
How much has the ground appreciated since number 1? So 10,000.
Yep.
What is Pete's tax basis in the ground? 1,000. And if he sold the ground, what is the gain? 19.
Yep. Okay. Now, I don't know if I'm getting ahead of myself, Alyssa. I might be. It happens to me. So, I want to introduce a new concept here. And I think this is what I'm driving at when I'm asking these questions. Is that we're going to go back to this for a second. Okay? And if we talk about basis in the ground, how much tax basis did Pete have in his ground?
1,000.
No, up here. Sorry.
Oh,
I'm getting away from that. I'm coming back to the word.
okay. Sorry, say that again.
How much tax basis a contribution did Pete have in this ground?
Oh, 100,000.
100,000.
Okay.
Okay. What was the fair value of Pete's ground?
1 million.
1 million. So this is where this gets a little tricky because you have to know the rule, you know how to execute on the rule, but it's not intuitive. Is it intuitive that Pete went to the bank and either borrowed 100,000 or pulled 100,000 out of his bank account, went and bought a piece of ground? You can wrap your head around that concept because there was an actual action that took place.
Right.
Okay? But when we agree on what this economic deal is, there's a fair value basis associated with that. So what's Pete's fair value basis in the ground?
1 million.
$1 million. Okay? So now if the ground is sold for $1 million, how much tax gain does the partnership have?
900,000.
900,000, which would be specially allocated to Pete.
Yes.
Okay? So what we're shooting for, we're going to do this two ways. Okay? One, the ground is sold for 1 million. Two, ground is sold for 2 million. Okay? So the concept that is hard to wrap your head around, that's difficult on some level, is there's a gain-loss calc that occurs both for 704C and 704B. So if we sell at $1 million, proceeds is how much, Melissa?
1 million.
Okay, so we're going to go 704C and 704B. 1 million. How much proceeds is my 704B?
Also 1 million.
Also $1 million. What's my basis for 704C?
100,000.
100,000. What's my basis for 704B?
1 million.
1 million. So I have no gain or loss, correct?
Yep.
But I have a 900 gain here, correct?
Yep.
So this says, for 704B purposes, that there's no gain or loss that needs to be allocated. But for 704C, I got 900, and I got 900 of inherent gain, and I know who to push that to because it's required allocation. So let's now change that to 2 million. How much gain do I have?
1.9.
1.9. How much gain do I have?
1 million.
1 million. So going back to Sam's earlier question, what's this required versus not required? Okay.
Yep.
So how much gain? Well, let's talk about 704B first. What's Aaron and I deal? Economic deal. How are we splitting income?
50-50.
50-50.
Guessing.
So the million is going to go 500K to Aaron and 500K to Pete. Okay? But over here, we have Aaron and Pete. How much required income has to go to Aaron?
Based off like the 704C percentage that they get. Like how it's allocated.
How much inherent gain did Aaron come to the table?
900,000. Oh. 0. 900,000.
Aaron is 0 and Pete's 900. How much total gain do we have?
1.9. So you have 1 million left to.
Okay, so now we have agreed What's our deal? Economic deal?
250.
So how much does Aaron get?
So 500.
And 500. So 1.4 and 500, correct? So we're gonna come down here and turn this off for a second. How much 704B income was allocated?
500,000.
500. What does that foot to?
1.5.
1.5. Okay. How much 704C income or goes to Pete?
1.4 million.
1.4. How much goes to Aaron?
500.
500.
I see.
Okay. So this concept, which is hard to wrap your head around, and part of what I'm driving at here is, well, in this case, it was 10,000, which appreciated to 20. In this case, it was $1 million that appreciated to 2 million. You have this concept of you have a gain-loss calc that occurs for 704B, and your basis for that gain-loss calc is what amount did you agree upon was the fair value of that particular asset at the date of contribution. And your 704C kicks out what's required versus what's agreed upon.
Gotcha.
Is how that works. Okay, I think that's what I was talking about there.
Yeah.
But I don't know.
What happens if you sell for 500,000?
I hate that question. But let's do it because I'm never really sure, honestly. Let's see if we can make our capital accounts work. Okay, so if we sell for 500, and this is a 500K loss, correct?
Yep.
And we have 400K income, correct? Oh, Jesus Christ, what do we do with this? Honestly, we have negative 250, right, Brett?
Yep.
Negative 250, 750, 750. And it should equalize out. But does that mean I mean, it feels like this goes 400 here, I got 500, and this is 0, but my instinct is that's wrong. Because
You still have 400 of inherent gains sitting out there.
not anymore, I think it just,
Does it just go away?
I think so. Because that particular asset was transacted on. My instinct is this what's happened. This what happens because we only have 400 of income to allocate. And now we have a disconnect in between the capital accounts, and they are never going to equalize.
If you had a curative election out there, would you maybe shoot someone a loss and someone a gain to fix it?
Don't know. I hate losses. When I say I don't really understand them, that's exactly what I mean. Is I have no idea how that really works. I should, but I don't.
Wouldn't the argument be on inception of this partnership, Pete had a gain immediately, right? By getting 50% ownership that was worth 1 million in his land that turned out to be worth 500. He was essentially came out 500 ahead.
Well, I mean, the only thing, alternative is that this is 650, and this is negative 250. This is 750, and this is 750. That's the alternative.
Because if you in your world of like required versus what was the other word you used, agreed upon?
Agreed upon, yep.
Like to me, in theory, there's a required income allocation of 400 to what, Pete,
Yep.
and then there's a agreed upon loss of 250 to each of you.
Yeah, but where's that coming from?
fiction.
Yeah, I know, but at the end of the day, I mean, if this equalizes the capital account.
Agreed. If not, Pete's gonna get it. In your other example, Pete will get it when we liquidate.
Or more like Aaron has a cap loss when we liquidate.
Sorry, yep, I'm getting the two mixed up. And Pete has a cap gain. Wouldn't he?
Well, right now we say we sold it for 500. At that point, we have $1.5 million. Yeah. You would have cap gain.
So I think at some point it likely is to get resolved.
Oh, clearly, but when and how is kind of the question.
Yeah.
And whether or not that's on K1 or off K1, and if that's reported by the individual because they know what's going on, or we
Well,
footnote it or something.
It'd
along
be off
those lines.
K1 in
Right.
liquidation.
Correct. I agree.
But if it's a required allocation to say Pete gets 650 and Aaron gets 250, that's on K1.
Agreed.
I mean, so
I know from my perspective, a lot of these things that when this type of things happens, as much as we can include on the K1, we try to do so because again, otherwise you're going on the belief that that partner is going to know that there's some kind of off K1 income or loss that's needed, and you're never going to be so sure that's going to happen.
And the other thing I would say also is I think this literally, you could not have a simpler example of one asset ground in a 50-50 partnership. And we start doing these contributions where maybe someone's contributing an operating business
or
or
you two chat for a while.
we sold.
I'll be right back.
I feel like a lot of times we have to come up with shortcuts that work, that are practical versus right. Because if you did it to the, completely perfect way and tracked it on asset by asset purpose, it'd just be completely impractical to the point of being impossible.
Correct. And sometimes that practicality is maybe even allocating that entire gain in that year to that partner, because otherwise then the 704C goes away and you forget about it. And at some point, does somebody forget about a loss or a gain? And so do you allocate the gain in a way that cures the difference immediately, right? Rather than on the liquidation. And again, it's not right. And sometimes it's not great, but based on a conversation with the partners could make sense in certain situations.
Yeah, I've had that exact pattern in our capital. I was working on the capital district. We had multiple pieces of land in there with inherent gain. We sold one of the lots for more than what was the inherent gain on that lot. For the tax purposes, it didn't hurt the one partner with the inherent gain to pick up more than the inherent gain they had at the time. So we allocated all the gain from that sale to cure up some of the other inherent gain as well. But both sides have to agree to that because otherwise.
Right.
What were we talking about before I left?
We're talking about the practicality of 704C allocations and how sometimes you got to make some decisions about what's right and easiest for the long-term tracking versus what's technically correct. If you got a bunch of assets or
Actually, who sat in here while I was on that call? I mean, at the end of the day, we were on for standard, and the discussion of the right number of the runoff for the years was one of the focal points for sure. And we chose 10 years because the underlying depreciable assets were 10-year assets, a majority of them, and that's how we ran it out. And
Rather than bifurcating each by each different life. Right.
So you were saying allocate losses right away in the year, so you don't have to worry about it in the end.
Well,
the quicker you can
depends. Yeah.
cure your 704C, 704B difference, the less likely that it gets missed completely.
Yeah, and so if it would get
It'd be gains, not losses. Right. Well, I guess it could be either.
like in
So, like,
this,
Brett,
this
I'll give you
situation.
a practical example. I think Pete helped us set this up. It predates me. But like Heritage runs a group of nursing facilities and probably
oh shit, yeah.
yeah, it's a messy one. And they started by contributing maybe like 15 properties to a holding company that had 100 investors. And since then, probably every 3 or 4 years, the kind of core 8 people contributes a new one that they've invested in, gotten up and running, stabilized, got leased up, all that stuff, because the holding company that has all these different investors wouldn't want to take the risk to go pull something out of the ground. Okay? Well, every time that happens, I have to run a huge calc that says what's everybody's tax basis capital, what's the fair market value capital that they have in this thing, and then I restart the 704C clock for the entire thing, even though some of those properties were contributed 15 years ago. So I'm doing one 704C asset. I picked 30 years because that felt like a reasonable life for multi-family senior care. And, basically I have stuff that was contributed in 2012 that had a little bit of 704C left, and I'm just restarting it when I contribute an asset each time. And that was the most practical way to do it. And then we say the rest will get cured when we eventually liquidate. But if you start tracking 25 different nursing facilities by their fridges and their carpeting and their roof and the core of the structure and the land, there'd be
It's gonna be a $75,000
Yeah.
tax return.
correct. Versus like each time I roll this forward, it costs probably 10, 15 grand for the calc, but we know what it is and then we disclose it to everyone so people know who have really big inherent gains, and it'll get solved at the end. And it's the most practical way to do
So
it.
if you're doing that year over year, that's all ordinary income items.
Yep.
If you would wait and then it's a liquidation problem in the end, could you potentially have capital or
A lot of it would
character?
probably be cured with 1250 if I ventured to guess.
Yep.
So yes, but there's for sure rate play there too.
That's a specific heritage. That's specific to heritage, though.
But the same would tack to any real estate probably, right?
For real estate, sure, but for
Tables and chairs.
no, for something that has intangibles, part of their built-in gain.
Yeah.
If LRS were in a partnership and Jeff contributed to the partnership, there's a huge intangible there,
Yeah.
which is capital in nature.
Yeah.
So that asset that's capital in nature, we have those 3 buckets: short-term, depreciable, and something that's going to be sold in the future. Well, intangibles. How hard is it to send me an invite? Intangibles are one that's going to be sold in the future, probably, right?
Yeah.
It depends, and it's going to depend on whether you that could end up with a required allocation, depending on the methodology, which is traditional with curative, and remedial. And those choices, traditional with curative, and remedial, all have to do with depreciable assets. And if you have purchased goodwill, do you get to write off that goodwill? Over what period?
15.
Over 15 years. So, and we would demonstrate this. I'm planning on demonstrating this. Let's see. If you're using remedial, even though you don't have purchased goodwill, it can still result in an allocation. Okay, so I think part of what I was driving at was there's a 704B gain loss transaction or transaction that has to be accounted for, and a 704C transaction has to be accounted for. Sam, what's this page say?
Same facts as fact pattern number 2, except the ground's fair market value is 20 grand. Basis in the ground remains at 10K. What's the fair market value? Just ground, 20K. How much has the ground appreciated since the fact pattern existed in fact pattern number 2? 10K. What's Jeff's tax basis in the ground? 10K. If Jeff sold the ground, what's the gain in the ground? 10K.
Okay. What's 5 say?
Pete and Jeff deposited $500 each into a First National Bank account. They agreed to buy land C for $1,000. The ground's fair market value is 20 grand. What's the fair market value of the land? 20,000. What's Jeff and Pete's tax basis in the land? 1,000. Or is it asking? Would it be 500 each or just?
It's combined, 500 each or 1,000.
All right. If the ground was sold, what gain would be generated? 19,000. If the ground was sold, what is Jeff's gain? What is that? 9.5.
9,500, yep.
And then same for question 5.
Okay, so part of this exercise is truly trying to demonstrate that appreciation that occurs post people getting together, which we had up here at 2 million and 1 million, right, is going to be split based on the required allocation versus, the agreed upon allocation, and the inherent gain is going to go with through a required allocation. And Sam, does the required allocation hit the 704B account or 704C account?
C.
C. And that required allocation, does it get the capital accounts more out of whack, or does it get them in sync?
In sync.
In sync. So the inherent gain, the required allocation, is meant to push the gain to the right person who is the inherent gain contributor when the partnership was put together. Okay? Who you want to call in?
Brett.
Have you been called on at all today?
No,
That's why I called him.
It's good to be Brett.
I was hoping to make it the whole day.
Let's just say, Brett, I'm like, because Stuthman's, I thought you were flying under the radar screen. Son of a bitch. Brett, you've really flown under the radar.
Tried to. Fact pattern number 5 continued. Question 6, what is the process for Pete and Jeff to report the gain? Is there a partnership?
Yeah.
Yes. What gain is reported at the partnership or entity level? If the partnership sold the ground, it would be a $19,000
Yep.
gain. If the gain is reported at the entity level, how is the gain reported to Jeff and Pete? Stated differently, what tax document is provided to Jeff and Pete? They get a K-1 that
Yep.
shows they have 1231 gain of 9,500. Good?
Yeah, sure.
Okay.
Does anybody want to disagree with that 1231? Why?
So it depends what you're doing with the land.
Depends on what you're doing with land. Man, land is always tricky. It could be inventory, 1231, or capital. You have a presumption that it was used in the trader business. What's the definition? 1231?
Used in a trader business held for more than 1 year.
And
Appreciable tangible property.
it could be either real property used in trader business for more than 1 year, or tangible personal property used in a trader business subject to depreciation for more than 1 year. Those are two categories. But anyway, we're splitting hairs. Or Sam is. She was giving me a look. She's the one that made me say it.
Okay. Keep going.
Yeah, please.
The basis in the partnership interest of Jeff and Pete is what amount? Is that before or after the sale?
What number are you on?
6D.
After the sale.
After the sale, 10,000.
10,000. Okay. Go ahead.
Pete and Jeff's basis in the partnership interest post-sale is how much? 10,000.
Yep.
How much cash did Pete and Jeff receive from the sale of land?
10 each.
Did the partnership hold on to it?
It's making the assumption that it was distributed. I like how you're splitting hairs now. I love it.
10,000.
Yeah.
Did the cash received equal the tax basis calculated in 6F above? Yes.
Okay, so this, when I originally did this slide was intended to start sniffing at and introducing the concept that there would be an allocation that's for 704B, there's an allocation for 704C, and that those allocations are intended to drive the capital accounts into the same spot. This was really 704-101. Okay? Brett, who you want to call in?
Leslie.
704B capital account. 704B capital account equals the fair market value of property being contributed to a partnership. A, the 704B capital account is a partnership IOU based on fair market value of property being contributed. Stated differently, the 704B capital account is a partner's economic right. 704B capital account is adjusted for division of income, loss, and distribution that occur post-formation. Review the PAC patterns 1 through 5. What is the economic 704B capital assuming the property was contributed to a partnership? So, fact pattern number 1, 704B.
You know what? Here, let's do it this way. That way you guys don't have to. Okay? This is fact pattern number 1. Isn't it?
Yes.
Okay, so what under this fact pattern, what is the 704B capital account?
So that'd be the fair market value of $10,000 of the land that Pete owns.
Yep. Okay,
Yeah.
you good with that? Everybody good with that? What about 2?
So Jeff owning the land with fair market value of 10,000.
Okay, what about 3?
3 is, so when he contributed it, it had a fair market value of $10,000, but now it appreciated to 20,000.
So, but there's an assumption, though, embedded. Did it get contributed to a partnership that's saying, how did I phrase the question? Okay, what is the economic, assuming the property was contributed to a partnership? And you could do this one of 2 ways. The way I would read this is that it's contributed at 20, just based on how I wrote that question, but your 10 is not inappropriate. So your 10 is presuming that it was contributed when it was worth 10 and that there was appreciation of 20, or we just knew it was worth 10 at some point, it appreciated 20, and then it was contributed, which is worth 20. Either is an acceptable answer to me, but it's what is the fair value of that asset when it was at the date it was contributed. Okay?
All right, number 4. So if it was contributed when it was 20?
Yep. Again, I think I was shooting for the appreciated number. 5?
Grounds fair market value. So fair market value is 20.
Yep. Whoops. Okay. What about who you want to call in, Leslie?
Let's do Austin.
Rustin? All right, so what's 704C account?
1,000.
1,000? 2?
10,000.
10,000? 3?
1,000.
4?
10,000.
5?
1,000.
Yeah, and 5's confusing because it looks like there's partnership there on top of it. Okay, so in doing the analysis upon the formation of a partnership, you have to know the tax basis of the asset that's being contributed. You have to know the fair value of the asset that's being contributed, and you have to know those items in order to populate the 704B and 704C capital accounts. Is that clear enough to everybody? Okay, so now we're going to take, well, Austin, what's this page say? 1, 2, and 3, and 4.
Number 1, why do we quantify the 704B and 704C capital accounts when a partnership is formed? To quantify the inherent gain or loss at the date of formation. Number 2, why do we care about the inherent gain at the date of formation? This is very informative in what tax law required special allocations will be. Remember, a tax law required special allocation is very different than agreed to allocations that is set forth in the partnership agreement. How do you quantify the inherent gain at the date of formation? The formula 704B minus 704C equals the inherent gain.
Okay, so what was my 704B capital account, Leslie, for 1, 2, 3, 4, and 5?
I think it was 10-10, 2020.
Does that sound right to everybody? I can't remember. Austin, what was my 704C?
Do 1,000, 10,000, 1,000, 10,000, and 1,000.
Okay. And what's my inherent gain? Austin calling somebody?
Stu,
9,000, 0, 19,000, 10,000, and 19,000.
Okay. All right, let's see what the next slide says.
How is the inherent gain informative and required special allocations for tax? The inherent gain as a data contribution is allocated to the partner who contributed the property when the property is sold or transacted upon.
Okay. What's this say, Stu?
Process: determine the properties contributed to the partnership. 2, determine the fair market value of the property being contributed. The fair market value is generally agreed upon by the partners who contributed to the partnership. 3, determine the tax basis of the property contributed to the partnership. 4, construct a 704B, C, and inherent gain balance sheet. 5, build a 704B and 704C capital account. 6, track your 704B and C capital accounts for transactions that occur post-formation. 7, if the 704B and C capital accounts do not equal at the date of the formation, the required special allocation for tax should equalize them.
Okay, so this is how I just formulated in my head what a procedure might be. Might be right, might be wrong, but this is how my brain thinks about how to confront this situation. Okay, determine the property that's contributed. So you have to say, well, what was contributed? And all the previous fact patterns, they happen to be land. In the call I had before, I had hogs, I had depreciable property, and I had partnership interests. So in that call, there were 3 specific items that had inherent gain in them. So it's not always just as simple as land being contributed. Determine the fair market value of the property being contributed. That's something that's negotiated between the people that are doing the contributing. So, Stu, who you want to call in?
Mar.
Who?
Me.
Mar? Oh, he threw that at you, didn't he? Right there. So and this is a skill that I think you guys probably might have, but if you don't, you probably want to develop it, is inferring what value is. And inferring what value is becoming wildly more difficult with waterfalls. It's hard. So if Aaron put in $1 million of cash and I put in a piece of ground and we're 50-50, you can infer the value of my ground is what, Nate?
$1 million.
$1 million. So you're using the guidepost of the cash contributor as what the other value of the assets are. Okay, so determine the fair market value of the property being contributed. The fair market value is generally agreed upon by the partners who contributed it. Okay, determine the basis of the property being contributed. Fine. Construct a 704B, 704C, and inherent gain balance sheet. What on God's green earth does that mean, Nate?
The 704B balance sheet would be the fair market value balance sheet.
Okay.
704C would be your tax basis balance sheet. And then the inherent gain balance sheet would just be your 704B minus 704C, whatever the differences would be here.
Okay, so far all we've really talked about is 704B and 704C capital accounts, have we not? This balance sheet is kind of a little bit of a new twist on what we're talking about. In the equity section of the 704B and 704C balance sheet, is going to equal the 704B and C capital accounts. Your equity section and your 704, in your capital accounts and your equity on the balance sheet, those two are tied completely together. The balance sheet itself, what were the three categories of assets that we're dealing with for 704 purposes?
Short-term realized
Yep.
depreciable assets. and
Yep.
Things that we will sell in the future.
Things we sell in the future. And how do we quantify what those are? We do it by the construction of the 704C, B, and C balance sheet. So we're going to say, for purposes of discussion, that Austin has PP&E, acquisition cost of $1 million, a cum of $1 million, net book value, how much, Austin?
0.
0. Fair market value, well, we'll leave that out for a second. And we have Pete with ground with acquisition cost of $100,000. And we have, let's leave it at that. And we have Aaron, cash of $1 million. And we're going to contribute all these assets. I'm contributing my ground, Austin's contributing his PP&E, and Aaron's contributing his cash for $1 million. Okay, so step one says what up there? Alyssa?
From the property contributed.
We've done that.
Yep.
We did. What's step two say?
Determine the fair market value of the property being contributed.
Okay. What's the fair market value of Austin's equipment?
1 million,
How do you know that?
because that's what the acquisition cost was.
Nope.
Or is that? It's like agreed upon? Is that what you're saying?
Sure. But if Austin and Aaron and I are 1/3, 1/3, is there any information that you can infer what each interest is worth? Brett?
Cash.
Cash. So Aaron contributed $1 million in cash for a 1/3 interest. Would that infer that Pete's interest and Austin's interest are both worth $1 million because we're each getting a third?
Mm-hmm.
Depends. What if Pete's doing a bunch of sweat equity and other stuff too? I
Well,
feel like we see that a lot.
fair enough, but we're going, with respect to just working through this,
Yep.
we're going to push that aside just for a second because the water's going to be muddy enough here in a second.
Okay.
Okay, so we can now say Austin's piece is 1 million of value, correct? And we can say Pete's ground is fair market value, 1 million, correct? Because we infer that based on Aaron's contribution to cash.
Yeah.
Okay?
Yep.
What's the next thing say?
Determine the tax basis of the property contributed to the partnership.
And we gave that to you, right? What's the next thing say?
Construct a 704B, 704C, and an inherent gain balance sheet.
Okay? So one of the skills that we talked about in other classes is how do you construct a fair market value balance? How do we construct a balance sheet? Where do we always start, Stephen?
The equity section.
The equity section. And taking a step back, what's the accounting equation that you're using to say the equity section?
Well, we know what the
Hold on, just tell me the equation.
assets
Assets.
equals liabilities plus equity.
Okay, so we know, right, that what the equity section is. So we said 704B balance sheet, correct? 704B. We have equity section, because that's where you said that we need to start, correct? So taking a note saying that we always start in the equity section is worth taking a note about, I think, is it not? So we have Austin, Pete, and Aaron, correct? What's Austin's fair market value equity?
They're all 1,000,000.
They're all $1 million. Okay? Was there any sort of liabilities? Is there any liabilities on this?
Nope.
So liabilities is 0. So liabilities plus equity is how much?
3 million.
3 million. Okay? So what assets were contributed?
The PP&E.
PP&E,
Let's probably start with cash.
cash is fine.
Then land.
Land. And what's the value of those?
They're all 1,000,000.
1 million. $3 million. Maher, what's my tax basis side look like?
Your tax basis side for equity,
It's fine.
yeah, we're good. And then if we,
Oh, no. For tax basis, what is it? Let's talk about 704C now. What's Austin's tax basis?
0.
0. And what code section tells you that his tax equity is 0? 723? Perfect. Okay. So what's Pete's tax basis?
100,000.
100. What's Aaron's tax basis?
Million.
A million. So we have 1.1 million because we have no liabilities, correct?
Yep.
So now we know that this side of the balance sheet is 1.1 million. Basis in the cash
1 million.
is 1 million. What about the PP&E?
0.
0. What about the land?
100,000.
100K. And our inherent gain is what?
0. A million. 900,000.
Okay. There's no inherent gain. So Austin's inherent gain is 1 million. Pete's is 900. And Aaron's is 0. So the construction of the balance sheet, the fair value balance sheet, and the tax basis balance sheet tells us that in the equity section, Austin has a pregnant gain of $1 million. Pete has a pregnant gain of 900,000, and Aaron has a pregnant gain of 0. But more importantly, there were 3 kinds of assets, and what were they, Noodles?
They were like, what did we say? Short-term recognizable,
Short-term recognizable,
depreciable assets,
depreciable
and
assets,
things we will sell in the future.
and things we'll sell in the future. Okay? And now we know that PP&E is one asset, the land is another, and land is only going to generate a required allocation when, Kelsey?
When it's sold.
When it's sold. The depreciable asset's going to generate its required allocation when?
It's sold.
Leslie?
Appreciated.
When it's depreciated. And that by itself, when you go back to the call that we had earlier, I said that there was a depreciation that was associated with the party that put in 50 million, that was $3 million, and then which resulted in the allocation of income to standard of $1 million. Okay, and we're going to get into what that is. But the construction of the balance sheet tells us which partner has the inherent gain. It also tells us which asset has the inherent gain embedded in that asset. And when we know that which asset has the embedded gain and which was the contributing partner, we know who to tie that inherent gain to. And when the land is sold, Noodles, who gets this required allocation?
You.
Me. And when we have depreciation, who gets the required allocation?
Austin.
Austin. You're going to get income, Austin.
Yeah.
This is a deduction. You're going to get income. But it tells us that that's you. So the construction of the balance sheet is very, very, very important for what we're doing. Okay? Shit, we're only on step 4. Okay? Build a 704B and C capital account, which again, the equity section does that. But if we come over here, does everybody understand the capital accounts and what they would look like? Okay. Then what's 6 say? Leslie?
Track your 704B and 704C capital accounts for transactions that occur post-formation.
Okay, and going back to Sam's question earlier, we have the required, or we have the agreed upon, which hits one account, both accounts, neither accounts. Both. We have a required, which hits C only. Okay, and when it talks about track your 704B and your 704C capital accounts, it says which is going to result in a
recording in progress.
And then 7, what's Sam? 7 say, Sam?
If the 704B and 704C capital accounts do not equal at the date of formation, the required special allocation for tax should equalize them.
Now, we're going to talk about this, but this is worth putting a highlighter on that last piece. And I did hand out highlighters just for such an occasion. The sentence should equalize them isn't always true. Because again, we go back to there's 3 methodologies that exist. One is traditional, second is traditional with curative, and the third is remedial. And the traditional method, and all those 3 methodologies have to do with the depreciable assets. We have those 3 categories. The traditional with curative, and remedial have to do with depreciable assets and how we're going to allocate those deductions. So it's possible that if you choose the traditional method, that while the non-inherent gain partner has an amount that should be allocable to them, an amount for fair value depreciation of $100, there may not be deduction to allocate to them. So even though the fair value capital account says there's a required allocation, it might be that there's not enough deduction to support that allocation and nothing happens for tax. And if that's true, and we're going to demonstrate this, that the required allocation didn't occur by virtue of not having enough deduction, and if it didn't occur by virtue of not having enough deduction, your capital accounts aren't going to equalize. And we're going to demonstrate that.
All right, I'm gonna kind of frame this, but this kind of coincidentally, this is like a little bit urgent for me because I'm meeting with this client tomorrow. Pete and I have been kind of working through this issue together. And then I was asking if I could have him review my calcs before I go talk to him with JT
Welcome
tomorrow.
to class.
What?
Welcome to class.
Yeah, and then I told Pete, well, why don't we just make this a case study because it's pretty applicable. And honestly, it's kind of funny that this is during the 704C, 704B conversation because that is the crux of this issue. But it kind of conflates, I would say, 2 complicated problems because I have a 704C issue and then I also have a special allocation of income, which was really why I went to Pete because it was spinning me into the ground. So some of you folks, like especially the Omaha folks, will probably be a little bit aware of this project. This is the Crossroads Mall at 72nd and Dodge. It's been kind of a, an odyssey to say the least. And one of our clients, the Lockwood team, is kind of one of the major developers in the project, alongside a non-client, the Krejci family. So the way that our partnership came together way back when, probably 7-8 years ago, was Frank Krejci, who's now deceased, which is part of the complicating factor of this whole thing, had purchased the Crossroads Mall at 72nd Dodge for about $8 million. And that was, probably 15 years ago. I don't know when it was. And him and Chip, our client, the Lockwood team, decide to say, okay, hey, let's come in a joint venture together. I'll do the sweat equity, you contribute your ground, and we're 50-50. And the way that they pegged it is they said, hey, we'll agree that the ground that Frank is contributing to our partnership is worth $25 million. So 8 million of basis, 25 million of fair market value. Chip, you need to come, or Lockwood, come with $2 million. Okay. And then we're 50-50 in this partnership after we cure the 25-2. So the first 27 million that comes out will go out in that ratio of 25-2. And then we're 50-50 past that. So embedded in that, okay, the other thing that's a little bit complicated that's leading me to have some heartburn here is we said that this first sale that happens, we're not going to take any tax distributions. We're only going to pay debt, which, just big sale dollars makes me a little nervous. So I'm getting pressured in a pretty serious way to try and figure out what the gain is and who gets what. Because now that the one party has died, his estate doesn't care as much. They got a huge step up. But for my taxpayer, it really matters. So in the vein of Pete's list, the way that I thought about this, really simplistically, is I just took their balance sheet. So I asked for it as of 9/30, and I got it in Excel. And that just so happens to be my book column here. And the client, you'll see, booked these, this 25-2. I knew that was a book basis 704B balance sheet because I knew I only had a little over $8 million of basis in this thing when we first started. Yep.
Where the hell's the losses that you've incurred since inception?
There are no losses. It's all been capitalized in the CIP.
Okay, all right.
Yep.
So, because I thought there were some losses that were taken,
Maybe a little bit.
but not much.
Yeah,
okay.
we can look at our capital accounts because I also ran the basis schedule up, down, and tracked it down. But so my balance sheet today is, and it's probably sitting, some of it's sitting here in this remainder speed.
Okay.
So I have cash, AR, $63 million of construction in progress, some AP, a big loan to Pinnacle Bank, his contribution, my contribution, and then some historical retained earnings. So basically, there's still like a whatchamacallit, like a sign down there that we're collecting some rental income on. Maybe like Verizon has a tower in there. The city was paying rent for a garage, even though no one was using it. Some stuff like that was leading us to have some income over a period of time. So I start there. That's a true book basis balance sheet, 704B balance sheet. With the agreed upon fair market value. I then back off the inherent gain. And for me, I kind of thought about this like Pete described. I know, and it's a little bit different, but I knew what Frank's tax basis was in the assets he contributed, which was like a pretty strong point of emphasis when this thing came together, 5, 6, 7 years ago, was I knew that was a problem. So I was really hustling Frank's CPA to say, hey, I really need to understand what the basis is so I can get a real balance sheet. Because I knew the bookkeeper that was keeping this or the controller was going to go to book basis. And I needed to, never an easier time to figure out what your 704C balance sheet is than at the beginning. I also knew that, Chips is cash. And then just to make this easier, I just split the retained earnings 50-50 to make my calc look a little better. And then I work backwards, the debt is the debt, the cash is the cash, the AR is the AR. And I knew then that I must only have 46 million of cost in my, my development costs on my balance sheet versus the 63 million that I have on my book side. I know that we're going to have about 3 closings here over the next 3 years, but I know that the total agreed upon price for the entire ground is 107 million. I'm saying cash is cash, AR is AR, AP is what it is, debt is what it is. And then I'm getting here and I'll show you the calc I did below. I'm getting here by saying, hey, if we liquidated for this 107 million based on our partnership agreement, who gets what? And so, again, I'll get to that calc in a second here. And then I show my gain loss total, which is basically the 107 minus the 46 million of cost. Okay. So I went down and tried to say, okay, where is this cash going to go to try and validate these numbers and these numbers? Because Pete had already caught me where I'd made a pretty big mistake in my 754 calc. for not thinking through the waterfall and just assuming we're 50-50. So I was trying to avoid that this time. So I went and said, hey, if I sell this whole thing out, I collect my AR, I already have my cash, I'll get 107,758,000 of cash get deposited into the bank. I need to go settle debt of 36.8 million. So in theory, after I settle everything, I should have, approximately 71 million left to split. I know that first I do a pref of 25 million because we return capital to Krejci, return 2 million of cash to me. After I do that, there's 43 million left to split, which is just the 70 minus the 27. And so each of us gets half of that, or 21.9 million, which I then just took up here and said, okay, 25 million plus 29, 2 million plus the 25 plus the 21 and the 2 million plus the 21. All right, so does that kind of generally make sense, like setting up the balance sheet with a book, an inherent gain, and a 704C? So then I go back and I say, okay, what is this by partner? And I probably am overcooking this, but I like to check things 3 different ways to make sure there's not a miss. And then the ultimate check to me is running through a liquidation on a tax basis in a book basis capital account and seeing if I get to 0. Because if you get to 0, you probably don't have a break. And so I went and said, okay, what's the proceeds that I think by partner? What's everyone's basis? What's the gain? Which is essentially the same thing as this up here, but now I'm just breaking it out on a partner by partner basis. And where it becomes critical for me is I know this is going to happen in, 3 different closings at a minimum. The first of which is happening this year. And knowing that I don't get a tax distribution and I'm going to owe some money, this is where the creative tax professional comes in me to say, okay, what can I manipulate in the gain? Knowing that I'm not the person with the 704C, might I mess with the 704C to push more gain to Frank since he's not a taxpayer and I am? Might I not do my basis pro rata, across the project and act like more of the cost happened on this first lot I'm selling? There's all that type of stuff that I think you need to think about. And again, you can't just make stuff up by any stretch of imagination, but it's not always fair just to assume, okay, the basis happened equally across this entire project, which is, just so everyone knows, that's what I'm doing here to start, just to try and illustrate the concept. So I know I have this amount of proceeds in total. Oh, looks like we lost VDI again. There we go. This 38 is a real number that's coming from the client, so it's not quite a third. There's that, I'm getting slightly more of that. And then I allocated this 47 million I have in total of basis. Oh, come on. I'm allocating that 47 million of basis I have across the 3 sales based on a ratio of the proceeds over total proceeds. Again, to me, this is a number that I want to discuss with the client, because should this, instead of having, a little over a third, instead of having 35% of the basis, should it have 40% of the basis? Should it have 45% of the basis? Are we selling the most valuable piece of ground first? I think there are all different types of questions we can ask to maybe get to a different tax answer, and I'm not to that point yet. I'm just trying to illustrate. Then I went and I said, okay, I know I have this overall gain in the project by closing of 21.91919. How's that going to go by partner? And I started with saying, hey, Frank's got total inherent gain of 19.6 million, or 16.9 million, sorry. And to just make this easy, I said, okay, I got 3 closings. I'm going to bring that 5.6 million in equal each time. And so I said, okay, on this first closing, how's this gain going to flow? And I said, first, I'm going to take 1/3 of my 704C, and then each other piece is 50-50. And you'll see I'm running this a couple different ways, because another way I'm running it is saying, hey, rather than just doing a third, should I allocate my 704C the same way I did my tax basis, which probably honestly makes more sense, but I'm just trying to illustrate to them that we can do this any reasonable way as long as the other side's account signs off on it. So I then go through and I say, okay, let's look at the cash, because that's what ultimately matters. And let's, this is what the client's gonna want to see, and then let's compare that to the taxable income calc. So again, I know that I have 107 million total sellout. I know this, I got to pay off this debt. There's 70 million of cash, which, ties to what I had up here. And then I know I have a waterfall to do, and then we split 50-50. And I just ran it through closings. And like I said, one of the complexities I have here is the fact that my first sale for 38.8, they're making us pay off all the debt first, which makes no sense to me, but that's what we've agreed to. And then there's only 2 million of cash to go out, which will not eat materially into my waterfall. And then the second sale will happen. We'll finish the waterfall, and there'll be 9.4 million left to split 50-50. And then the last closing, all 35 million will come out 50-50.
Hold on, but what you're doing, you're framing the cash for this piece,
Yep,
which is a complete disconnect
from the gain.
from how the gain's being allocated.
Correct. And so what I'm trying to show my client, who in this case is Royce, is I'm trying to make him aware, because he was like, hey, I just want to pay off this debt. And it shouldn't matter to me because I'm not getting a lot of cash. And I said, you are getting a lot of gain. So don't just agree to not to paying off all this debt and not doing a tax distribution without us figuring out what this number is, because you're going to owe a lot of tax in April, which is then when I got Pete involved, because I wasn't comfortable. I hadn't even gotten to even close to this point yet of working out this math, and I needed Pete to just help point me in this direction to make sure I was, kind of considering the issues. So then I say, okay, on a by partner basis, I know that we start with Frank's got to get in total. Let's see, how did I do this? Frank's going to get in total. What the hell was I doing here? Sorry. Okay. This is kind of shittily labeled. I apologize. This is total. Here it is by closing. This should be just a total number, but I'm showing Frank. So he's getting $1.8 million of his preferred in the first close. He's getting the remaining 23 million of cash in the second close. Then he's getting 4.7 of this 50-50 and 17. And if you take all three of these cashes he's receiving, it equals his total cash here. And Chip's side, in this first close, he's only getting 145,000 of cash, even though, like we showed up here, his total gain that he's going to get allocated is 8.1 million bucks. So kind of a big tax miss there.
Hold on, say that again, because I kind of fell asleep.
So Chip, in his first sale, he's only going to get 145,000 of cash, because that's the pro rata cash that's coming out. That's the 25-2 ratio of this. Where's that waterfall of this $1.9 million?
Yep.
But I just said up here.
You're doing that proportional 25-2.
Correct.
For 27 total.
Yep.
Proportional 2 divided by 27, and 25 divided by 7.
That's exactly right. Yep. That's exactly how I did that. But what's the issue I'm having here is I got Chip that's going to get a gain. His K1's going to say 8.1 million, but he's only going to get 145,000 of cash because of our choice to pay off all this debt. So the other thing that I think is good, and Brett, you kind of like hit this earlier, again, coincidentally, one of the things that I started with here as I was trying to do this kind of calc in my head before I set and put pencil to paper with Pete was I was like, okay, well, I'm going to underwrite this at, 37% Fed and 5% Nebraska. And it goes into that whole, you got to define what property you have. Is this inventory? Is this depreciable? Is it another short-term asset? Is this another asset I plan to hold and sell? And in my mind, I had kept saying aloud again and again and again that this is development property to me. And it felt like I had gotten this ground, subdivided it, done all these things that made me, in my head, really think it was inventory. And Pete, kind of challenged me to think about it differently and say,
I just thought about it differently.
Yeah.
You looked at me, I said, well, this is 1231.
Yep.
And you looked at me as if horns had grown out of my head that this was an impossibility.
Yep.
Because I did the calc and gave it capital gain treatment with the presumption that there was no 1231
recapture,
unrecaptured 1231. And then you came back and asked the question.
Yep.
So what drove your analysis to say cat or ordinary, and what drove my analysis to say 1231?
So I think of the reason I thought it was ordinary is I normally in my head, when I'm in the real estate developer role, I think of things that I subdivide, improve with the intention to sell as it's pretty blatantly inventory. And so especially like when we have these folks that are buying raw dirt, subdividing it, improving it, dragging utilities, maybe like negotiating entitlements with the city, it starts to feel a lot like inventory and I'm selling lots. Which is what just so happened to happen here at the end, but it was not the intention that we went into this project with. And
Well, but it was subdivided. I mean, that didn't happen at the end, right?
no, it happened at the beginning.
Yeah.
Yeah,
The subdivision occurred in the beginning.
yeah,
So everything's still kind of matching your facts
correct.
to lead you to a conclusion of ordinary.
Yep, exactly. And I think the thing that I would tell the folks here is one, this calc took me a fair amount of time to get my head around. It took a fair amount of time, and I don't even know if I would have been able to get through this part and rolling it through the capital accounts if not having talked to Pete first. And not to say you have to talk to Pete, you can talk to Pfeiffer or Campy or someone else, but on these big calcs,
My
having
preference is Pfeiffer or Campy,
Yeah.
just so you know.
I just go to Pete normally, but I would encourage people to realize, and I mean Hoffman and I pick each other's brains on stuff all the time, or Burton or whoever, but trying to even start a project like this without at least talking to somebody and saying, hey, this is how I'm thinking about it. Tell me I'm crazy, or help me think through what I might be missing, I think is a waste of time, because I wouldn't have been able to get through this without Pete first pointing me in the right direction. Just like, hey, here's how this works with your waterfall and 704C, which was really confusing me. Ian, I don't even think that this is necessarily completely correct. I think this is one way to do it, but I think you could allocate the income in a different way and do it before 704C for the preferences if you wanted to. The other thing
I don't know that I agree with that, but go ahead.
Yeah, and I think the other piece that that helped was if I hadn't talked to Pete about this, I would have gotten way down the road of inventory, which would be a really bad tax answer, and kind of shame on me for not at least thinking 1231.
Because typically you're going into your investor versus dealer rules.
Yep.
And typically, when you have a real estate developer, once it's plotted, you're usually, you go directly to a dealer unless there's an exception. And a lot of times, developers will take a project and pick out parcels that they're going to keep and build on themselves, and then those can be held as investments for capital gain treatment. But where the IRS typically, I've read a couple cases that you should typically earmark those out into their own LLCs just to separate them from your normal dealer activity.
And I will say the set of facts here that was really interesting that I think Pete helped me on is when we did this agreement, it was our intention that us, our client Lockwood and Frank's team, we were going to develop all this ground ourselves, and we were going to own. There's an office building that was supposed to go on this. There was a mall. There was a bunch of apartments and some old folks' home. Like there was, a hotel. And our plan was that we were going to contribute all of this property to joint ventures with a hotel developer. For the office building, we were just going to do it ourselves because we know how to do that. For the old folks' home, we were maybe going to sell a lot, but we were also maybe going to contribute it and joint venture it. And I think to my point would be that I had kind of already come to what I thought the right conclusion was without trying to think big picture of how did we get here. And Pete was the one that kind of said, hey, I mean, tell me I'm wrong here, but weren't you guys going to own all this stuff? You guys have been talking about this project with me forever. You're going to have this big office building that was going to go down there that you're going to own. You're going to do this, you're going to do that. And then one guy died and everything changed. And that was
kind of goes back to facts and circumstances.
correct.
And which a lot of things when you're dealing with tax scenarios boils down to facts and circumstances, not characteristics, especially real estate.
And so to me, that's where I got more comfortable with Pete's position, or our position. But Pete challenged me to this position. I'll say
He's going to send me. Yes, he's going to put me before
I'm
the
going to go
IRS.
get this.
when this
I'm
gets
going to
audited.
get when we get audited, I'll download this video and be like, yeah, see, I said way before it was Pete's position, not mine.
Yeah.
Yeah, it's really JT's position because he's signing return. Yeah, please record this. But that's where I got very comfortable with Pete's position, and you know, again, kind of having to educate our client who honestly functions in both capacities. He very normally is the developer that is putting up his own buildings and he holds stuff for rental purposes, but he's done a little bit of ground development recently, and I in my head was like, oh, this is exactly like our big land development out at 204th and F Street. And so I just kind of started spinning myself there and not thinking big picture of how did we get to this project and why are we here. So all that to say, to me, the check ultimately, and actually, like I was asking John as I was doing this calc, the check ultimately on this stuff is if I liquidate it, what happens, and if it gets to zero, you can feel pretty correct that you've solved your 704C issue.
When you say get to zero, what the more precise statement is you start with your beginning capital account, you do your additions and subtractions for your income and losses,
Yep.
and then you compare that ending capital account to the cash that's available for distribution, and that cash available for distribution coming out to the partners should zero out those capital accounts to bring it to zero.
When we liquidate. That's exactly right.
That's what he's saying.
And we can kind of like, I don't want to make this too small, but you can see on this project, so we started with this in 2019, and it existed before that. You can see, like, since the beginning, I've been tracking 704C capital accounts, 704B capital accounts, and then this is not as applicable, but I've been also just tracking cash. Because to me, like, I know that I will probably be the person very likely when a close happens that they say, where are we at in our 25 and 2 before we start going 50-50. You know, obviously no one's taking any cash out of this deal yet. But so when I go here and I say, okay, and actually we can just kind of hide this because the names are the same. That might make it a little easier. Okay, so I kind of have been running through this, and obviously, you know, now my tax returns on a tax basis. So this would tie to my M2 each year. This would tie to my balance sheet because my Schedule L is on a book basis. And I've been kind of running it through the end of 2023 here, where I start here and I say, okay, coming into this year, I had 10,087,000 of 704C basis or inside tax capital, and I had 27,056,000 of true book-based equity in this project on my balance sheet. I asked the CFO of Lockwood to give me a financials through 9/30, sorry. So there was 36 grand of income that I just split between these guys 50-50. That may or may not be right, but it's also kind of wholly immaterial to all this. And then what I did was I went and said, okay, what's going to happen here for my gain on each of these closings? Okay, so like for Chip, you'll see I have this 8.1 million, which is coming from here. For Frank, you'll see he's got a 704C gain of 5.6 and a normal gain of 8.1. So his total should be that 13.7.
So to in the terminology we use today, 5 million is the required allocation,
Yep.
and the 8 million is the agreed upon allocation.
Yep. Yep. So this is what's required to solve our quote unquote, you know, our pregnant game that we have out there. And this is what we agreed to in our partnership agreement. And it's not, obviously, we're 50-50, so it makes sense that these two would be equal with each other. Okay, so you'll see on 704C, I'm shoving Frank more income, okay? Versus in our 704B, where we're 50-50, our contributions are the same. Or our gain allocations, excuse me, are the same.
And that's because that's the appreciation that occurred post us agreeing to be in the partnership together.
Correct.
And Sam, does a required allocation hit a 704B?
No.
No. Does an agreed upon hit 704B?
Yes.
Yes. Does agreed upon hit 704C?
Yes.
Yes. So then that's what you're seeing here. Agreed upon is hitting both 704B and 704C, because he's saying the 8,121,000 is the appreciation that's occurred post the partnership being formed. And our agreed upon allocation is 50-50. So Joe's taking that 8.1 and hitting his agreed upon or fair market value for the 8.1 each, because that's the appreciation that occurred post the partnership coming together. That's the income that's available to split for 704B purposes. But then on 704C, we have agreed upon and required that's going to go in there to equalize the capital accounts as we go.
And I honestly, I probably would be better off if I, to really hammer that home to these guys, because I will walk through this with them
Yeah.
when I do this. Like, I'd probably be better off like having closing one have two rows to it and saying, hey,
Required
here's-
and agreed.
yeah, exactly. Yeah, here's the gain. Here's the pregnant gain releasing. Because required and agreed, they might get confused. But here's the
Or inherent gain being released. That's much better for a chip. Yes,
Yeah.
100%.
Exactly. And so then I go and I say, okay, what do I think is going to happen with the cash? Which again, I calced back here, like you'll see. Can I do that? Yeah. So you'll see here, I have 145,000 in cash in the first closing, 6.5, 17.2. And then I have this for Frank. And then I say, okay, what's my net at the end, which basis probably isn't the right net basis, might not be the right word, but I started here and I said, hey, I had 2 million of tax capital after picking up all these gains. I'm at 23. I'm going to back off 23 of cash. I'm at $1. For Frank, I had that. I'm backing off this much cash. I have like a $500 miss in here that I have a fat finger in the spreadsheet I haven't found yet.
Okay. Which, who cares?
Exactly. Yep. Not material. And then you'll see here for 704B, it's interesting. It's clearly something in my gain calc or in my tax basis, because 704B, I get to exactly 0. And it's clearly the same calc. Everyone's got the same income coming in. I'm solving that by the fact that he's getting a lot more cash, namely 17 million, I think, right? Should be approximately that number.
Yep.
And that's where we're kind of shaking out. So I guess the things that I would want this group to be thinking about as they're getting these is, one, when you have something screwed up or something that's confusing, like I think some of this stuff is very easy for some people, and a lot of it's just probably because of the reps that they've done. Like I think for you guys, pulling together something like this might be more difficult than it is for me, and it's infinitely easier for Pete than it is for me. And I don't start something like this without asking for help with other people. And so don't try and do something like this on your own, and don't even try and start it on your own. Like ask someone for some direction before you really dig in, because I think it'll make the final work product better, and it'll keep you from getting way off the rails before you even start. And the other piece I would tell you is on these bigger projects, challenging people's, having people challenge your assumptions like Pete did for me on this 1231, or I know I've talked to Hoffman a little bit about this project because there's a bunch of TIF dollars at play and other stuff going on too. Just to say, hey, I want to pick your brain on this. This is generally what's going on, and here's my fact pattern. You don't have to put numbers to it, just so someone else can say, well, you're thinking about this wrong. I think is really, really helpful and gets the right answer for our clients.
I think
It doesn't make you a bad practitioner to not know the answer, or to even if you think you know the answer. Anytime you get a scenario with some sort of complication to it, not even this complicated, but you walk through it how you think, if you feel confident, but then I challenge you to go talk to people about it, like Donovan, myself, Pfeiffer, and if Pete's not busy, Pete.
I'm never busy.
I think that to Joe's comment though, I think the people that are the best at doing this stuff are the ones that are disciplined to step through every single piece of the transaction and break every, what you think might be one transaction might be 5 too. So
How long did it take you to learn that?
a long time.
Seriously.
Yeah, because your first assumption is to think of the very important pieces and kind of jump to a conclusion. and you'll miss a lot of the stuff in between there that can change the outcome substantially. So the best way to get good at this is remembering the steps that Pete's teaching you here. If here's, first step one, what's the basis, what's the value, what's the inherent gain, then what type of asset is it, and the transactions that occur on those assets. I mean, going through every single piece of that is how you get to the right answer. And if you skip just one of them, things can get very off the rails.
And I don't think this is a relatively simple one from the standpoint of we are just talking about one. We're talking about a piece of ground that's going to get sold over 3 different closings.
But
But
the complicating factor is that you have a waterfall.
Then I have a waterfall. Yep, which that was what was really. If I didn't have a waterfall, I would have probably been able to do this without a ton of assistance. But what JP just said, I think is so.
Hold on. So let's stop there. Brett, what the hell's a waterfall?
Is that the 25 and 2?
That is, but
Yeah.
if you're going to describe that to Kelsey, absent this being an example, what is a waterfall?
I would say a waterfall would be unequal cash received by the partners that is not equal to their ownership percentage based on other agreements.
That's a pretty good definition. Okay, so a waterfall is an agreed upon income or loss allocation that disproportionately allocates income in cash in a manner that rewards people, but generally at the end results in some sort of proportional allocation. So there's a disproportional interaction in how income and dollars are allocated in the first steps, with a result generally going to be pro rata at the end. And when you say 25 and 2, we have a disproportionate piece of this partnership agreement, which 25 and 2 is not proportional, but reverts to 50-50. I mean, waterfalls are more and more common. And what I wrestle with is, in this case, what Joe's saying is the first closing, go to your first closing, Joe. There's $21 million of tax gain, correct?
Yep.
Okay. And there's $17 million of inherent gain embedded in all the ground that was contributed. And I've been wrestling with this for a long time. And the more I wrestle with it, I think my conclusion is that, so go to the side, Joe, and let's do a closing. Let's label closing 1704C under E46. You should have been up. Go up one. Yep, right there. So let's do a 704B closing over the next to it. So there's a 704B closing that you got to take those same proceeds. Okay. But now the ground at data contribution had $25 million of fair value, did it not? So 25 million of fair value. So go to that next to it, Joe.
Yep.
So no, go over the side and label this basis at formation. And then let's say 25 million divided by 3. Okay. That piece of ground had $8 million of basis at formation, fair value. And then the debt was how much, Joe?
I can't remember. 37 million.
Okay, so let's take that 37 million divided by 3. Add those two together. It should come out to my 22 million. What's come out to?
21.
Okay, so it wasn't quite precise in terms of his debt.
Yeah, but there's also some AR and some other stuff factored in here.
Okay.
Because this is that back of the envelope is exactly what I did when I was initially trying to do this on like a piece of paper.
Okay, so we have the 704C closing, which is the 8 million divided by 3, the 8 million of basis that he had when was contributed.
Oh, you know why it's also fucked up, Pete? Because I'm not doing basis pro rata here. I'm not.
Oh,
doing-
yeah, it's okay. Okay, so the 8 million divided by 3 plus the debt that's been incurred, that's your 704C calc. But going back to what I said earlier, that you have to do a gain loss calc for both for 704B and 704C. And because only required is going to hit which count?
See,
C. But agreed upon is going to hit both.
both.
Okay, so it's the appreciation that occurs post the formation of the partnership. And if we take the basis, the 25 million divided by 3 plus whatever we've capitalized in that ground should be the basis for 704B calc. And that basis for 704B calc gives us our agreed upon allocation that goes to both people. And the difference between that calc and our 704C calc is going to give us the required allocation that's going to go to a specific partner. So what Joe's done here
And I can
is,
kind of do that by inserting a column up here because I do have a 704B balance sheet, and I can see kind of what this would be on a lot by lot basis.
yeah. So
And even if I just like that's a lot closer here, which kind of makes sense.
well, and it's the disproportionately higher
Basis that I'm
proceeds.
taking this first one.
Well, yeah, and proceeds.
Yep.
So I mean, it's not a third, and a third.
Yep.
So the agreed upon allocation is going to really be driven off of that gain loss calc that's coming on the 704B side.
And the other thing that I keep thinking about with this that has really been causing me a lot of angst is this whole disconnect between
Oh, so yeah, I was sorry. So we have this first closing that is generating $21 million for taxable income. There's $17 million of inherent gain. And if the next two lots sell for 0, shouldn't we push all 17 million of that gain to Frank? Doesn't that feel like that's what we should do? And that's what I've been wrestling with. What is the amount of gain, that 17 million, that I should push to Frank by virtue of this waterfall, this 27 million being allocated, 25 to Frank and 2 to Chip? And my conclusion as I've wrestled with this is I got to respect that 704B gain loss calculation, because I got 3 lots, and the fact that I'm selling one of them, I got an inherent gain based in that lot. And going back to Sam and I's agreement, a required allocation only goes to C. An agreed upon allocation goes to both. The only way I'm going to get to that agreed upon allocation is by doing that gain loss calc with respect to that specific lot, and then dividing it based on agreed upon allocation. And if all of them sold, that works. And the fact that, this is an anxiety causing moment where we have $21 million of gain and the other could just be break even, or they could be a loss. We don't know. We do in this case by
we
virtue.
feel confident.
Yeah, we feel confident in this case. But
I will say it's a really bad answer because, I guarantee you I'm going to get asked that question tomorrow, in that they're going to say, wait, so I'm getting 8 million of gain. He's getting 13 million of the gain, but the cash, I'm getting 145,000. He's getting $1.8 million. And if you take the percentage of the gain,
that's by virtue of them being dumb enough to pay their debt, all the debt.
I know, but still, the percentage of cash I'm getting is a lot lower than the percentage of gain I'm getting overall.
Yes.
And I think that's going to be their question to me. I 100% agree. I've been saying all along we should not pay off all the debt. We should leave 20% of it back and use it to pay taxes. But that's not what they want to do.
What's the bank say?
Yeah, the bank is very happy to get their debt paid off.
They are.
And actually, when we first talked about this, that was exactly my point, Aaron, was if we want to keep this cash to pay taxes, we got to say it out loud to the bank, and we got to say it now.
Yep. And I think for us, it comes down to there's a lot of complexities here with personal guarantees. One of which is, the guy's dead, and his guarantee's not worth a lot anymore. You know,
How's
obviously,
that work? I wonder. You have to transfer to the
I think
state.
it's transferred to the trust, to the now irrevocable trust, but the corporate trustee has no interest in being encumbered by this asset. So there's a lot of other stuff at stake that's making, you know, me, the tax person, it's like, hey, by the way, you know, if we just say, even if this guy's not a taxpayer because of the 754 step up, you know, take 8 million times 25%, there's a $2 million tax bill here that we got to pay in April, and we only have 145,000 coming to us. You know, for most people that'd be a problem. We have means to fix it, but that's what's been giving me a bunch of heartache in this situation.
I think what we talked about a little bit when Pete stepped out of the room last time was if your scenario happened to be different and Krejci say, well, we could take on more of this gain because we have loss carry forwards and we don't worry about it. Why wouldn't we allocate, all the gain to them and cure our 704C at that point?
Well, I think you probably get into the argument of, does that allocation really have substantial economic effect?
Yeah.
Which I don't think we're talking about substantial economic effect at all in here. Okay, I don't think it's anywhere in the slides. But since the words have now been introduced, we should probably talk about what that means on some level. There is no concept of substantial economic effect in S corps. There is a concept of substantial economic effect in partnerships. And what substantial economic effect means in general is if the partnership makes an allocation of income, the cash sure as hell should follow.
Over a period of time.
The cash should follow. So what Aaron is saying, and substantial economic effect also means that you can't do an allocation of income to game the system. If Joe has a capital loss of $1 million and I have an NOL of $1 million, and the partnership that we're in happens to have $1 million of capital gain and happens to have $1 million of ordinary income, and we allocate $1 million of capital gain to Joe and $1 million of ordinary income to me, did we game the system? We sure as hell did. So substantial economic effect really means one of two things from your guys' perspective. The cash has to follow the income allocation, and you can't game rates by your allocation.
Well, I would add another layer of a law. When you get to a loss scenario, your loss allocation should follow either your ownership percentage or who's bearing the risk of that loss, right? If somebody comes in, they don't put anything into a partnership, it loses, you can make a special allocation to somebody that brought all the assets to the table, right? Because if this thing blows up today and goes away, somebody brought all the assets to the table, they really lost, where the other guy didn't lose anything. So, on a loss perspective, it's whose risk of loss.
Either by assets or by guaranteeing debt.
Correct.
That complicates the hell out of what you just said.
It really does.
Substantially.
Goes back to earlier when you said everybody's getting back to zero. Like, that's the substantial economic effect. Everybody put something in, got allocated enough to get back to zero at the end of the day when it liquidates.
With cash distribution.
Yes.
Cash attached to what your income allocation is.
Yes.
Which, like, again, though, if you think about it, right, like, because of my waterfall, we're taking on a lot of this gain at the beginning, and then we don't really get fixed until 3 years from now when the cash comes out 50-50. And I think this very well might be 27 or 28 by the time it all happens. So it's not like it has to get cured day one. In our situation, it certainly is not. But I would argue that this clearly has substantial economic effect based on.
If we shoved all 17 million of gain to,
I'd be gaming the system.
I don't know that they would respect that allocation.
Yeah.
Because I have 3 lots with its own. Those 3 lots have its own 704B basis associated with it, and when we sell that lot, that 704B basis should be compared to that fair market value proceeds, which is going to give us an amount that is allocated based on our agreed upon economics. And that's why I go back to, you can't allocate the 17 million to Frank.
Yep.
Now, that being said, I know I like to be a little aggressive, and I don't think I necessarily have to do it a third, a third, a third, or pro rata based on proceeds. You know, like I think if I want to be a little creative here, I'm going to go look at what lots are actually being sold, where we move the dirt to, did one have more utilities, stuff like that, to try and maybe get to a better answer for our client that I feel comfortable, signing a return on.
Okay, so let me restate that just slightly differently. Okay, we have a piece of ground, and the piece of ground has an absolute swamp. It has a piece that has 1 trillion trees on it, and a piece that is pristine and nothing needs to happen. Well, you can just build on it today. Now, are you going to pay more for the pristine one than the swamp? You're going to. Okay, so that $8 million, we could say that one piece was pristine, and more of that $8 million is going to that pristine piece in the acquisition cost, because it all comes down to what was fair value associated with that. The second piece that Joe's talking about is, well, we have $37 million of costs in the ground, and we're going to sell that pristine piece first, and we used 80% to run utilities and everything into that most pristine cost. The next piece to start clearing trees, and a little bit to start pumping out the swamp. Okay, and that's what he's saying. Well, you got two levers that you can pull with respect to this basis for fair value. And so, and do we do that?
No, I let the client do it.
He lets the client do it. I have a feeling there might be some guidance.
Oh, help.
Help. That's what we're here for.
Usually on the phone. All right, any questions? And Pete, you think I'm directionally going the right way for tomorrow?
I do.
That's helpful. I was not feeling great this weekend when I was working through this, so.
No, I think that you should be able to have a nice, productive meeting with Chip.
Yeah.
Tomorrow.
All right.
Nice productive meeting in which he's gonna love the answer.
He's gonna hate the answer. Okay, so there's one thing, and I think the best part of this meeting was something that JP said, because again, how long you been around, JP? 8 years, something?
Like 11.
Okay, 11. Time flies when you're having fun.
Yeah.
I mean, the JP of in year 2, year 4, year 5, I don't think understood or appreciated. You have to break something apart and put it back together. And I say it all the time. I have to break something apart into 1 million pieces, and I put it back together. And when it doesn't work, I break it apart again, and I put it back together. And then I break it apart again, and I put it back together. So that call that we had today, how many times did I have to break that apart and put it back together? How many hours do you think I had in that? I mean, 70 to 100. Because when I was talking about, wait a minute, there's the standard, the client gave me a universe of assets that were 100%. I had 2 partnership interests that I bought part of it, and I had to roll part of it. And there's one partnership I bought 100%, and I have 6 different things all coming in from 6 different directions. And first I had to, Sam, diagnose and understand that the client was giving me a full universe of all the assets in a consolidated schedule. Well, that's a problem, because I need to isolate solely on what they're contributing by themselves. So I had to break it apart. And then I had to understand, well, wait a minute. There's a part of these partnerships that are being purchased and part of it that's being rolled. And then I had to break that apart and then put it back together. I mean, this ability to look at something and understand that you can break it down into these small individual pieces and understand that what the pieces are, how to break it apart, and what they mean, and get it to the smallest piece that you can tolerate, and then put it back together, minimizes and eliminates errors. When Joe put something. No, I'm not going to pick on you because I don't think this is as true as I want it to be. Bill Kennedy and Adam Austin. Adam Austin can put something together, and I look at it like, wait a minute, you shortcut the shit out of that. And generally, Adam Austin's hit rate's pretty good at getting to the answer. But I look at it and I say, I have no idea if that's right because you skip my pieces. I look at that, I cannot identify if you really thought through that correctly. So what we do is I have
probably luck, Pete.
what? Luck.
Probably luck.
Oh fuck, you're on. I'm gonna use Bill Kennedy.
He is paying attention.
I'm gonna use
Wanted to make sure you knew I was here before you go any further.
that fucking asshole Adam Austin.
I guess he does get credit today.
I will say though, I think that's Pete's point though. I think a piece of it too is that he's very patient and doesn't mind. Like I get stressed when I do it the shortcut, and if that thing didn't zero, I would have been way too quick to be like, I surrender. You know, I need someone to help me. And Pete will just keep methodically breaking it down into smaller pieces, making those small pieces get to zero individually before he smashes it back together. And I feel like that's the piece to understand. And in this situation, like, you know, I've been with Pete at different times where we've had big transactions, and there I just had B, one asset, C, where Pete will have 20 rows wide or columns wide of, well, this is me adjusting this asset to tax basis because I know exactly what this is. This is me recording transactions costs. This is me booking SARs. This is me doing this. This is me doing that. So that we can like make sure that each separate piece is working and hitting the balance sheet and the P&L, hitting our tax basis schedule. To Pete's point, it makes it so you just don't you'll figure out when you have the error one place because it'll all be working and then it will stop working. You're like, oh, I must have a fat finger in column Q because this was all balancing and all going and my capital accounts are rolling and all these things were happening. And then I did that last entry and it didn't work. And it does take a ton of patience to do that and a lot of confidence in understanding the pieces, which I feel like to me that's what's always intimidating.
I think Joe might be referencing our KPMG experience.
Yeah, or the LRS one, Milan or LRS were both, and I got really sideways on.
This is one of my favorite stories. Is Joe and I we took a $20 million step up that didn't exist.
Yeah.
No shit. Swear to God, it was 10 or 20.
It was, I think it was a little more, yeah, it was maybe a little more 20.
And we look at it 2 years later and I go, Joe, we fucked this one up.
Badly, and got called on it.
Yeah, 100%. And KPMG was on the other side of it. And KPMG, if you're on the phone with me, if the other side is being cordial, Joe, am I cordial?
Yeah.
If they're not cordial,
Yeah, you can be combative.
I will go out of my way to take them out of their knees if I can. So we were on the call and we were falling on this $20 million sword. Like, yep, we're stupid. I mean, we are stupid. Could we say anything more than we're stupid?
No.
No, we were stupid. And we're on this call, and the whole time, KPMG has been cordial with us. We've agreed to disagree on, and this has to do with non-recourse debt and distributions. So if you guys go back to your basis hurdles, when I talked about distributions coming out of the partnership can be supported by non-recourse debt. You guys remember that? Okay, it comes back to that issue of non-recourse debt supports distributions.
But not losses.
But not losses. So they were taking a position that we didn't have basis for non-recourse. Doesn't matter more than that. Okay, and we were being very cordial. And I basically said to KPMG, look, I have control over the 1040s. Me and Joe have control over the 1040s. You have control over the entity stuff. We'll agree to disagree. Statute of limitations runs in a month.
Yeah.
So now we get on a call, and we're on the call, and yep, we're stupid. Joe and I are stupid. Okay? And so, but the KPMG kept picking at a 704 calculation that I did. And they kept picking at a 754 calculation that I did. And at one point during the call, you know, there was an allocation. What was the allocation that they were trying to make? They were doing
Well, I
something.
think it might have been on the 704C runoff, honestly.
So at some point, the client goes, "What, you guys blessed. KPMG blessed our work 5 years ago. They reviewed our work, and
Yeah, we
now
didn't
they're
file a tax return without them looking at it because I was nervous about the whole transaction.
and now you're coming over the top and you're throwing stones at the work that Lutz did, and you guys reviewed it." And the guy on the phone goes, "Well, that was Lutz or KPMG M&A." And the client just lost. As soon as I heard him say that, Joe and I were off the $20 million hook
Yeah.
because the client just lost his shit. What the fuck? KPMG is like one umbrella, and you're telling me that one hand doesn't know what the other hand is, and it was scorched earth. I don't know if you remember, I just hit mute at that point
Yeah.
on the phone on our side, and I'm like, we're good. We're off the hook.
Yeah.
And I'm actually laughing at this point.
It was funny.
But Joe actually felt bad for this guy on the phone. He got red and he was sweating. And the poor guy, he was just getting blasted.
Yeah.
So since KPMG was cordial, and they seriously 100%, they wanted to work with us. They weren't assholes. I finally went off mute and I said, it was Shakar, right?
Yeah, Shakar, yeah.
I said, look, Shakar, you've extracted your pound of flesh. What you're doing is not productive. KPMG is solving Joe and my fuck up by the way they're doing it. They're not going to go back and highlight in an amended return how stupid he and I are, because they could have.
Yeah, that's what we were talking about. That's what we're negotiating.
And they could have amended the return to highlight how stupid we were. And they were doing it via an accounting method change in the current year to do under allowed and allowable to recapture what we did and take it over a 4-year period. Yeah, over a 4-year period to fix the problem. And based on them being cordial and them taking us off the hook, I said, this is not productive. They KPMG have been your complete advocate through this whole process. They're trying to do the right thing, and the fact the guy said something stupid, you should just let it go. And Abe goes, or Shakar goes, okay, and everything worked. But that was,
What if that would have been Kim Suka?
I would have fucking taken her out of the knees.
And I will say on that deal, because they're still like a pretty big customer of mine, and I'm very close with these two founders. And even that $20 million, I was very nervous about, because it was a really big mistake.
It was stupid.
Even in the scheme of a $270 million transaction, was still materially not good. But because I'm so close with these guys and I've helped them through a lot of things, and they know that they put me in a bad position sometimes with rushing me, and I always disclaim everything and say, well, this is what we're doing, but you're not really giving us what we need, or hey, I really want KPMG to bless us. Nah, don't need to do that. Like, I feel like they would have let us off the hook, because also I wasn't going to try and talk my way out of it. I was just going to be like, look, yeah, you can see where we were working at midnight in June trying to figure this out because the closing was happening, and we have an error here. And it was literally, I think it was that plainly stated.
And actually, when they did the initial the financing with warrants,
yeah, which we got out of that too, because I told them, I'm like, you're not even giving me time to look at this. I'm just going to follow whatever you tell me.
we had a call with them and we said, we don't know what we're doing. There's how many answers are there, Kelsey?
A lot. 3.
2.
2.
The answer, and I don't know.
Yep.
We were on the phone and we said, we have no idea what we're sitting on here. We're not warrants people. We don't know what we're sitting on. We don't know how all this works. And they said, the other people gave us guidance. All right, fine. We're going to accept you got guidance from somebody that knows something more than us. Well, that guidance wasn't very good. And
I don't even think they got guidance. I think they just told us what they wanted to have happen. We said,
that's
sure.
my story. That's my story, and I'm sticking to it.
Yeah.
But
And actually, it's 22 million now because I remember exactly what happened. That was what happened was we had penny warrants that they said just ignore these, and basically they went and got a 22 million
they were a
loan.
partner. Okay.
Yeah, and because the warrants were so in the money, these guys were a partner in the partnership that Pete and I didn't even realize they should have been a partner. And because they had lent the $22 million to the partnership, clearly they had at-risk basis, and we'd given Abe and Shakar non-recourse debt basis for that $22 million and distributed out all the cash.
Yeah.
And so we had a $22 million.
Yeah, I'm gonna have
cash
nightmares
basis.
again tonight.
Yeah.
So, but to their credit, when we said, you said that you knew what was going on, and we said we didn't, they go, "Yep, that's what we said."
And I will say it was kind of funny because when this originally came out in due diligence, I was on the phone without Pete, and it was probably like 10 p.m. in June with some attorney in New York talking through this. And she's like, "Hey, in due diligence, it looks like you guys missed adding this whatever venture debt bank as a partner." And I'm like, "Yeah, I guess that's right. You know, didn't think of that. Like I was told that they weren't a partner." And she goes, "Well, so we need to do that." And I'm like, "Well, I think that's going to create a problem for me." And she's like, "Well, what do you mean?" I'm like, "Well, we distribute all the cash." And this lady's like, "Oh shit, that's going to be a big problem." And Abe and Shakar, the two guys that owned this business at that time, were on the phone too. And afterwards, I called them like, they're like, "Well, what does that mean?" I'm like, "Well, it means each of you have an $11 million capital gain report." And I was like, "We can decide if we want to amend or not amend." We chose not to, and then we just picked it up at the end. But it was very stressful.
Yeah, it was all fun. All right, looks like it's time. I don't know. I got 5 minutes more worth of blathering in me. So it's time for you guys to go drink beer and do whatever it is that you're going to do.
I'll add one last comment just to bring it all full circle and kind of in support of the things that Pete beats into our heads over and over and over is
Kindly.
depends. Is the temptation as a lot of this stuff comes up, like with Joe's project here, of a phone call of, "Hey, we're selling this property. I'm not getting much cash. We're going to pay down debt," end call, right? And the temptations to go along with that and oversimplify it and shortcut to the answer. And if you don't break it down, like Pete says, in all these different pieces, you're going to miss the fact that he's got $8 million of income, no cash, and has to pay tax. Not to mention, is that a big problem that needs to be discussed? We also potentially forego a bunch of work that Joe just did. That's very valuable work that we bill our clients for too.
That's the most valuable thing that was said all day right there.
So
It'll make us money.
There's a lot to be said about, asking questions, giving, maybe even giving in them an assumption, but with a qualifier of, here's what I think, let me dig into it and I'll come back to you. So that's not only a warning of, I don't know if this is correct, but also a warning of, hey, you're also going to get a bill for this. Both things are good.
Comical because I met with them 3 weeks ago and did that calc on one sheet of paper, and I told them I thought the game was $7.5 million, which ended up being very close to correct. And past me would have probably left it at that and said, "Yeah, scan that, put it on the G drive. I'm sure that's probably pretty close." And I've been burned enough times where I've had a really critical mistake and have then had to go try and fix something with P at the end, or had to call someone in March and say, "Hey, I thought this, but I didn't understand this, and this was happening." And so now I am like, I'm still pretty confident in what I know, but I'm like always very willing to give people the answer in the meeting and say, "Hey, by the way, this could be way, 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 way wrong." And the client over this last 2 weeks has taken me to do this because I've had some other stuff going on. He's been like, "Well, yeah, so it's $7.5 million, so this." I'm like, "No. We think it's $7.5 million. It could be, that is a assumption that's yet to be confirmed." And he keeps saying it, "Oh, we're doing this, $7.5 million, we're in an opportunity zone." We think, we don't know. And then he's getting annoyed with me, and to the point where I'm like, "Look, just stop saying $7.5 million. Like, that was referenced. I did that calc in 3 minutes sitting with you at breakfast. Like, that's not you can't take that as gospel."
And the client's a lot more willing to pay a tax planning bill from us as they're going through the transaction than in April, right after we filed their tax return and sprung a surprise on them that cost them millions of dollars too.
Adam Austin.
Yes, sir.
Do you want to talk about the steaming pile of shit left in the corner?
No. Yeah, I can. I mean, what? That was
This is dead on JP's point.
I inherited a client from Dana that I don't remember the timing of all this, but I'm kind of trying to remember here. Did Dana leave in maybe August, and we sat down and here's half a dozen or so clients that you're gonna inherit from me. Here's what you need to know. These people, it was a vet practice. They sold to one of these vet aggregating groups, roll up private equity thing, and I've done all the gain calculations on it. It's all out there. You know, here's my spreadsheet.
And this is what
PTO
Dana says.
told- This is what Dana had told me. And so it gets to be, you know, this time of year, I think it was probably early December or so, I contact these people and say, all right, year-end planning, let's get going on this stuff. And I can't remember. Oh, it was, there were some, you know, I'm reviewing some of these calculations that Dana had done, and there were a few pieces of it that I was kind of unsure about, and so I ended up just calling Dana to see if she would walk me through parts of it, and it ended up that because of the way the deal was structured to allow that, they did the old free liquor special where they sell for a note, distribute the note out to the shareholders, and then the shareholders are the ones that actually collect the cash on that note. The entity was supposed to have been liquidated as of like March or something like that. Isn't that right, Pete?
Something, yeah.
Essentially, at the time that we realized what was going on here, we already had tax returns that were 6 or 7 months late, and it was a huge mess.
And the work was not substantially done.
And the work was not done. Yeah, it was sounds like maybe Joe, whatever situation you were talking about there, where it was back of the napkin, done on a one sheet Excel spreadsheet, that it was not scientific whatsoever. So we ended up having a meeting with these people to say, you know, there was a little bit of a dropping of the ball and the changing of the guard here, and we've got a problem on our hands, and you can expect to receive notices for late filed returns and so on and so forth. But we think it's more important to respect the timing of the transaction to make sure that you still qualify for the Nebraska cap gain exclusion rather than losing that benefit to save on a couple $1,000s of late filing penalties, which we think can be forgiven anyway. And they were more or less fine with that. I'm sure they were irritated from the outset, but I don't remember where things went from there.
Well,
necessarily, but-
it was the bill at the end.
Yeah, it was the bill at the end was definitely what set them off. I mean, we kind of came to this realization in December, January, and pretty soon it's busy season and the thing's already late. And I think we ended up filing it. We ended up getting the business returns actually filed shortly after busy season in like May. I think it might have been May or early June. And then we do their personal return and so on and so forth. But then to JP's point, we ended up sending them a bill for, I don't even know how much it was.
30-40 grand.
$30,000-$40,000. I mean, in the scheme of things, not a humongous bill, but just enough that it pretty severely pissed them off to say
They
"Look,
didn't
this was your
take it
guys' mistake."
gracefully.
No, they didn't care for that, and they're a Lutz Financial client, and you know we stood to lose. They walked away with quite a bit of cash after this thing, and we stood to lose a accounting firm client that from here on is going to be a pretty small CPA client, but a pretty big number in Lutz Financial's world, and they were pretty pissed off that Lutz made a mistake. To this day, I don't feel like we were sort of on the receiving end of the mistake, but Lutz made the mistake and then sent them a bill for $40,000 a couple months later for having to clean up the mistake that we had made, which was work that needed to be done anyway. They were just under the perception that the work had already been performed, and the whole thing was just a shit show. And yeah, is that enough detail for you, Pete, or do I have to keep
That's
reliving
plenty.
this publicly?
And here's what I would tell you, and Adam, you can confirm, deny, and trash me as much as you want. But when you came to the firm, your ability to execute on a transaction, walk through the individual pieces was not very good. And you've gone through 6, 7, 8, 9, 10, 12 transactions, and your ability to execute on that, to break it down to the individual pieces and pull it apart and put it back together is infinitely better. Is that correct?
Yeah, 100% agree. I mean, my experience at the place I came from, I was not doing this kind of stuff. I just did not have experience in this arena. And so the very first time I remember walking through this with you, Pete, and a couple others, he who shall not be named, it was like, what the hell are we doing here? You know, you understand the general concepts of it, but a lot of it was pretty Greek to you. Having gone through several iterations of it now, and you almost kind of want the opportunity to do it yourself. You know, ideally these things hit outside of busy season, and when you have the opportunity to take it all apart and put it back together in the June, July timeframe, you know, these are getting real world examples where you can identify the issues, attempt to diagnose them yourself, and work with Pete for confirmation on those things. It's honestly kind of fun projects to do these days. And, you know, each one you get a little bit better and better and sniffing out the issues.
Well, we had one where there were two entities part of a transaction. One sold everything and the other one didn't sell anything, but the one that didn't sell anything had some closing costs and some other things. And why in the hell does a non-seller have closing costs? And he and I went back and forth on that in the conference room. And to his credit, he had me stumped a couple times as to how we should manage this. And the fact that the logic trees that he was using were really good logic trees. And he had me stumped a couple times, but I think I won. I think what I said was
Okay.
So anyway, that's enough plug for Asshole Austin.
Thanks, sir.
All right.
Great. Thank you, Pete.
Yep, we're done for the day. Okay, this is a page. I don't. This is what we were talking about a little bit yesterday, and I think Joe came in and we moved off of it. But to me, this is something that a post-it note might be helpful to have on it, because you might use this at some point in the future. Sam, what's this page telling us? What's this about?
The process for 704B, 704C, figuring out the capital accounts and the inherent gains.
Okay, so what's step one?
Determine the properties contributed to the partnership.
Okay, so said differently, you want to make sure that you understand the partner, that which partner is contributing which piece of property, so you can do the analysis of who has the inherent gain at the partnership level and at the partner level. Okay, so what's step two?
Determine the fair market value of property being contributed. The fair market value is generally agreed upon by the partners who contributed to the partnership.
Okay, three.
Determine the tax basis of the property contributed to the partnership.
Four.
Construct a 704B, 704C, and inherent gain balance sheet.
Five.
Build a 704B, 704C capital account.
Six.
Track your 704B and 704C capital accounts for transactions that occur post-formation.
Okay, so which allocations hit your 704B account?
Agreed upon.
Agreed upon. Does everybody agree that agreed upon is the right answer? Brett, how do you feel about that? Feel good about that? Okay. What about the 704C account?
Agreed upon and required.
Agreed upon and required. We're going to hit the C account. Okay. 7.
If the 704B and 704C capital accounts do not equal at the date of formation, the required special allocation for tax should equalize them.
Okay, so if we're sitting in front of a client and we're trying to explain what this is, would a good explanation be that your tax basis at the beginning is not proportional to your ownership percentage, potentially. And the point of 704B and 704C is to have required allocations to make your 704C capital account and your 704B capital account equalize out. Is that fair? Is that basically what this is telling us that we should be doing? So, for whoever was on that call yesterday, do you think I used this methodology in the calculations I was doing yesterday? And do you think that Joe, when he was here, used this methodology. He did. Okay? Well, let's combine fact pattern number 1 and number 2. Sam, who you want to call in?
Brett.
Brett, what's this say?
Let's combine the fact patterns of number 1 and number 2. Pete and Jeff form PJ LLC, which will be taxed as a partnership. Pete contributes land A with the fair market value of $10,000 and a tax basis of $1,000 in exchange for 50% of PJ LLC. Jeff contributes land B with fair market value $10,000 and tax basis of $10,000 in exchange for 50% of PJ LLC.
Okay, so now we're just going to follow the steps, aren't we, Brett? What's the first one say?
What property was contributed to the partnership?
Okay, land
Land
A,
A.
land B, right?
Yep,
Okay, and then fair market value of each piece of land was what, Brett?
both 10,000.
How do you know it's 10,000 for Pete?
It says so.
Okay, but if somebody just gave you a data point and you were going to do, Sam, diagnosis of how you got from point A to point B, Pete's basis was 1,000. How could you infer that it was fair value 10,000?
Oh, well, there's no cash here to anchor it to.
Oh, there's not?
They're
Oh,
both
fine.
land.
I take it back. We have appraisals, but it would be cash. I'm sorry. I have to apologize for this being silly. Okay? What does 3 say?
What is tax basis of the contributed property? Land A's 1,000, B's 10,000.
Okay? Brett, who you want to call in?
Stu with me.
Brad, what's this page doing? Number 4.
It builds a 704 B and C tax basis inherent gain balance sheet.
Okay? So, land A has a basis of what, Brad?
1,000.
Pete's capital?
Pete's capital is 1,000.
Okay? Land B?
10,000.
Jeff's capital?
10,000.
In the fair market value column,
Everything's 10,000.
okay, and the inherent gain.
9,000 on Pete's ground.
Okay? And why is the inherent gain column important, Brad?
Because that's how we figure out where the 704C issues may arise.
Okay? And what kind of allocation is going to result in that inherent gain column?
It'll be a
Is it required or agreed?
required.
It's required. Okay? So the inherent gain column is the information that tells us what the required allocation possibly could be in the future. Brad, who you want to call on?
Call on Nate.
Well, I just feel like dominoes falling here. Nate, well, actually, I think you're going to nail this one because you were nailing it yesterday. But there's been a lot of
It's a
fog
different
of
date
war.
today.
Do what? This is different Nate today. Nate, there were 3 categories of assets. There were 704C assets. What were they?
They were short-term recognizable, depreciable assets and things that we will sell in the future.
Okay? And so if you were going to diagnose, Nate, what we're dealing with on this balance sheet, which category are we dealing with?
Things that we're gonna sell in the future.
Things that we're going to sell in the future. So only a point in the future does the required allocation kick in. Do you think it's good to know at the data formation whether we're dealing with a short-term recognizable asset, a depreciable asset, or something that's going to sell in the future? Do you
Yes.
think that's a good thing? That's a really good thing.
Yeah.
So knowing that those 3 categories exist and how you have to interact with those is a good thing. Okay? So what's note A say, Noodles?
A says, building the 704B and 704C capital illustrates which properties have inherent gain at the date of contribution.
Okay. B?
B, building the equity section of balance sheet at the date of contribution provides the required special allocation for tax to equalize 704B and 704C capital accounts. And the C says $9,000 is the required special allocation. Gain in excess of $9,000 is split based on the partnership agreement.
Okay. How's everybody feel about that? So, stupid question. If, and we're going to do this, I'm quite confident, but if land A sells for $20,000, is there a gain loss calculation that we have to do for 704B?
Yeah.
Yep. And what's that gain loss calculation? What's my proceeds?
$20,000.
What's my 704B basis?
704B basis is 10,000,
And my 704B gain?
would be $10,000.
And in my 704B account, do we have required allocations that go through there and agreed upon allocations?
Yeah, no,
No,
No.
we don't. Okay, it's
just agreed upon.
so 704B is always going to be agreed. So our agreed upon allocation between Pete and Jeff is 60-40,
No, 50/50.
50-50. So that $10,000 appreciation that occurred since the asset was contributed is split 50-50 between Pete and Jeff. So 5,000 goes to Pete and 5,000 goes to Jeff, right? And for 704C purposes, proceeds was how much?
20,000,
Basis was?
1,000.
So now, do we have required and agreed upon that's going to go through my 704C account?
Yes.
Yes.
So the first 9,000, because we have 19,000 in gains, the first 9,000 would go to you. And then after that, we have 11,000 left over, and that would go.
How much?
11,000. Oh my God, we have what? Yeah, we have 11,000.
Come on, Noodles, you can do it.
20,000,
Minus?
9,000,
No, 20,000.
minus 1,000, minus 9,000. We have 10,000 left over.
There you go.
5,000 apiece to each partner.
There you go. 10,000, which equals the same 10,000 that went through my 704B, correct?
Mm-hmm.
So it's only appreciation that occurs post formation of the partnership that's going to be in the agreed upon allocation. Okay? Noodles, who you want to call in?
Leslie.
Let's combine the fact patterns of 1 and 2. You need to construct the 704B and 704C capital accounts by partner. At date of contribution, 704B is 10,000, 10,000, 704C is 1,000, 10,000, inherent gain is 9,000, 0. Why do we construct these capital accounts? Answer, we use them to allocate income, loss, and distribution to track who is owed what economic benefit. This category is generally dictated by the terms of the partnership agreement, and we use them to execute the required special allocation to equalize the capital accounts.
Everybody on board with that? Okay. What we got here, Leslie?
The partnership agreement states income and losses are allocated 50-50 to Jeff and Pete. What happens if the land is rented for $30,000 annually? We need to construct the 704B and 704C capital accounts by partner. So looks like they're getting the 30,000 of rental income split 50-50 based on the agreed upon 50-50. And that does not go into the inherent gain.
So if you were going to articulate to me, the new staff person, why that is a 50-50 agreed upon allocation and not a required allocation, and how you diagnosed that was an agreed upon allocation, how would you articulate that?
I would say that the inherent gain pertains to gains, such as when the land is sold, whereas rent is ordinary income and it's not gain, so it doesn't. It's 50-50.
Oh, that's true. But would a possible addition to that explanation be the rent occurred post-formation, and it's something that both Pete and Jeff were partners in and should participate equally in, and has nothing to do with inherent gain that existed prior to the formation of the partnership? This is activity that Pete and Jeff engaged in as partners post-formation.
That's a good point, yes.
Okay? So everything that you said was absolutely true, Leslie. But the point that I'm driving to, which is in addition to what the good points that you made, is that the $30,000 is activity that occurred post Jeff and Pete engaging in the partnership. The same way when Nate and I did the analysis on the ground for $20,000 sale, there were two things that occurred in the 704C portion. The 9,000 that existed as inherent gain as of the date we formed, that had to be pushed to Pete because that was a 704C inherent gain that required an allocation to Pete. The appreciation of 10,000 from the 10,000 fair market value at data contribution to $20,000 proceeds at data sale, that is appreciation that occurred post. Pete and Jeff were in a partnership together, and we're partners in that partnership, and both enjoy that appreciation. Okay? So the point I'm driving at is income, any activity that is generated post partnership formation that's not in the required category follows into agreed upon. So the rent that we got is something we did together as partners. We both should enjoy the $30,000 rent proceeds. So that's why it hits both the 704B and 704C capital accounts. Leslie, who you want to call in?
Sue Burton.
Burden? I generally have a rule that we don't pick on the people that...
Well, I'm happy to participate.
All right, fire away, Burden.
Balance sheet after the rent was collected. Cash. We're doing 704C first. Cash is 30,000. Land A 1,000. Land B 10,000. Total 41,000. Equity. Pete is 16,000. Jeff is 25,000. Total 41,000.
Okay, so if we go back to the previous page, you have 704B, 25, and 25, correct, Ben? Yep. And if you look at the 704, I got 16 and 25.
Yep.
We have a tracking of the capital accounts outside of the balance sheet of the partnership, correct? But it should tie to the balance sheet when we adjust for the current year activity. Those two data points should be intimately tied to each other. They should correlate. Okay, what do we got here, Ben?
Combining the fact pattern of 1 and 2, we'll need to construct 704B and 704C capital accounts by partner. So
This is the starting point from the previous page.
Yep.
The capital accounts, the 704B and 704C, this is the starting point. Then it says, what happens if?
what happens if land is sold for 40,000?
Land, which land?
Land B.
Okay,
You have to calculate 704B gain or loss. And calculate 704C gain or loss. So if we go back to our balance sheet, land B is valued at 10,000 or basis at 10,000?
well, we have a 704B and C capital account. What's land B valued on the 704B and C capital account on that balance sheet? Okay, so land B is that the previous, page 18.
Yep.
Land B has a 704C basis of 10,000 and a 704B basis of 10,000.
So 704B calculating gain or loss, we have 40,000 of proceeds, 10,000 of basis. So our gain is $30,000.
Yep.
704C, our basis is 10,000, proceeds of 40,000. So our gain or loss is a $30,000 gain.
Okay, and if you look back at the balance sheet though, was there any inherent gain on the balance sheet at the date of formation associated with that piece of ground?
No.
There was not. So since there was no gain associated with that ground, does that infer that we should be thinking about a required allocation?
No.
No. And if you, now, when you did your math, proceeds for 704B was how much?
40,000.
Basis was?
10,000.
And that B tells us required or agreed, Sam?
Agreed.
Agreed. So agreed, Ben, is 50-50, right?
Yep.
So 50% of the 30, 15 goes to Pete and 15 goes to Jeff for my 704B account. And for my tax basis, or 704C, I have how much proceeds?
40,000.
Basis?
10,000.
Gain?
30,000.
So both It's all appreciation post getting the partnership. So this piece of land is now going to go, it's going to go through the process of only being a agreed upon allocation. So Pete's capital account is going to go up by how much? Oh, here's the gain. This is what Ben just did, right? Page 20. So now we've calculated the gain. Okay, and now we have the capital account from the previous year, fair value of 25 and 25. Everybody remember that number from the previous year? And then, or previous transaction, however you, and 16 and 15, or 25, the inherent gain still exists. We now have to split the gain for 704C, which, Ben, you said was 15 apiece, correct?
Correct.
And then for 704B, it's still 15, correct?
Correct.
Okay, so we still have this inherent gain that has not been addressed, correct?
Correct.
So now we have to adjust our balance sheet, and our cash had $30,000 of rent, $40,000 of proceeds from the sale of ground. We have Land A that still has 1,000 of basis, 10 of 704B basis. Pete's equity is 31 and 40, and Pete's is 704C's capital is 31 and 40 for B respectively, and Jeff is 40 for both. And that ties back to, again, this balance sheet ties back to 40, 40, 31, and 40, and we have the rent going through on special or required? Or agreed upon or required?
Agreed upon.
Agreed upon. The gain for land?
Agreed upon.
Okay. So we still have this pregnant inherent gain, and that still spits out in my balance sheet. Okay? Ben, who you want to call? Colin.
We'll go to Sam.
Sam, what's this say?
We need to construct a 704B and 704C capital accounts by partner. We just looked at that. What happens if land A is sold for 10 grand? You have to calculate the 704B gain or loss, and then you have to calculate 704C gain or loss, and then if there was an inherent gain at the date of contribution, then there's a required special allocation and an allocation based on the partnership agreement.
Okay, what's my 704B gain from this, Sam?
Nothing.
Nothing. Sam, or Alyssa, how you feel about nothing? Do you think it's right or wrong?
I think it's right.
You think it's right?
Yeah, because your basis was 10,000, right? In A?
What kind of basis?
Uh,
704B basis?
Yeah, 704B.
Okay, because the reason I say that is because it's easy to just say basis and
Yeah.
not
or
recognize there's two buckets of basis that you have to confront and deal with. It's 704B basis and 704C basis, and the point of 704B basis is how much appreciation occurred post-formation, and that gain or loss calc with that 704B basis tells us how much gain or appreciation occurred post-formation to tell us how much goes through our agreed upon allocation. Okay, so what Sam just did was, what was proceeds, Sam?
Same.
What was 704B basis?
Same.
And what's my gain or loss?
No.
So I have no agreed upon allocation because there was no appreciation in that property. So what's my 704C gain?
9.
9. And what do we do with that?
It's the required allocation on the 9,000 inherent gain that Pete had at formation.
Okay, so that's what this is doing, is it not? The next page. Oh, okay, is everybody on board with this page? Okay, so 704B capital accounts, was there any income to allocate to the 704B capital accounts, Sam? No. Was there any income to allocate to the 704C?
Only the required.
Only the required, and who did that go to? Pete. Now, was my goal met as a good tax professional to drive my 704B capital accounts, which on day one were 10 and 10, and they were equal from a 704B perspective. There was 10 for Pete and 10 for Jeff, right? And is that 50-50? But the beginning capital account for 704C is 1,000 and 10,000. Is that 50-50 in proportion?
No.
It is not. Does the required allocation when the sale of land A, which drives the required allocation, equalize accounts 704B of 40 and 40, is that 50-50?
Yes.
Is the ground, or the 704C 40-40 now 50-50?
Yes.
And now our special allocations, the required income special allocation has driven my tax capital accounts to equalize out to my 704 accounts, and that's the goal. There's a couple of goals. One is we want to make sure that Jeff is not harmed by that $9,000 of inherent gain that Pete brought to the table. The second is we want to equalize out the accounts to get to what our agreed upon economic deal is. So I think, Sam, what's 40 plus 40?
80.
80. Is that, so 704B is 80. How much is 704C?
80.
80. So now if we go to the balance sheet, how much cash do we have? 80. So the tracking of the capital accounts is measuring the economic deal that the partners have and what the liquidation rate is. And when you review a partnership agreement, which hopefully I can, Aaron and I can pull one up and talk about it, because there's some points I want to make about partnership agreements and some of the boilerplate language in there and some other things that I think is important. It's going to say that the 704 accounts, excuse me, it's going to say we want to liquidate, or it might say we're going to liquidate the partnership based on positive capital accounts. It might say that. Aaron, might it say something like that? Sure. Ben?
Yep.
It does. So if we're going to liquidate based on positive capital account, what is Pete's positive capital account?
40.
What's Ben or Jeff's?
40.
40. How much cash do I have on the balance sheet?
80.
So the amount of cash I'm in the balance sheet drives to the right person by virtue of executing properly on my required income allocation. Okay. So this is just a summary of what the hell happened. Everybody's on board with us, I presume. Okay, Sam, who you want to call in?
Kelsey.
Let's combine the fact patterns of 1 and 2. You need to construct the 704B and 704C capital accounts by partner.
Okay, so what this needs to actually say on 1 here is, what if land A, it just says land, and you can see above that land B has already been sold. So this inferred land A was being sold, but it doesn't hurt to put a note in there, this is really land A that's being sold. Okay, so go ahead, Kels.
So what if land A is sold for $50,000? You have to calculate your 704B gain. So for that, our 704B basis was 10,000. So with proceeds of 50, our gain would be 40.
Yep.
And then
what's that tell us, that 40?
that is your gain for your 704B, which would be allocated 50-50 to Pete and Jeff.
Which falls into the agreed upon category.
Yep.
Correct? Okay, let's go to the next one.
You have to calculate your 704C gain or loss. So with the 704C, we had a basis of 1,000. So with proceeds of 50,000, we'd have a 704C gain of 49,000. And with that, we had a required special allocation where 9,000 of that goes to Pete, and then the remaining is allocated 50-50 to Pete and Jeff.
And how much is that?
The agreed upon amount would be 20 to each.
20 each. Okay, can everybody see those moving pieces? Okay, so now, I think that's what this is doing, is it not, Kels?
Yep.
It is. Okay, and then when we do the special allocations, you have ending capital account 704B of how much for Pete and Jeff?
60 each.
And how much for their 704C?
60 each, so we equal.
So we equalized out, so we successfully executed on the required allocation to equalize those accounts out. Okay? And our balance sheet has how much cash, Kelsey?
120,000.
120,000. Okay, this is just another summary. Okay, now this is where it's going to get nauseating, right? What we've done is a little easier than what we're about ready to do. And to be able to wrap your head around what we've done so far, how you doing there, Noodles? You felt it, didn't you?
Oh, I don't feel great right now.
Do you need a Sam moment?
No.
Okay.
Nowhere near that.
Okay. Hold on. It's going to be Sam moments at this point. You aren't going to get away from that. Just the way same way Tito's is Tito's.
Yeah, so I'm famous, basically.
You're famous or infamous, one of the two. Okay, so Noodles, just to keep you in the game, what's number 1 say here?
Number 1 says, what triggers a required allocation? Partnership receives an inherent gain property as long as the property is not affected by a, quote, tax event. There's no required allocation. If there is a tax event associated with the inherent gain property, then there is a required allocation.
Okay, what's 2 say?
2 says, what does a tax event mean from the previous explanation? Tax event is when the inherent gain assets offset the taxable income of the partnership. The most common categories are A, cash basis assets and liabilities, B, sale or exchange of the inherent gain assets, or C, depreciation expense taken on the contributed assets.
Does that sound pretty much like I just made it up on the fly? But what were the 3 categories of assets that we talked about?
Short-term recognizable depreciable assets or for sale in the future.
Is that basically the same thing?
Yeah.
I like my other wording better that we came up with just on the board on the fly versus what I wrote here. Because that first category, cash basis assets and liabilities, is a short-time recognizable asset. But in my 704C calc I had yesterday, I had inventory that had a different fair market value versus basis, and that got triggered as well. So the terminology short-term recognizable asset seems more appropriate and broader than what I have written there. Okay, and what's my little asterisk say?
That is, the depreciation is an annual expense. There are 3 possible methods to allocate the required allocation, which are traditional with curative, and remedial.
Yeah. Okay. Noodles, who you want to call in?
We'll do Hoffman.
Well, I'm not reading.
No.
You're not reading?
I'm not reading.
Okay, who you want to call in?
How do you like that?
Do it.
I said, how do you like that?
I don't care.
We'll just go over to Stoothman then.
Okay, facts. P has a sole proprietorship. The only items on the balance sheet is 100,000 of AR and 50,000 of AP. The sole proprietorship reports income on cash basis. Jeff and Pete decide to form JP partnership whereby Pete contributes the sole proprietorship in exchange for 50% interest. Jeff contributes $1 million for his 50%.
Okay. So we have to identify the asset by person, correct? Then we have to construct our 704C, 704B inherent gain balance sheet, correct?
Correct.
Cash basis means that there's no basis in the AR. Well, let's use my methodology, because we have tax basis balance sheet. Pete has 0 equity in this deal, correct? Because he has cash basis AR of 100,000, AP of 50,000. Neither have been recognized because Pete's a cash basis taxpayer. And those are the only assets that are coming, correct? So Pete has 0 equity for tax basis. Jeff has $1 million of equity. There's no basis in the AP, which is confusing by itself. It exists, but for tax basis, it does not. So 0 plus a million is a million, which gets me my equity section, right, Brad?
Yep.
0 AP, because I don't have tax basis in it. 0 plus a million is how much, Brad?
Million.
Okay. And then I have AR with 0 basis, goodwill of 0 basis, because I know I'm going to have a goodwill kick out of this on the fair value side. And my cash is how much?
Million.
A million. So now I start with the equity section, and maybe that's where I should have started before. Maybe. I don't know the best way to approach this one. What's Pete's fair value equity?
1 million.
1 million. What's Jeff's?
1 million.
So what's my equity section?
A total of 2 million.
Okay, what's the liabilities that's on the balance sheet?
50.
50. So liabilities plus equity equal.
2 million 50.
So what's my assets have to equal?
2 million 50.
Okay, my cash is worth a million.
Yep.
Okay, my AR is worth.
100,000.
So my goodwill that pops out is how much?
950.
950. So now I've constructed my 704B balance sheet, my 704C balance sheet. What's my inherent gain?
You had 100,000 on AR.
Yep.
950 on goodwill. And then
Yep.
Pete has $1 million hanging out.
Yep. Okay. So I have, is that a 1 and a 2? Is that what that is?
So
Right there? Yeah.
Yeah.
So on the bottom left, what's the 1 say?
upon the collection of AR, this generates a required allocation.
Yep.
The payment of AP requires an required allocation.
Yep. Okay, so Jeff's 704C capital account post that collection is how much?
It wouldn't change.
And Pete's?
It would, you would get a deduct of 50,000 and an income of 10 or 100,000, so it'd go up 50,000.
Yep. And Pete and Jeff's 704B capital account were affected by that collection of AR and AP by how much?
The B account, nothing.
Nothing. Because the AP and AR were existing pregnant gain and expense when this was formed. Since it existed when it was formed, it goes to the contributing partner, which was Pete. So, what's Pete's 704C account?
Pete's is 0 to begin with.
And where does it end?
50,000 because we have to recognize the AR and AP.
Okay, and what's his fair value?
His fair value is $1 million.
What's the difference between those two numbers?
The inherent gain,
How much?
950.
How much inherent gain existed prior to the collection?
950.
No, $1,050,000.
$1,050,000.
And we recognized 100 on the asset side, 50 of expense on the liability side. Those had now gone away. The 950 of goodwill is still inherent gain that's yet to be recognized, and that ties to the variance between Pete's 704B capital account of $1 million and a 704C capital account of 50. What's the difference between those two numbers, Brad?
950.
How much inherent gain is my goodwill?
950.
950. So now I'm able to track the inherent gain that still resides in Pete's 704B and C capital account back to the inherent gain that exists on the balance sheet. Does everybody see that? Brett, you good?
Yeah.
Okay. So, I even did the math there. Huh. What is that? Why am I so fucking bad? What does the 4 with 2 arrows say, Brett?
The inherent gain only becomes a required allocation when goodwill is sold. However, see discussion on remedial allocation.
Okay. So that is something that you actually, in my view, want to highlight. Because if you ever want to become, a consultant, this is worth knowing. Because if you're representing somebody that's coming to the table with inherent gain, and part of that inherent gain is goodwill, you might want to take a note on this. You don't want to use the remedial method, and we'll demonstrate why. If you're the non-inherent gain partner, so in other words, Pete, to be specific on this page, does not want the remedial method. Jeff, the non-inherent gain partner, Jeff wants the remedial method. And I'm going to demonstrate this later, but on that call yesterday, where I was on the call with the attorneys, they were using the remedial method. Okay. Brad, who you want to call in?
We'll call Alyssa.
Okay, required allocations under 704. What are the methods? What are the methods the required allocations are measured and allocated to the inherent gain partners? Yeah, traditional method with curative allocation, and remedial method. How are the three methods utilized to make the required income allocation? The method must be chosen between the three options. Depreciation calculations must be made for 704B capital accounts. The partnership must quantify the tax depreciation deduction that will be taken on the partnership return, and the tax depreciation must be allocated to the 704C capital account based on the 704 method chosen.
Okay, this is where, Alyssa, we start getting nauseated. Okay, so let's go back to what were the three categories of assets?
Short-term recognizable asset, depreciable assets, and then if sold in the future.
Okay, so the short-term recognizable asset, I believe everybody in the room has wrapped their head around what that means. The collection of cash basis AR is a short-term recognizable asset. Yes? Mm-hmm. The sale of inventory that has appreciation in it, that's a short-term recognizable asset. Yes? Okay. A partnership interest or land, that's one that has to have a sale in order to have a recognition event in order to trigger the gain. So those two, I think we can capture those and say, we can see those as a required allocation because it's going to be, the methodology is calculate 704B gain, correct, Alyssa?
Yep.
And any appreciation on that is going to be a required allocation?
Agreed upon.
Agreed upon, right, Sam?
Yep.
Okay. And 704C has both required and agreed upon.
Correct.
Correct?
Yep.
And the required is going to key off of what?
The inherent gain.
The inherent gain that existed as of the date we formed the partnership. Correct?
Yep.
Okay. And the agreed upon is going to key off of
The partnership agreement or.
the partnership agreement, but it's going to key off of the 704B calculation.
Okay, yeah.
Because the agreed upon is going to be equal for 704C purposes, and it's going to be equal for 704B and C. Those two amounts should be the same. If they're not, something's off the rails. For the required 704B gain loss should be informative of how to allocate the 704C gain. That's a check figure. Your inherent gain is another check figure. You have two check figures that are embedded in 704C to make sure that you're on the rails. But this depreciable asset, that's a whole different thing. And the depreciable asset comes under three different methodologies: the traditional method with curative, and the remedial method. Okay, and for purposes of this, because man, I got lazy. I'm like, how am I going to express this? Okay, so we're going to do this on the fly, and I'm going to do it in here because I think this is going to potentially be helpful. We're going to say that I'm going to do this because I'm blind as a damn bat. And we're going to say depreciable equipment widget machine. I always like the old widget machine. That has a value, or excuse me, acquisition cost of $1 million. Where's my, there we go. And I'm going to say accum. And we're going to do this first in the extreme. Net book value is how much?
0.
0. Fair market value, we're going to leave it at $1 million. Fair enough? Everybody good with the facts so far? So Jeff is going to contribute cash of $1 million. Okay, so Alyssa, who do you want to call in?
Kelsey.
Kelsey, is this a short-term asset that's going to convert immediately?
No.
Is it an asset that is long-term that we have to, that is only going to have a recognition event when we sell it?
No.
It's a depreciable asset, correct?
Yep.
Okay, so what's my, make this a little smaller. My eyes aren't that bad. Come on, you can do it. So what assets do I have on my balance sheet, Kelsey?
You have the widget machine,
Yep.
cash of $1 million.
Okay,
The widget machine, is this 704C or 704B balance sheet?
let's make this, that's a good question. We'll make this C.
Okay.
Okay. And then we have what?
The widget machine, which would be $1 million with a cum of $1 million, so net book value of 0.
Okay. Okay, so my liabilities is what?
0.
Is 0. Equity,
Pete would be 0 because the net book value of the widget machine is 0, and then Jeff would be $1 million.
okay. There we go. Okay, so we have our total, right?
Mm-hmm. Which is $1 million,
And then
$1 million.
million. Okay, and my 704B is what?
Cash of $1 million. Widget machine of $1 million with 0 cum.
Okay,
Liabilities of 0. And then Pete and Jeff both $1 million.
everybody's on board so far. Have we done anything different? So my 704C, or my inherent gain, excuse me, is how much?
0 cash. The widget machine would be $1 million.
Okay,
And then liabilities 0, and then Pete $1 million, Jeff 0.
okay, and again, what kind of asset are we dealing with?
A depreciable asset.
A depreciable asset. So right now, everybody seems to be on board. This is no different than what we've been talking about so far, correct? No different. Everybody in sync with we haven't done anything different so far. So now we have to construct our 704B, 704C cap account. We have Jeff, we have Pete, right? Or Pete and Jeff, let's keep it consistent. Total. What's Pete's?
0,
0. And what's Jeff's?
$1 million.
Million. Okay. Okay. Now we have, and believe me, this is going somewhere. I don't know where. It's going somewhere. Okay. And now we have find the copy. We have 704B, right?
Yep. And they would both be $1 million.
Okay. All right. Everything's the same so far. So, let me ask you a question, Kelsey. If I had a piece of ground in a former example, we had land A and land B that Pete and Jeff contributed. Do you remember the 704B basis of each piece of the ground?
Land A was 1,000.
704B.
Oh, both were 10,000.
Both were 10,000. And if we sold that ground, what was our 704B basis?
10,000.
10,000. So we have a 704B basis that's attached to that account or that asset, correct?
Mm-hmm.
So is it fair to say that my depreciable property has a 704B basis in the same way my land has a 704B basis?
Yes.
Okay? So step 1 under every methodology is to recognize that your depreciable asset has a 704B basis equal to the fair value that was assigned to it when it came to the entity. So if we bought this asset, Kelsey, pushing aside any partnership tax concept we've been talking about, we bought an asset for $1 million, and we're going to depreciate that over a 5-year period over a straight line. How much depreciation do we have?
200,000.
200,000. Okay, so we're going to say fair market value of depreciable property. How much was it?
$1 million.
$1 million. Correct?
Yep.
5-year straight line. You said that was
200,000.
200,000. Okay. So step 1, should we write down our steps on here just for the hell of it? Okay. So step 1, follow normal procedure. And what do I mean by normal procedure, Kelsey? For step 1. Identify the asset by partner.
Yep. 704C balance sheet, 704B balance sheet, and inherent gain.
Okay. So is everybody on board with what I mean by normal procedure? Okay. Okay, so step 2 is there depreciable property? So is there depreciable property?
Yes.
There is. Okay. So, step 3. If there, if there is depreciable property, what method is being utilized? And that is, what were they? Traditional?
Traditional with curative and remedial.
Okay. Does that mean anything to you at all, Kelsey?
Not really.
Okay. We'll come back to it. Okay. Step 4. Calculate fair market value depreciation based on 704B fair market value of depreciable property. So what was the fair market value?
$1 million.
$1 million. Okay, so right now we've done, we were through step 4, are we not?
Yes.
Okay, so now let's talk about what, and actually, honestly, step 3 and step 4 could be inverted, and actually more appropriately, maybe they should be, just from a development of a thought process. Because traditional, okay, I'm not gonna go down this path just yet. Okay, I'm gonna tell you what the procedure is, and then we're gonna go down the path. Kelsey, why do you think we calculate fair market value depreciation?
So when we're adjusting our, so we can adjust our 704B balance sheet.
Okay, so we're gonna go year 1, year 2, through year 5, correct? And what's the goal of the 704B and 704C cap accounts, Kels?
To eventually equalize.
To eventually equalize, okay? So we have this concept of fair value depreciation. Hold on. So if nothing else happens and all we're dealing with is depreciation, if that's our only thing, our goal would be to equalize out our capital account. Oh, fuck, that's wrong. Like, what the hell? So, Kelsey, this is where I screwed up. What is the agreed upon allocation?
50-50.
And if I have 200,000 of total depreciation that's available, how much should go to Pete?
100,000.
100,000. I'm an idiot. Times 0.5. So, if we got into this partnership, and the partnership, we contributed $1 million of cash per person, and $1 million was deployed into a depreciable asset, we would get a deduction every year of $100,000 each. Is that how you would prepare a tax return? It is,
Okay.
right? So if 2 people contributed cash to a partnership, our cash count is $2 million. Debit cash, $2 million. Credit equity for Pete and Kelsey for $1 million each. The partnership goes out and buys a piece of equipment for $1 million. It generates a $200,000 deduction for depreciation. There's not a book tax difference. We're pushing partnership tax concepts aside. You would get $100,000 of depreciation, and I would get $100,000 of depreciation. That's just normal tax preparation, is it not? Okay, So what this is saying is, if we bought the asset for $1 million, how much depreciation goes to each person? This would be an agreed upon allocation, correct?
Yes.
Okay. So then we have this 704B, 704C capital account, which is our required allocation. So our required allocation, here's the rule. Oops, what am I doing? And I am going to invert these. The more I think about it, they almost have to be inverted. Okay, because we're going to calculate the fair market value depreciation. Then we're going to assess which methodology we're on. We're going to invert those steps. Okay, so now you know the fair market value depreciation that's available. And if pushing the partnership concept aside, you would have gotten 100,000 Kelsey of depreciation. I would have gotten $100,000 depreciation. Okay, so now we've had the concept of a contributing partner who is an inherent gain contributing partner, and we have the concept of a non-inherent gain contributing partner, correct? And we have those two assets that are easy to wrap our head around, which was short-term asset, which was sold, and the second asset was the one that sells in the future. And we do our 704B gain loss, and we have the required gain allocation, and how does this work? Okay, so the starting point for the analysis is, who is the non-inherent gain contributing partner? Okay, so step 5. Once you know what? I'm gonna, because this is now gonna be step 4. Because again, I'm trying to develop a thought process, and this is more automatic in my head, and I'm trying to go down the path. So step 4 is, who is the non-inherent gain partner? Okay? So who's the non-inherent gain partner, Kelsey?
Jeff.
Jeff. Okay? So now maybe I finally get to step 5. Traditional method, what methodology has been agreed upon by all the partners? Traditional with curative, or remedial. Okay, and I'm going to go back to step 4 a second. The reason I'm asking who the non-inherent gain partner is tells me this is a guidepost. The non-inherent gain partner, Jeff, has a fair market value allocation of depreciation of how much?
100,000 a year.
100,000. That 100,000 is a guidepost. It is an indicator of telling you what you need to do next. So, going back to our brief example where we're pushing the partnership concepts aside, you put in $1 million, I put in $1 million, we buy an asset at the partnership level, you get $100,000 depreciation, I get $100,000 depreciation. Well, we have a variation of that where Jeff put in $1 million, and Pete put a depreciable asset in. So Jeff should get his fair value depreciation. So by virtue of calculating what the fair value depreciation, you use that as a guidepost to say, well, he gets that much of the tax depreciation. So the traditional method says you can only use the depreciation from the contributed item. Okay? So, step 1 is normal procedure. Step 2 is there depreciable property? Yes. Calculate the fair market value depreciation, which is 100,000. who's the non-inherent gain partner, which is Jeff, how much, well, you know what? Okay, we're gonna insert here.
We're writing with pens.
Okay, well, this will be provided to you. Step 5. Yeah, no shit. Use the non-inherent gain partners 704B depreciation as a guidepost to determine how to allocate tax depreciation. Okay, so let's do this again. Follow normal procedure, which we agree what that is. Is there depreciable property? Yes. Calculate the fair market value of depreciation, which is 100 each, which is the depreciable property that was contributed, divided by an agreed upon amount of time. You come to a fair market value depreciation that's available to Jeff and Pete. Allocate that fair market value depreciation to Jeff and Pete in proportion to the agreed upon allocation. Use that. Who's the non-inherent gain partner? Use the non-inherent gain partner 704B depreciation as a guidepost to determine how to allocate tax depreciation. Okay? And then the traditional method says you can only use the depreciation from the contributed depreciable asset. What is the depreciable contributed asset that was the depreciable contributed asset, Brett?
The widget?
The widget machine. Okay? So, tax net book value. How much is tax net book value? Huh. Okay. 5-year straight line. How much tax depreciation do I have?
0.
0. So Jeff is owed $100,000 of depreciation. Correct? From a fair value perspective?
Yes.
And traditional says that, what's that say, Brett?
You can only use the depreciation from the contributed asset.
Uh-huh. You can only use the, need to be more precise, because words matter. Use the what depreciation?
Tax.
From the contributed asset. How much tax depreciation do I have?
0.
0. So that says that there is no required allocation because there's something called the ceiling rule. When you use the traditional method, it's possible that you bump into the ceiling rule. Okay, so let's change the facts a little bit. And let's play with this because we're going to stick on the traditional method. And I'm going to say instead of $1 million, this is 500,000. What the fuck? Oh, I added that. What the hell? Escape plus. Oh, that's what I did. I'm an idiot. Okay, is all that track? We went through our normal stuff. Okay. Control C. Control V. Let's do. Well, I'm going to do this manually. So what's the rule that we have Brett?
You can only use the tax depreciation from the contributed asset,
Okay, so how much depreciation is Jeff owed?
100,000,
How much do I have available?
100,000.
Okay, so look what just happened. There was 500,000 of depreciation, tax depreciation that was available. We didn't bump into the ceiling, but Pete gets 0 tax depreciation off that asset as we go, and Jeff gets 100% of it. Okay? So if we made this, these would all be 0, right? And it doesn't equalize.
And that's because the ceiling rules that you can only use the tax depreciation.
From the contributed asset. Or contributed assets. Because we could have a widget machine A that was fully depreciated, and which widget machine B that was newly acquired. And both those assets are contributed, and both would have a depreciation that we'd have to go through from a fair market value depreciation to figure out who gets what depreciation. But it's the population of the contributed assets, not just on an asset by asset basis. It's the population of depreciable assets that were contributed.
Okay.
Okay, so does anybody have any questions yet? Are you sure? So, if we don't have any questions, let's do this, just to make sure that we're all here together.
I don't think I'm very happy if I'm Pete.
What do you mean?
Jeff's getting all my depreciation.
Fair enough, but Jeff's also giving me $1 million of value for a 0 basis asset.
And you already got the depreciation.
And I already got the
Well,
depreciation.
no wonder you're revised. There's 500,000 basis left.
If I'm Jeff, how do I get cured?
You don't. The only way you get cured in the 0, when you bump into the ceiling, is gain or loss on disposition of your partnership interest. That's the only way it gets cured. So the ceiling rule, if you bump in, if the ceiling rule comes into play, then the only way that gets cured is by disposition of partnership assets, and the goal to have your 704C tax count drive to equalize to your 704B cap account is not going to happen because you bumped into the ceiling rule.
You said you only get cured on disposition of the partnership,
Mm-hmm.
not disposition of the asset.
Nope. So, well, I said no too quickly. I think if you get to the end of the depreciable life for fair value, my answer is correct. I think if it gets disposed somewhere in the middle of the fair value, my answer might not be correct. So I'm going to go with I don't know on that. But I do know if you get to the end of the depreciable life of the asset and we bumped into the ceiling rule 5 consecutive years and we get to 0 basis in that asset, that there is no cure for it. Because at that point, your 704B basis, so let's answer your question. If we get to the end of year 5, Brett,
Yep.
what's the net book value for 704B purposes?
0.
0. And if we sell it for $500,000, how much gain do we have?
500.
500. Now, and that's going to be split, the 704B cap account, is that required or agreed upon?
Agreed upon.
Agreed upon. So that gain's going to go 250 and 250, correct?
Right.
Okay. So now we go into our 704C cap gain. How much are our proceeds?
500.
What's our basis?
0.
Gain.
500.
So those two are going to be in concert with each other, correct?
From a gain perspective, yes, but it'll be required to Pete.
Because it's been fully
Oh,
depreciated for
Yeah, that's only on the future assets. Yeah.
Okay. So let's do this. Okay. Can you guys tell me what depreciation goes to Jeff and Pete? I'm going to change this.
Is it a 5-year asset?
Yep.
So for 704B, it would be 200,000 each year at the partnership level, and then if they're 50-50, it would be 100,000 to each. And then 704C, there would be 750,000 remaining.
Yep.
And then with the traditional method, you have the ceiling rule that says you can only use.
And we're only talking about traditional method at this point.
Okay. Let me think. What's 750 divided by 5?
15.
50?
15.
15?
150,000.
Okay. So 150,000 over each year over 5 years.
Okay, so hold on. So even if you fuck this up, Kelsey, you're on it.
Oh, thanks.
Okay, so what's my 704B cap account for Pete and Jeff?
They're each at $1 million.
So Pete and Jeff is $1 million and $1 million. So what did you do next exactly?
I calculated depreciation over the next 5 years for each
And
of
how
them.
much was it?
To 100,000 each.
But how did you get there? You're shortcutting on me. You're right, but how?
The fair market value of the widget machine is $1 million.
Okay.
So at the entity level, they'll take depreciation of 200,000 a year.
Yep.
And then if Pete and Jeff are 50-50, they'll each get 100,000.
Okay. Okay, so, and that's for a period of 5 years, correct?
Yep. So then at the end, they'll each be at 500,000, which will equal.
That's 3, 4, 5, correct?
Yep.
$500 and $500. Okay. So what about my 704C?
Pete is at 750 and Jeff is at $1 million.
Okay. Then what?
Now we need to depreciate the asset, which has a net book value of 750.
Okay.
So then over 5 years, that would be 150,000 each year.
Okay, and then your rule is what guidepost do you use to figure out how to allocate that 150,000?
A non-inherent gain partner,
And who was that?
Jeff.
Okay, and how much in the fair value column, because you're using the fair value column to key in on as the guidepost to say what tax depreciation go to Jeff, correct?
Mm-hmm.
And how much is that number?
100,000.
100,000. Okay, and do we have enough tax depreciation to support that?
Yes.
Okay, so for a period of 5 years, Jeff is how much?
500,000.
Okay, so how much tax depreciation do we have overall?
150 each year.
How much do we use?
100,000.
So where do you think that additional depreciation pushes to?
Pete.
Your inherent gain partner. Okay, so Pete's depreciation is 50 a year, correct? Kelsey, what's 5 times 50? 250.
250.
Okay. Okay, what's 750 minus
300. 200. Wait, 750 minus 250?
750 minus 250?
500.
Wow, that was math Tourette's. I've never seen anything like that before. That was math
I need my
Tourette's.
10 key.
I did any number in infinity could have popped out of your mouth. I'm quite confident. And how much is that?
500.
500K.
And we equal.
We equalize out. Okay, so the procedure, follow normal procedure. Is there depreciable property?
Yes.
Calculate the fair market value depreciation.
100,000 to each partner each year.
Yep. Who's the non-inherent gain partner?
Jeff.
Use the non-inherent gain partner 704B depreciation as a guidepost to determine how much tax depreciation to allocate.
Which is 100,000 to Jeff.
Yep. And then, are we using traditional, curative, or remedial?
Traditional.
Okay. And then the traditional has the burden of having what rule?
The ceiling rule.
The ceiling rule. So if you don't have enough tax depreciation to support the fair value depreciation that should be allocated to the non-inherent gain partner, it just goes, it goes away. And to Brett's point, I don't know what happens when you sell it in the middle, but I suspect that if you sell it in the middle, there would be a portion of the gain that would go to the non-inherent gain or the inherent gain partner. But if it gets all the way through the fair value depreciation, then you gotta wait till the end. Leslie, how you feel about all this?
Okay.
Okay. Alyssa?
Yeah, good.
Sam? You need to be drunker tonight. Brett?
Good enough.
John?
Good.
Okay. Okay, so traditional with curative. Okay? So the rule is you can only use the tax depreciation from the contributed asset. Traditional with curative. Okay, so everybody understands traditional, you can only use the tax depreciation that comes from the contributed asset. Traditional with curative says, well, and I didn't know this, the way it was couched in grad school, and I think it might have been Pfeiffer who was taking a partnership class. The way I learned this rule was that if you added an additional piece of depreciation, depreciable property, you could cure the shortfall. So if we go back to the balance sheet, and if we had no depreciation available based on the asset that existed at the date we formed the partnership, if we went out and bought another widget machine for $1 million, then we would be able to use that $1 million newly acquired machine to allocate allocate depreciation to Jeff to cure the shortfall that existed on the asset that was contributed. So in this case, how much is the shortfall? Kelsey, who do you want to call in?
Brett.
Who?
Brett.
Brett, how much is my shortfall? How much did the ceiling rule?
100,000.
100,000. So we have a shortfall of 100,000, correct? So if we added another machine, and let's call it for $500,000, in a straight line for 5 years, how much tax depreciation do we have due to the newly added machine?
100.
100. What do we owe Jeff?
100.
So Jeff would be able to harvest the depreciation off the newly acquired machine in order to cure that shortfall.
So if it was in for $1 million, the first 100 would go to Jeff, and then it's 50-50 for the rest.
Yeah. That's a very, very good question. So let's do that again. Did everybody understand Brett's question? Okay. And why would that be the conclusion?
Because you have your required piece, then you have your agreed upon for the rest.
That's right. That's 100% right.
What if they bought like a building for 39 years? How would that shake itself out?
You mean in terms of,
Yeah, say we're doing the second method with remedial, and then we buy a $1 million building, for example.
oh, well, it doesn't have to be the same kind of asset. So if the shortfall, let's say, let me rephrase articulate what I think your question is. If instead of a widget machine, we had a building that was fully depreciated, and then we added a machine that created depreciation, is that where you're going?
I was thinking like if we did the machine still, did a building, is the runoff over 5 years or would that get cured over 39 years?
It'd be over the 5 years. But the building depreciation probably is enough to harvest that out, harvest a portion of that tax depreciation out to cure that 5-year problem, would be my instinct. So traditional with curative says that I have the opportunity to cure by addition of depreciable property. That's the way I learned it in grad school. Or that was my impression of it. But when Fife went through, he said you had to pick a specific item of deduction and allocate that specific item of deduction, and you had to stick with that specific item of deduction. Is that right? Probably. I mean, Pfeiffer's generally pretty good at paying attention to what the hell's going on.
What do you mean by that? Specific item.
So I could say, well, I'm going to specially allocate my rent expense to cure the depreciation shortfall. There's going to be rent expense every year that I have to dip into to cure the depreciation shortfall. Or I could choose some item. That's what Pfeiffer said.
Does that have to be the same character?
One would think, but I don't know the answer to that. I'd be surprised if that weren't the case.
And that's once you would decide that you have to use that specific expense until it's cured.
Yeah. Well, for over the 5 years. So if that specific expense came up short in a given year, you're going to bump into the ceiling rule.
Mm-hmm. You can't flip it though. Like first year you want to do rent expense, next year you can't flip it to something.
That was not my impression from the discussion with Fife, so I'm going to stick with my grad school understanding and stick with depreciable property, because that always made sense to me, because it was of the exact same expense type, and that made sense to me since it was the exact same expense type. The addition of depreciable property using that exact expense type would cure the shortfall. That always made sense to me. This concept of using some other item of deduction didn't really make sense to me. But again, I mean, he had it. We were sitting in the conference room. He was going through Golden Gate. Okay. So let's talk about there were 3 options. Kelsey, what were they?
Traditional with curative, and remedial.
Remedial. Okay? Remedial is a free-for-all. It's the wild, wild west. We can just make up whatever we want to make the capital accounts get to the right spot. So if this is our fact pattern, where Jeff contributed cash of $1 million, Pete contributed a machine of $100,000 with a cum of $100,000, and this is the exact same fact pattern. So, Brett, we have with traditional, we have a ceiling problem, correct?
Correct.
With traditional, with curative, we have a ceiling problem until we add a new machine, and we still possibly have a ceiling problem, correct?
Correct.
Okay? The remedial says, well, wait a minute. This is the wild, wild west. We're going to make the allocation, we're going to do allocations to make the capital accounts drive to zero at the end. So, it's the same steps as we had before until you get to the allocation. So, Brett, what is my fair value depreciation?
200,000.
And allocated to Pete and Jeff and
100
each. So how much depreciation do we owe Jeff?
Fair value?
Yep.
100.
How much tax depreciation do we owe him?
0.
No. How much do we owe him? Just
Oh.
What it's a guidepost. Let
Yeah.
me be more precise in my question. Using book depreciation as a guidepost, how much tax depreciation do we owe him? 100. So the remedial method says, we don't care. We don't care if there's any sort of depreciation to support that. Jeff, Jeff's going to get his 100 depreciation. No matter what. So let's put this in the most stark of fact patterns. Jeff is owed 100 of depreciation. We're going to give him 100 of depreciation. And I'm going to pretend that we have no income, and this is not the way this works, but this is going to drive the point home. We have no income, and we have no expenses for 5 years. We don't collect $1, we don't spend $1. Everybody agreed on what our fact pattern is? So the remedial method says, well, if we have no income and no expenses, what's our book income and what's our taxable income that's going to be reported on the 1065, Brett?
0.
0. Well, we're saying that we're giving Jeff a K1 with a $100,000 deduction, are we not?
Yes.
So right now, I got a K1 that says $100,000 loss, correct?
Yes.
But I have no taxable income at all. What do you think the offsetting action would be? Would it be to jam Pete with $100,000 of income? So Pete's going to get a K1 with $100,000 of income on it. Jeff's going to get a K1 with $100,000 of expense. And those two are going to zero out because 100 of income to Pete, 100 of expense to Jeff is 0. That's exactly under my very bad fact pattern, fictitious fact pattern of no dollars of income, no dollars of expenses. Gets us back to 0. And what does that allocation do, Brett? Do we accomplish what 704B and 704C try to do in pushing the inherent gain to the proper party and equalizing the capital accounts? Does it do that?
Yeah.
It does. So the remedial method is a free-for-all.
It doesn't matter what type of expense you're allocating, as long as you get to the right answer in the end.
It can be rent, it can be depreciation, it can be whatever you want.
As long as it's a $100,000 loss in this case.
Or in the inverse, okay, so there's a push and a pull, or a different way of looking at this. Let's pretend for 1 second that we just had $100,000 of income. on an annual basis. If we said the $100,000 of income gets specially allocated to Pete and the 0 to Jeff, does that cure the problem?
No.
It does.
What?
Well, Jeff's gonna have we're both gonna have $100,000 on, I think it does. The point is, and I think you might be right, I think I might have a math problem on that. My point is, it can be an item of income can be shoved to the inherent gain partner, or an item of expense can be pushed to the non-inherent gain partner to equalize capital accounts. So it could be an allocation of either to make that true. Now, I think you busted me on a math problem, maybe, because I don't know that it does equalize if I have 100 of income. Well,
Yeah, if you have 100 income, you're shoving it all to Pete, then Jeff still has 0 loss.
yeah, they don't equalize. So I think I do have a math problem. But I know it can be either. I'm just going to stop there because I know I'm on shaky ground. Okay?
Which one do you see most common?
Well, what do you mean, what do you see most common?
The method, because that's what you
Oh.
used yesterday, right? The remedial. Is that what that was?
Well, let's go back to if I'm, well, I don't want to go here yet. I'm going to answer that question differently.
Is there something in the partnership agreement that says which one they have to use?
Can. Certainly can. But that is generally going to be, you have to have somebody that has recognition that you want that in there for a specific reason. The more common is the partnership agreement is going to say 704C allocations are going to be dictated by the managing member of the partnership. That's more likely the language that's going to be in the partnership agreement. But, so I'm going to change this from, what if Jeff contributed $2 million of cash, and Pete's widget machine was worth $1 million, and we're still 50-50. Okay, so my equity section is how much from a fair value perspective, Stuthman?
3.
No, both were 50-50.
Oh. 4.
Okay? So Jeff's contributing us $2 million in cash. Okay? But the machine is still worth $1 million. Are we in balance on the 704B side?
No.
No.
Okay? What do you suppose we're missing to get into balance? If my machine is worth $1 million and I'm getting $2 million of equity, what do you suppose I'm missing?
Goodwill.
Goodwill. Okay, so if we say that there's a goodwill component, wait a minute, there we go. We have goodwill, 0, that's $1 million. Oops. Are we now in balance?
Yes.
Okay. So the remedial method, traditional has a ceiling rule, correct?
Correct.
Traditional with curative has an allowance for an adjustment to the tax depreciation for additional assets added, correct?
Correct.
Remedial I described as a
Wild West.
the Wild West is free for all. So if let me ask this question, Brad. If we were dealing with not a partnership concept and you bought goodwill and there's $1.5 million of acquisition cost associated with that goodwill, what's my annual write-off?
100,000.
100,000. So you would get $100,000 a year. Now let's take that to the next step to say that if we have $1 million of goodwill and we acquired that for 704B purposes, how much depreciation, and I should change it to $1.5 million for purposes of our example, how much 704B depreciation is available?
If it was $1.5 million, it'd be 100,000.
100,000. So if Jeff and Pete were 50-50 partners, Jeff would have how much 704B goodwill amortization?
75.
50, right? It was 100,000.
Oh yeah, yep.
Okay. So now we're in the wild, wild west. It's a free-for-all. Going back to our original rule, and we highlighted this on a page earlier that said goodwill fell most likely into that third bucket. What was three types of assets, Noodles?
It was short-term, recognizable, depreciable assets and things that we will sell in the future.
And goodwill feels like something that falls in the self-created goodwill falls into the bucket of something that feels like we should be recognizing a gain only when it's sold in the future.
Yeah.
Under the remedial method, self-created goodwill, we have this $50 that's associated with that goodwill amortization that's due to Jeff. The remedial method says that came in at fair value. The remedial method says this is the wild, wild west. Jeff is owed that $50 of goodwill amortization. So, do you remember earlier I said if you're the inherent gain partner, you don't want the remedial method.
Correct.
As the non-inherent gain partner, you want the remedial method. Because I, as the non-inherent gain partner, want my $50 of depreciation or amortization. As the non-inherent or the inherent gain partner, I don't want $50 of income jammed my way. Because if we sell the goodwill in the future, what's the character of that gain, Brad?
Capital.
Capital. If we have the remedial allocation that's going to jam $50 of income my way, what's the character of that gain?
Ordinary.
Ordinary. So there's two really bad things that just happened is non-inherent gain partner. One is, what's character?
Ordinary.
Ordinary. And when did it happen to me?
Right now.
Right now. And if we don't have remedial turned on, when is it inflicted on me?
Whenever you sell.
Whenever we sell it. So, if I'm representing somebody that is getting into a partnership and there's this goodwill bucket that exists, and they're the inherent gain partner, what am I trying to insist on in the partnership agreement?
Traditional.
Traditional, or traditional with curative, don't care. But traditional is most likely. If I'm the non-inherent gain partner, representing the non-inherent gain partner, what do I want?
Remedial.
Remedial. So going back to the page when I said, you know, it's that third bucket, goodwill falls into that third bucket of it's only going to be recognized when it's sold. And then I said, except we need to talk about the remedial method. This is why. So you want to make sure that you don't have the remedial method if you have goodwill in play. Because it's the wild, wild west. You can do whatever the hell you want.
So goodwill, even though we're getting a deduction like first year, because it's amortized over 15 years, we don't cure or do anything with that if it's traditional, right?
Correct. Yeah, and
So I guess like my thought is it feels like the second category, it's like getting traditional.
you know what? I've never thought about that.
You know,
Because I've always, in my mind, once I turned off remedial, I've left that in the exact same category as land, in my mind. But what you said and what you just picked up on was the conversation Brett and I had a little bit ago when we bumped into the ceiling earlier. If we didn't have any allocation, then we get to the end and I have no value left under 704B, and therefore it's going to go under the agreed upon. I've never viewed it that way, and maybe I should have, because I'm saying for 704B purposes, that probably does have a deduction associated with it, which is not available, which bumps into a ceiling, which means that the goodwill should be allocated based on agreed upon versus required. But I've always treated goodwill as required. I don't know if that's the right answer, because I've never even thought about that before. Does anybody have any questions on that?
If you're the inherent game partner, this says inherent game partner does not want remedial. Is that only if it's goodwill, or is it all the time?
That's a good question. What do you think?
That's what I'm asking.
What do you think, though? What's your instinct?
I want to say all the time.
That you want what?
That you don't want remedial if you're the inherent game partner.
That's exactly right. But you sure don't want it with goodwill. So Sam's question, which in my view is a next level question, is that, wait a minute, you just made the point on goodwill and not wanting to be harmed by that deduction from goodwill. Why isn't that true for all depreciable property? Why wouldn't you want, as the inherent gain partner, to always be in the category of traditional method? And I think you do. Yeah, because if you bump into a ceiling rule, that's a good thing for the inherent gain partner. Bad for the non-inherent gain partner.
Aren't you gonna give Brad a coupon over there
Do what?
for his comment?
What? Huh?
Steuben's comment that you said you'd never even thought of before? He
That's
doesn't get it.
depreciable.
Okay, all right. Here you go, Brad.
I mean, he gave it to a guy for picking up pigeons.
I did, actually. He fucking deserves it. You guys know about this?
He's picking up dead pigeons.
You know
I
about
don't
this, right?
know.
This Wyatt from CAS here?
Oh, yeah.
White's in healthcare.
Healthcare.
Healthcare? Okay.
During, when he interned, or maybe his first year, I remember he was picking up dead birds on the.
He did it yesterday. He's still picking up dead birds out there.
He walks in, he grabs a trash bag, and he grabs some paper towels, and I don't know how Hoffman figured it out, but you figured out he was going outside to pick up dead birds.
Like, what are you doing?
He's the designated dead bird upper.
Yeah.
They just banging y'all's building?
Yeah, in the windows.
I'm like,
The cleaners are so good.
But when he said he's going out to get a pigeon, I said, well, here's a gift card for your services. And I still think the guy's getting screwed.
I want to pay you for this. Here's a gift card.
100%. And I don't think we're doing enough. I mean, Wyatt needs something for the pigeon pickup services here that he's providing.
It's all figured in, Pete.
I'm sure it is.
I told him to put it on his self-evo. That's one of his accomplishments.
I'm 100% on board. If that kid is dedicated enough that he's going to go out and pick up the dead birds, I think that is.
Do we not pay for a cleaner?
Right. That's what I said.
They don't pick them up.
So our veranda has carcasses if Wyatt doesn't do the job.
Yeah, there's some I feel like tax season. Sometimes they lay out there for a few days. And they just with them.
This conversation, I didn't know I was going to have this when I got up this morning. That's for sure. The dead bird conversation.
Well, it's really scary when you're working and one of them bangs against the wall and you're like, oh my gosh, what just happened? Well, bangs against the window.
Yeah, I don't know what broke that window. So
Okay,
someone
but
thinks it's the building. No, it was not.
Brett and
Someone-
Trent were the only people in the office when the window broke that night.
It's true.
That's
What has happened? We have no clue. Trent and I were sitting there, and all of a sudden there was just a loud crash, and we looked over, and the window was shattered.
I don't believe a word of this.
It's exactly what happened.
Okay, so this is.
It was during opening night of NFL last year.
I'm sure a football was being thrown somehow.
It was not.
There was. So, Christmas Eve, I was in the Omaha office, and you know the story, I think, don't you? And for whatever reason, I was going from my office to the mailroom, and I don't know why I was being stupid, but I was going through and I was just taking the cube doors and just closing them as I went. And I have no idea why the hell I was doing it. None. I was thinking about God only knows. And I'm walking past, you have Jeff Snyder's old office, and you have that row of cubes that are there, and then there's a super cube row of cubes. And I go through and I close the door and I'm taking steps, and there's a thud. And I turn around, and the door had come off the cube and was falling over. So I'm like, fuck. So I turn around and I try to catch said door. I don't get there, and it hits the cube and just shatters. Nobody's there. So now I'm in this conundrum of, do I raise my hand and say I'm the idiot that broke this door, or do I pin it on the cleaning people? These are my options.
Sounds like ethics training.
Yeah.
So
Are we getting credit for ethics?
yeah, no shit. So I called David Horner, which most of you probably don't know who David is. And
I do.
this is the freakiest thing. I said, David, I have a confession. Swear to God this happened. This is no shit. He goes, did you break a cube door? What? How the fuck do you know that? Why would that be your guess? And I go, I did. You can take it on my comp at the end of the year. But how he guessed that? This was an hour after I did it, on the way home on my cell phone. How he guessed that, how he knew that, if there's cameras in the office that we don't know about, that was so super weird to me, I didn't know what to do with it. But no, I called and owned up to it.
He didn't tell you why he guessed that? That is like a very random thing for him to just assume.
With no reason.
That's because he did it. Once. He probably did it once.
He probably slid that one slightly off the rail, and then you just finished it off.
You know how much that door cost?
Wasn't it something like $1,000?
$1,500. Motherfucker.
Did they take it out of your paycheck?
I don't know. If they did, how does one know?
I would know.
Well, I mean, if
Would you not know?
Yeah.
Be like, where's my money?
No, he's saying they took it out as like year-end comp. See,
yeah, year end. Yeah, if it went on my weekly, I'd notice that. Well, I don't think I would notice that. My wife would notice it, but I would not notice that. I am blissfully unaware of lots of things. Let's see. That's not what I wanted. Okay, so this is that deal we did, I had the call about yesterday that shows, let's go to 704C first, that my beginning tax basis was negative 20 million, it ended at 15 million, and then I have the 3 buckets of assets that I had to deal with. One bucket is the short term. In the short term assets shows I had inventory for the hogs, that the inventory was turning in year 1, and there was a $16 million or $17 million inherent gain that existed with respect to those hogs. Those hogs are sold in year 1, and the first partner ended up getting a $13 million will get a $13 million special allocation of that income, because that short-term asset was sold in year 1. The second bucket was depreciation. And Kelsey, where do you start for who gets what depreciation?
704B.
704B. So you go to the 704B account. My depreciation was 62 million, or the population of fair value was 62 million. Based on the underlying assets, those assets were being depreciated over 10 years because this is specialty farm equipment. And since the majority of the assets were specialty farm. I took the amount over 10 years, which said that the non-inherent gain partner that contributed 15 million is owed 3 million. You know, Joyce, who also contributed $1 million, gets their 62,000. I have cash contributors, and I go to my 704C account, and I've got only 2.4 million of depreciation that's available. If I was using the traditional method, would I bump into a ceiling, Brett? If I was using traditional with curative, I can add assets later, which would have worked, by the way, because a minute after the formation of this, they bought a target for $100 million. So there would have been a lot of assets. So traditional with curative actually would have worked. But they said, we're doing remedial. So the non-inherent gain partners got their 3 million, their 62, so on and so forth, and which results in an income pickup of $1 million to that particular partner. So how the hell does this work? Let's do this for a second.
I have a question real quick.
Yeah.
If like, for some reason, like half of those hogs die or something, like, do they just standard in this case get like all the deduction for that since they've picked up the income related to that? Or
Well,
if
they
like
only pick it up when the hogs are sold. So the question is, and I got to figure this answer out sooner or later, is that if I sell for something less than 704B basis, what impact does that have on my 704C capital account? So I have $16 million of inherent gain sitting in there, correct? So if I sold the asset, I'm going to say that I have zero basis in that asset for purposes of discussion. Okay, so if I sell it for 16 million, 12.7 would go to this particular partner. Now what happens if I sell it for 10 million? Now my 704B capital, or my basis, was 16 million, correct? Now I have a loss for 704B of $5 million. But I still have an inherent gain of $10 million because proceeds for 704C was 10 million, correct? My basis was 0. I got a loss in my 704B account of 5 million, 2.5 to each partner, however that worked. But I got a $10 million gain. How does that work? And I don't know the answer to that. I should know the answer to that, but I don't. Because everything appreciates, Brad. Okay? So, how does this work? You're confronted with, and maybe we go back to the other example. What's the best way to frame this? I might have to just come up with a different fact pattern. Okay, so I'm going to say I have book income of $100,000 or $1 million. I have book depreciation of $200,000. I have book gross income. I have book net income of 800. Sam, when we're doing an M1 schedule, what number do we start with as our beginning number? Book income. Okay. So let's go back to this, and let's say that my net book value is 500,000. which means that if that's the case, let's do some undos here. Does that give me the right spot? Nope. Does that give me the right spot? I think it does. 2 million, 2 million, 0. Because this is saying this is negative 500, right? Why didn't that work? Oh, it works, right? We have $100,000. $100,000 is due to Jeff, correct? And we have $200,000 that's due to for fair value. Oh, this accidentally works. Okay. So we have $1 million of income, correct? We have $200,000 of depreciation. Okay? And our only M1, Sam, is depreciation. How much book depreciation? Well, let's do it both. How much book depreciation is embedded in my net income number?
200.
Okay, so do I add that back or subtract it?
Wait.
No, to arrive at taxable income for M1.
Oh, well, yeah, that. Why all of it?
Because now we're going to deduct tax depreciation, are we not?
Oh, you just breaking it out into two.
And I'm doing it for a specific reason. Okay? How much is my tax depreciation? Okay? It's 100. Taxable income is how much?
99.
So how do we execute on this special allocation? Is the question. And this is how I do it. And this doesn't make it right, but this just makes it how I do it. We had 3 categories of assets, right? Noodles, what were they?
They were short-term recognizable, depreciable assets and things we'll sell in the future.
Okay, and so I'm going to push that aside for a second. If we have an item of income that occurs post-formation, or we have appreciation that occurs post-formation, that goes agreed upon, right?
Yes.
Okay, so now, as an M1 schedule, you have to ask yourself, what is agreed upon and what is special in terms of how you have to confront this? Okay, so this is Pete and Jeff, right? Is that who this is? Yep, Pete and Jeff. So now, I'm going to break this up into something that's occurred post and something that's required because it was inherent gain. So do Pete and Jeff enjoy, should they equally share in the net income of the operations? They should. So from a book income perspective, Pete and Jeff should have $400,000 of book income, shouldn't they? So this depreciation, this GAAP depreciation, this fair value depreciation, and they're not going to be the same. They just happen to be in this case. So let's be clear about that. The GAAP depreciation, is that something that occurs post Pete and Jeff getting together? Yes or no? Yes. Yes. Okay, so we're going to add that back to Pete and Jeff. So 100 and 100. GAAP depreciation. Okay? So, we know our tax depreciation is 100. And we've done our analysis as to who that depreciation should go to, haven't we? And who does it go to?
Jeff.
Jeff. How much goes to Pete? So taxable income to Pete is 500, and Jeff is 400. We have taxable income globally of 900, and by virtue of segregating the M1s, or each item in the M1 schedule, is this something that occurs post us getting together? Therefore, the M1 is going to be allocated on the agreed upon amounts. What's a required allocation, and driving the M1 based on the agreed upon allocation is going to drive your analysis of Pete's K1 and Jeff's K1.
So would this look any different if the 704B and the GAAP depreciation didn't equal each other?
Yeah, well, let's do that. I'm completely okay with that. Because Leslie's saying, well, what if this is 300, right? And that's fair value. Now we have a disconnect. Well, in order to derive at taxable income, you're going to key off GAAP. The fair value piece is only there to serve as a guidepost as to what the non-inherent gain partner's getting in terms of depreciation. There is no correlation to GAAP. It just happened to be equal in this case. So now my 700, right? 350. Now I got, 150. 150. And we have the same result. So it's going to be the gap is going to be allocated or backed out in proportion to everybody's ownership. Okay, so this piece of how do we take that special allocation and run it through the M1 schedule, my procedure, for lack of a better description, is start with global. What is this is just your global M1 schedule. This is no different than the M1 schedule you're going to do for an S Corp, partnership, C Corp, whoever. This is exactly the same. Then, and the reason I broke this out between GAAP depreciation and tax depreciation is I'm smart enough to know that some of these items are going to be split based on agreed upon, and some are going to be split based on required. And now I have to break this apart, this M1 apart, to say, well, is it agreed upon? If it is, it's going to be agreed upon in the K1 allocation. If it's special allocation, then it's got to go to the right person. Okay, so when we're going to be utilizing this, there's going to be an M1 that says there's a $16 million add back globally that's going to occur. My market hogs are going to sell for 16, there's no gain or loss for GAAP purposes. So over here, there is no M1 for GAAP on that. But there's going to be a $16 million add back with respect to those market hogs to get to a global taxable income. And then I gotta be smart enough to say, well, of that 16 million add back, none of that add back is going to go to the cash contributing partners. And 12.7 million is going to go to the non-contributing or the inherent gain. 408 is going to go to the inherent gain. 727, 686, so on and so forth across. So globally, I'm going to have this $17 million M1, and that $17 million M1 has to then be broken out by K1, by partner, to figure out who has that special allocation of income. Any questions about that? And that takes practice.
So you were representing Standard Nutrition in that example, right?
Yes.
We are,
Yes.
and they're the inherent gain.
The
Or
biggest
is-
one.
Yeah.
Yep, they have a fair value capital count of 40, negative of 20, $60 million of inherent gain that they're sitting on.
But we use the remedial method,
Mm-hmm.
and that's not necessarily a good answer for them, right? Is that what
Well-
we decided? Or were they just doing that in order to, kind of push the deal through?
Bingo.
Okay.
Bingo. The other side is taking the position, I'm coming with 50 million of money.
Yep.
And you want to shortcut me on my depreciation?
Yep.
We don't think so.
Makes sense.
And Standard basically said, we see the value in this deal, and we're going to take the income hit because there's value locked up in what we have. There's value, somebody is willing to sell us their business line, which is exactly like our business line. So we're going to double in size by virtue of you coming on and giving us the cash. We're going to double in size by virtue of acquisition. And, oh, by the way, the seller is so tired of being in this business that they're going to give us a $30 million discount on the business. So if I just break this thing up and sell it in pieces, instead of $100 million of acquisition cost, if I break it up into pieces immediately, I got $30 million of value that's going to pop. So this income allocation is just noise in the larger, broader, big picture. But if you are, and they agreed to it right up front. There's no doubt from the other side, that's the way this was going to shake out. And Standard was very amenable because we want to get this deal done.
Yep.
When would that close? Did it close finally? All right, whatever. Nope. I want to close this too, right? Nope. See, I wrote this page and I got lazy and I figured we'd just do this in class. Okay, so are there any questions on that whatsoever?
I got a couple.
Yeah, go ahead.
So going back to the short-term bucket,
Okay?
if you have AR and AP,
Yep.
are you going to specifically look at those buckets inside the AR and AP when they're brought to the table, or is it just going to be the first AR collected for the?
So let me see if I'm answering your question.
Okay.
We have two items of AR.
Mhm.
I'm AR. You have an AR from Pete, and you have an AR from Kelsey.
Yeah.
Are you going to go into the AR to figure out whether you've truly collected both Pete and Kelsey, or are you just going to say they were collected?
Yeah, or if say those are equal to 100,000, and throughout the activity for the year you collected 200, are you just gonna say their 100 was collected, or you need to go specifically find out if those two accounts were?
I've never gone and specifically found out. The question I actually have though is embedded in that 100, is there anything that's bad? If there's anything that's bad, I might go as far as to say, well, Kelsey's a slouch. She's not going to pay her bill. So I might specifically identify something that's not going to turn and keep my eye on that. But in general, it's going to be all 100 turns. You gave me a value. AR is generally collected somewhere between 30 and 90 days. And that 30 to 90 days is going to be a quick turn. And unless I have something in that AR pool that I think is uncollectible and not going to be good, then I'm just going to deem it all to be, I'm not going to go into specific collection. Not
Okay.
gonna do it. Okay, and same on AP. I'm gonna deem it all to be paid. Okay, any other questions?
Yeah.
Okay,
So we're doing this from the onset, from a new partnership perspective.
Yep.
Or what if, or how is it handled when an existing partnership comes to Lutz? We look at their capital accounts and say, or do we look at their capital accounts typically and say, this is not in proportion to your ownership percentage? What's going on here? Should we be looking for, maybe there's a 704C problem that,
we should, and it's difficult. Not all practitioners are created equal, and I would say that the level of recognition over the past 2 days or day and a half or whatever we have might be something more than 0 in this room. And 2 days ago, I'm not sure that you would have been able to formulate that question, maybe. So not all practitioners are going to have a 704B capital account, and a 704C capital account, and a 704B balance sheet that is quantified the inherent gain. So getting this from another practitioner can be a challenge. So there are times, and there are times where we know there's a bust, and we know there's an issue, and we say, okay, this does not look right. We're not in proportion. We're not sure what special allocation should exist, and either we hold this as a constant or we start curing it. What do you want to do, client? One of the two. You got 2 choices.
and that's only easier to diagnose if you know the same partners have been there from day one. Because if partners have come in and out, then there could be some.
More mud in the water. 100%. 100%. Okay, so I didn't bring this up. Do you have any more questions?
That was it.
Okay, because now you made me. And this should be in here. I think I was silly not to bring it up. Okay. We're going to be talking about, we've been talking about 704C, right? So far. This is called a reverse 704C. Because what we've been talking about so far is you have people that are contributing assets to a partnership. Now we gotta measure the inherent gain to the partnership. What do we do? And Joe brought this up yesterday, but he didn't say these words, reverse 704C. He was talking about Heritage, and Heritage has these communities, and these communities get rolled up into the mothership. And every time it gets rolled up in the mothership, they do this shortcut calculation to try to make all make sure everything's going to equalize out. Do you remember him saying that? Okay. This, what he was saying without saying it, was this is reverse 704C, is what this is. So, and I'm going to just stick with whatever my balance sheet and the spreadsheet was. Okay, I'm going to say that we get to year 5, and in year 5, oops, you son of a bitch. In year 5, we actually now have -$1 million, okay? And we have 0 basis for 704B because we've run it out. We've done all the special allocations. And that Pete's capital account is it was, I'm going to just say it's 500,000. Jeff's is 500,000. And that's not specifically right for what our fact pattern completely was, but at this point, there's no inherent gain because we've run out the schedule. Okay, so everybody on board with what we have so far. So we have cash of $1 million, correct? We have a widget machine, 1 million, a cum, 1 million, asset side 1 million, liabilities 0, Pete and Jeff in the equity section is 500 and 500. Okay, that's what we have up there. The reverse 704C says, well, Leslie believes in our enterprise. We believe in Leslie. Leslie contributes $1 million to the entity in exchange for a 1/3 interest. Okay? So, how much does my cash go up to by virtue of the contribution? $2 million, correct? So, what's my accounting equation, Sam?
Assets equal liabilities plus equity.
Okay, and where do we always start?
Equity.
Equity. By virtue of her putting in her $1 million, what's my equity section?
2
There's 3 of us.
500, 500, 1.
How do you feel about this?
Wouldn't it be the 2 million though? Cause you got, yeah. 2 million.
Okay, so let's talk about this. Okay, because I'm being dumb, thinking you're dumb, because I haven't said the words out loud yet. I'm like, why isn't she making this connection? That's the way. Okay, so you infer value. So if she puts in $1 million for 1/3 interest, how much value do Pete and Jeff have? She has 1/3 for $1 million, and there's 3 of us. 3 million. Okay, so the word I should have been introducing, and I did a poor job, and I called you stupid, but that was not appropriate. I mean, I really didn't mean that.
It's fine.
Okay, you get my point. That was not appropriate. That sounded a little too sincere from my side, but it wasn't. Okay, is that when you have the $1 million being contributed to the entity for 1/3 interest, you get to revalue or restate what your equity section is. Okay, so if Leslie contributes $1 million for 1/3 interest, that would infer the other 2 interests that are equal in terms of proportion are worth $1 million each. So my equity section is how much?
3 million.
3 million. So I have Leslie, I have 1 million, 1 million, and 1 million for a total of 3. How much liabilities do I have, Sam? 0. So my total assets, or my total liabilities plus equity is 3 million. So what does my asset side have to look like? 3. Okay? How much cash do I have? 2 million. Okay? So now the fair value goes where? Let's say it's still all equipment. It could be goodwill. Somebody's gonna have to give you that number. So the fair value of my equipment is $1 million based on this. So now, even though on day 1 we had this fact pattern where Pete came with asset with $500,000 of basis, Jeff got all the depreciation, that equalized capital accounts out, correct? Right? Leslie comes into the partnership 3 years later, contributes $1 million. The partnership issues, if Jeff has 3 units, I have 3 units, we issue Leslie 3 units in exchange for $1 million. We now have an event that revalues the entity. And so we have an event that revalues the entity. We have a new 704 event. So the issuance of units in formation is a 704 event where you have to go through our steps. What are our steps?
Create a 704B, C, and inherent gain balance sheet.
Okay, and then you have to categorize the assets into 3 assets, and then you have to do depreciation. By virtue of us having a new partner enter into the partnership, we have a revaluation event to say our equity section was $1 million. It's being revalued to 2 million, with the addition of Leslie coming in for her million, now 3 million. And now my 704, this is my 704B, correct? What's my 704C? How much cash do I have?
2 million.
2 million. What's the basis in the equipment?
0.
0. 2 million. Oops. 0 liabilities, 500K, 500K, 1 million, 2 million. Now, do I have a short-term asset that I have to contend with? Do I have a long-term asset that I have to contend with? Do I have a depreciable asset that I have to contend with? Depreciation. So, if we divide the depreciation up into 5 years, it's 200,000, correct? 30% or 33% of 100,000 or 200,000 is 66,000, correct? Leslie's owed 66,000 of depreciation. Pete and Jeff, the inherent gain partners, are also owed 66 if we have enough to support it. But we have no tax depreciation whatsoever. Do we not? So now we're in the conundrum of, is it traditional with curative, or remedial? Okay? So the point I'm trying to make is the issuance of units, the admission of a new partner, or the issuance of units, however we want to say it, that sets fair value is a revaluation event, which causes a new 704 calculation to be done. Burton, how often does this happen?
Why do you call it reverse?
Reverse? Because we had the person who came to the partnership contributed cash.
Oh.
Okay, and the existing partners are the ones that are sitting on inherent gain. So 704C is everybody's contributing. Reverse 704C is when you have a new partner contributing, and it could be an inherent gain asset. Now, where this really gets nauseating and gets difficult is Leslie has a piece of equipment that has a fair value of $1 million, acquisition cost of $1 million, and a cum of $1 million, so net book value of 0, right? Pete has a machine exactly like Leslie's, fair value of $1 million, acquisition cost of $1 million, but net book or a cum of 200,000. Stuthman puts in $1 million. So Stuthman's capital fair value, capital account, and tax basis is $1 million. Leslie's fair value is $1 million and 0. Pete's is $1,800,000. Well, Pete has an inherent gain built in there. Leslie has an inherent gain in there. It's not proportional. And trying to figure out how to drive that special allocation of depreciation to equalize her out when she has a larger inherent gain and Pete has a smaller inherent gain is mind-numbing. Okay, so this is where I say there's New York law and there's California law, and then there's what we do in Nebraska. And what I mean by that, and I'm going to pull this up. Let's see, what's this? Who's this? Oh, all right. I can't see. And this is the methodology that we use, or I use, to bring sanity into this. What I hit. So I got a formula here let's see. This says, okay, I got a beginning point of -20. I got a beginning point of 117. And I got a beginning point of 202. And I have inherent gains that are varied the same way I just described. I know that my 704B ending point is 14 million bucks. I know that's my target. I now have something to aim at. And I know my ending capital account is 242. I have something to aim at. And I know that I have these short-term items and these long-term items that are knowns. So, what amount is required? Well, that's interesting. Oh. I know that once I have that, what has to be pushed to that particular partner to add up to that number? So I use their ending capital account. I know based on 704B what the ending capital account should be because I've taken my fair value depreciation and I've allocated that to them. Now I have a target to aim at. I use that target to arrive at these special allocations at in the middle. I back into it. I don't magically say, well, she's got $1 million, I got 200. I say, what should happen in the middle to make this true? Because if you try to focus in on the disproportionality of the inherent gain that's embedded in that asset, you will be beating your head against the wall. It's almost, for me, it's a virtual impossibility. So I use the ending capital, fair value capital count as a target and pick that up and bring it over to say that's going to be my ending tax 704 capital. Here's, I know my short term that's going to trigger, I know my long term that's going to trigger, and I know in this case I'm taking something over 10 years. So I take my beginning plus the short term plus the long term, which says I get to 298,000. And I know that my target is 14,947. And I know that I have 10 years that I'm going to run that out over. So I take the difference between the 14,947 and the 298, I divide it by 10, and I jam that income to them. That's how I do it. That's how I deal with the disproportionality of inherent gains that exist. Does that seem slightly clear to everybody?
Are you doing inherent losses in the afternoon, Pete?
No. I'm not touching losses. I don't know what to do with losses, honestly.
Well, everything always has gain in it, so that's fine.
Every Let's client, they're successful ventures for sure. Okay.
So in this last example you did with Leslie,
Yeah.
that's saying if the 5 years ran out from the original start of the partnership.
Yeah.
What if you were in year 3?
It'd be a revaluation event.
You don't worry about running out the old, you just start completely fresh and say, what do we have to do for another 5 years?
Okay, so I'm going to go back to a comment I made before, Brett. There's California law, there's New York law, and then there's what I do here in the Midwest. The question you're asking is, do we have to respect and keep tabs on that original 704 calculation? And under the rules and regulations, the answer to that is yes, you do. Ask me if I do.
Do you?
I don't. I treat this as a whole new revaluation event, as if we shoved everything into a bucket together, And then I go back to that same procedure of saying, what's my tax basis capital account? It's brand new beginning tax basis capital account. I know what my target is. I know my short term, I know my long term. I know the variance between those two, and I know the amount I'm going to run it out over that schedule of 10 years. So I'm going to, and that's what Joe was saying, is we're not going to respect those multi-layered 704C allocations because it's hard enough, and this is close enough. And if somebody wants to bust us for the shortcut, have at it. Do the calculation and tell us what you think it is, because this is close enough.
That was Joe's comment yesterday, why he does that, because it turns a tax return into a $70,000 tax return.
Yes, 100%. 100%. 99.5. New subject and same subject, but this dovetails off of what we've been talking about to the point that I would include it in the same subject. 99.5. Okay. What the hell is not, there's two revenue rulings that we're going to be talking about, maybe more, I think, but only two that I know of. We're going to be talking about 99.5 and 99.6. 99.5 is the concept of a single member LLC going to a multi-member LLC. (99-5). So Pete owns L1. L1, and L1 owns land. Sam, who do you want to call in?
Nate.
Who?
Nate.
Nate. Is L1 a disregarded entity, assuming no check the box?
Yes.
Okay, and what's that mean?
Means it's a single member LLC.
And who owns the land for tax purposes?
Pete,
Okay. Who owns it legally?
the entity.
L1.
Yes.
Okay. So an LLC is a chameleon. Does everybody know what I mean by that? Brett, what do I mean by that?
It can be multiple things.
Okay, based on fact pattern. Okay, it can change its stripes based on its fact pattern. So if you have two-member LLC, how's that taxed? No check the box.
Partnership.
Partnership. Okay, so let's do this for a second. I own P. P owns, or I own L1, and L1 owns ground. You become an owner of L1. Is it a partnership?
Yes.
Okay. We don't like each other anymore. You kick me out, and you own L1. What is it?
Single member LLC.
And how's it taxed?
Sole proprietorship. Or
Disregarded.
Yeah.
Right? So it could be a sole proprietorship. So I started out with L1, which was disregarded. You owned it for a brief moment in time, or however we want to say it. And now we have two members. It's partnership, because by virtue of having two members. Then I exit, and now you have all the units. Now it is a single member LLC to you. So that in that way, it's a chameleon. Based on the fact pattern, this is going to dictate how the LLC is taxed. So what 99.5 says is, well, wait a minute. If we had Brett, we went from a single member LLC to multi-member LLC. 99.5 is addressing that fact pattern. So what 99.5 says is there's two ways this can happen. And I'm going to say land basis and fair market value is 10,000 Fair market value is 100,000. Equity, 10,000, and there's no debt. So that's kind of a balance sheet of the single member LLC. What 99.5 says is Brett can enter the partnership one of two ways, and we're going to be 50-50. Okay, Brett and I are going to be 50-50 partners when the dust settles. Brett, what two transactions do you think are possible or might manifest to make you a partner in this partnership? How could you get LLC units?
I can bring cash to the table,
You can bring cash, that's one.
or I can buy part of your existing shares.
You can buy part of my existing shares. So let's stick with the bring cash to the table first. If you bring to the cash to the table, did anybody note the page with the steps, 704 steps?
Oh, I did.
Okay.
He's so proud of himself.
He was 100%, 100% proud. Okay, so what are our steps?
Determine the property that's contributed to the partnership.
Hold on, let's stop there. What property is being contributed to the partnership?
Cash.
Cash? And?
I don't remember.
What else?
Land.
Land. Is land really being contributed though? From a legal perspective?
No.
But for tax perspective,
Yes.
it is. We always, as tax people, have to understand when we enter into the land of fiction. And we are now entering into the land of fiction. Because who owns the land legally, Brett?
L1.
L1. But who owns it for tax purposes?
Pete.
Pete. So if we have this tax fiction that Pete owns the ground as a single member LLC, we would also have a tax fiction that Pete's contributing to it, contributing the land when it becomes a partnership. Okay? So what are the assets, Brett, or Noodles?
Cash and land.
Cash and land. What's the next step?
Determine the fair market value of property being contributed. The fair market value is generally agreed upon by the partners who contributed to the partnership.
Okay, how much is the ground worth?
100,000.
Which would infer Brett is contributing how much?
100,000.
Okay. So the ground is inferred to be worth 100,000 because he's bringing 100,000 in cash. So what do we do next?
Determine the tax basis of the property contributed to the partnership.
How much space is in the ground?
10 grand.
And what's space in cash?
100.
Okay. What's next?
Construct 704B, C, and inherent gain balance sheet.
Okay, my 704B. What do I got?
You have land of 10,000.
B. We're on B.
Oh.
You said B first for whatever reason.
You have
That's the way I wrote it, I'm sure.
You have cash and land both of 100,000.
Okay. And?
And then you have equity for P and B, each of 100,000.
Okay. What about my C?
C, the land is going to be 10,000 and P's equity is going to be 10,000.
Okay.
And then cash and Brett will both be 100,000.
Okay.
And then inherent gain, you'll have a $90,000 gain on the land and Pete equity.
Okay. Everybody's on board with that. Okay. That's maybe situation one. I mean, there's situation one and situation two in 99.5. So you have this tax fiction that Pete's transferring his ground to a newly formed partnership by virtue of Brett contributing $100,000 to the LLC in exchange for the LLC units, right? So now, what was the second option, Brett?
I buy your interest in.
So
Shares.
let's label this for if whatever graphic purposes. This is scenario. Let's find out which scenario it is. I'm almost positive it's going to be 1. What's situation 1? B, who is not related to A. Oh, it's scenario 2. We covered scenario 2. B, who's not related to A, contributes $10,000 to the LLC in exchange for 50% of the ownership interest. The LLC uses all the contributed asset, contributed cash in the business. A and B continue to operate the business and LLC as co-owners. So this is situation number 2 under 99.5. Okay, what was the other one, Brett?
I buy your interest in.
You buy your interest. That's situation 1. So now if you buy my interest, and we're going to be 50-50, how much cash do you have to come with? Sam, how much cash do you have to come with?
You're going 50/50?
$5,000.
I didn't know.
Well, but let's think about this. How much? We got basis and fair market value. Basis is 10, fair market's 100. Equity is 100. If he's just going to buy straight up 50% of my ground, how much cash would he owe me? 50K. Okay? So you got to come with $50,000. So you're going to buy 50. You're going to pay me $50,000. And I'm going to give you units. Okay? Noodles, what did we say L1 was regarded or disregarded prior to his entry?
Disregarded.
Disregarded. Okay? And if that's true, when he pays me $50,000 for 50% of the units, what's that transaction? What did I sell him exactly? Brad?
Units,
Legally, but what did I sell him for tax?
land,
Land. So, Pete's going to have a gain-loss calc. Proceeds is how much, Brad?
50,
50K. Basis is how much, Brad?
50, or 5, sorry.
5. So Pete now has a gain of 45K. And what's the character of that gain, Brad?
It depends
On?
what the land was used for before.
Yep. So it could be
Inventory.
capital, it could be inventory, which is ordinary, it could be 1231. It's going to depend on how Pete held that ground in L1. Okay? So, step 1 is there's a gain-loss calc that needs to occur with respect to the percentage of the asset that was sold based on the percentage of units that were purchased. So in this case, Brett gave me $50,000 cash. The thing was worth 100, so 50% of the asset was sold by me. What did you buy, Brad? Or Brett?
I bought ownership interest.
Legally. But what did you buy for tax?
Land.
Land. So now what's your basis in your land?
50.
50. Okay, and this is all the world of land in the land of fiction. Because legally you bought units. Legally I sold units. From a tax perspective, I sold ground. From a tax perspective, you bought ground. Okay, so you have to get through that first hoop, or this first analysis, before we get to Noodles' procedure. What's the procedure, Noodles?
determine the property that's contributed to the partnership.
What property is being contributed to the partnership?
Land,
By who?
both of you now.
Both of us now. What, then what?
Then determine the fair market value of the property being contributed.
Okay, what's the fair market value of the ground that Pete's contributing?
50.
50. What's the fair value that Brett's contributing?
50.
What's the basis that Pete has in his ground?
5.
What's the basis that Brett has in his ground?
50.
Okay, then what's it say?
Then determine the tax basis,
Okay,
which,
we did.
yep. Then
Okay.
704B and 704C an inherent gain balance sheet.
Okay, so what was contributed?
Land.
Land, I'm gonna call it land B and land
B.
P.
Okay.
Okay. What's fair value?
50,000 for each.
Okay. And equity?
50,000 for each. For B and P.
And 704C?
Yeah.
Land B?
Land B is 50, land P is 5, and equity is the same, like the 50 and 5.
Okay. Inherent gain? So 99.5 is a revenue procedure or revenue ruling that says you have a multi-member LLC, excuse me, a single member LLC going to a multi-member. And what are the two transactions that are possible for it to go from a single to a multi? And what were those two transactions, Brett?
Contribute cash
Contribute cash
or buy ownership
or
interest.
buy ownership. Okay, so in the contribute cash, and this is scenario 1, based on this, what we just did is scenario 1. Or situation 1, however we want to say it. In situation 1, before we get to the 704 procedures that we've outlined in the previous pages, we have to first do the gain loss analysis for the person who's selling, because that's happening a minute before the formation of the partnership. Because tax fiction says Pete owns the ground, not the LLC. Tax fiction says Brett purchased the ground, not LLC interests. So that's a tax fiction that you have to understand exists before you get to your 704 procedure. And that 704 procedure would be, and the reason we have to do that, the first thing you have to do, Noodles, is what from your procedure?
What you're actually contributing.
Determine what you're actually contributing. So I have to break this apart, meaning Brett has to have a piece of ground, I have to have a piece of ground. How did Brett get that ground? He purchased that piece of ground. That means I sold the ground. That means I have a gain or loss on the sale of that ground. And now that reduces my basis because I sold 50% of it. My basis was reduced from 10 to 5 because I used 5 of my basis in my gain loss calc. I have to do that piece before I can even say who has what asset to contribute to the partnership. Then once I get through that knothole, then I follow through with that 704. Who has what assets? What's the fair value of the asset? What's the basis of that asset? Use that information and construct my 704B, C balance sheet and come out with my inherent gain. Did I miss anything, Noodles?
Sounds pretty good.
Okay, so 704 is something that we confront all the time. A lot, I think. Yeah, Hoffman?
I would think so, yeah.
I mean,
Well, I would say at least 50% of our partnerships, probably. And over, I would say, if you're dealing with real estate, it's probably 75% plus of the time.
I think you're light, but
Yeah,
Yeah.
probably.
I mean, I would almost say, given some of the things you confront, it's closer to 100%. When you talk about deferred developer fees and because
Just land in general.
and land in general, you know, and scraping gain, whether you don't scrape gain, all sorts of things come into that.
In that scenario up there, Pete, in your infinite wisdom, if that land was inventory, is there a way to manipulate the character of the gain you'll recognize?
If it was inventory going in,
Mm-hmm.
not to my knowledge. I mean, if it was inventory in,
So I set this up because we've done this. Change it to multi-member first with a related, your related party, and then sell your units.
well, if it's inventory, that's 751 asset though.
Yeah. True.
So then you're saying,
But if you have land's a bad example. If it's an operating activity and you don't have much for depreciated assets,
you can manipulate gain by creating an LLC or a partnership. That is true. But if it's ordinary in your hands and you have fair value assigned to it, it's kind of hard. Fair value assigned to the ordinary, 751 is going to capture
most.
Yeah, whatever that difference is. However, there's a form 8308.
which is much more, in 2024, I think there's a lot more detail involved on that
I was
8308.
gonna say it's new. I
Yeah.
mean, it's not new, but the
You have to disclose all the assets on that form.
disclosures are new.
Which, again, going back to the basis schedules, going back to this BOI, going back to this foreign disclosure, going back to all these things. I mean, we're becoming a government reporting arm. You know, we're disclosing things that I don't think we should be required to disclose. Because a hot asset is defined as what? Okay, so let's back up. Because does everybody know what the 8308 is? Nope. 8308, back when I was in your shoes, was a form that's just you raised your hand and said, the sale of this interest might result in ordinary income. Then they revised that to say, the sale of an interest, we now have a reporting mechanism on the K1 that you're now required to disclose the amount of hot asset gain that you should push to the person. I think it's code AB. Is that right, Benny?
Yeah, I'm not sure where.
Like box 20 code AB or something stupid.
Oh, something like that.
That says, on the K1 itself, it says, your amount of hot assets for the sale of this interest is $100,000. That never existed. Then they took this form 8308. Okay, so a hot asset, let's stop there for a second. A hot asset is defined as cash basis AR, depreciation recapture, and appreciated inventory. Those were the categories, and that's what should be quantified in that box 20. Well, this 8308, I think, has overstepped its bounds. Because on the 8308, as it currently stands, if I understand correctly, is undercaptured 1250. I think there's 28% gain for collectibles. What else was added to it?
Have you seen it?
I haven't seen it.
I haven't seen it.
I just know it's out there.
talked to a couple of people about it.
Well, Campy's the one who said, didn't you say, and he said undercaptured 1250 is not a problem, and that shouldn't be taxed, and yeah, that's That's been the rule I've been dealing with my whole life. Does anybody see a bar I can type something in? Okay, here we go. So say U308.
There's also that box on the bottom of the K1 that now says amount of 704C or 704B.
Yeah, that's been the last couple of years.
I think this would be a dismiss. I don't even know what that is. Gain from collectibles, gain from unrecaptured 1250. So not only do you have your hot assets in line 1, you're supposed to be disclosing, which, fair enough. That's always been the rule. Okay, so now we're playing by the rules. We should be disclosing it. We should have been more honest in previous years versus playing games. We should have. Fine, fair enough. But this concept of collectibles that has a 28% rate and unrecaptured 1250, not fair enough. Those aren't hot assets. The rule under 741, and 741 is a provision that says the sale or exchange of a partnership interest is capital. In the same way, the sale or exchange GE stock is capital, unless there's 751 hot assets. And to the extent there's 751 hot assets, we're going to require you to recharacterize your gain to a portion that's ordinary to the extent there's hot assets. Well, that's line 1. That's the rule in the code. It never says, well, and if you have something embedded in there that's collectible that would be a 28%, you got to do that too. And it also doesn't say, if you have 25% tax rate on unrecaptured, you have to do that too. There's no technical hook out there that I know of that says that you have to look through your partnership interest to the assets on the balance sheet to capture the 28% rate gain or 28% rate associated with collectibles or the 25% rate associated with unrecaptured 1250. There's nothing out there.
So, dumb question. Should there ever be anything on those lines?
I'm never going to put anything on those lines. I think that's an overreach. I don't know what, and I could be wrong. Because again, I go back to the rule is the gain's going to be capital. Well, so here's the potential. I'm going to play the part of the IRS for just 1 second. Okay, just for a second. I can see them making this argument. What is the character of gain associated with collectibles?
28.
Not the rate. What's character?
Capital.
Pretty sure it's capital. What's the character of unrecaptured 1250?
Ordinary, kind of.
Nope, it's capital. So both those items can be offset by a capital loss. So they are, in fact, capital in nature. So would the IRS argue that 741 says that it's capital in nature, the sale of a partnership interest is capital in nature, but you have to recharacterize for 751 hot assets? Their subsequent argument could be, well, capital now can be bifurcated into 3 buckets. One is just capital, one is for collectibles, and one is for unrecaptured 1250. Maybe, because they are capital in nature. But I've never read it that way at all, ever. And I think I would not populate that line, and sorry, I don't understand, because I'm an old guy, and the 8308 is a form that I just kind of always attach, never give much thought, and hot assets are this. Sorry. Whoops. I think this is an overreach.
8308.
But like at the top.
And the way that's,
A lot of times we, in the past, before that line was there, we'd either fill this out not fill this out.
There's a penalty for not
Yeah. If
attaching
you
it.
fill this out, we would typically put any hot asset 751 items in the footnotes of the K1.
Yeah.
We'd used a long time ago, just fill it out and wait for somebody to ask, because we didn't calculate it till they asked.
Yes.
If it was outside of what a client we did not do the 1040 for.
Okay, so, but here's the thing.
Nobody asked.
Well, but or here's the issue. Because at the end of the day, Hoffman or buyer and seller on an asset purchase congruent or have the same interests, economic interests in how a purchase price allocation is
No.
done. Why? Well, let's be buyer for a second. Where do you want to push purchase price?
Appreciable assets,
Shortest lived depreciable assets. Why?
because I get a deduction for those items.
You get
Ordinary deduction for those.
and quicker.
And quicker.
Okay. As seller, where do I want to put that?
Goodwill,
Goodwill. Why?
capital
Capital.
gain treatment.
And the seller still gets a write-off. It's over 15 years.
It's over 15 years guaranteed.
Okay. So you have this adversarial relationship in between buyer and seller. Not adversarial that we want to take a gun and shoot each other, but adversarial that what's good for me isn't necessarily good for you, and it all comes down to a negotiation. Now, with respect to this hot assets piece, if somebody buys an interest in a partnership, is there some sort of election that can be made for step up in basis?
I've heard of one.
Noodles, what is it?
704, 754.
That was almost code Tourette's. I thought you were just going to start spitting out a bunch of sevens.
Just throwing out numbers.
301.
One landed.
Yeah, that's what I actually started to expect to see coming out of Nate over there was code Tourette's.
99.5. 667.
Okay, so 754. Okay, and the 754, which we're going to cover at some point in the middle of all this, steps up the basis of the assets. And the step up of the basis of the assets, is it based on the fair value of the underlying assets, or is it based on the tax basis of the underlying assets?
Fair value.
Fair value.
I would say yes.
Okay, so
He's got my back.
No, not yes to fair value, yes to both.
Oh.
He'd say yes to both. Depends on which side of the equation you're on.
Yep.
Okay, so if you have a 754 step up associated with your PP&E, do you think that that'd be a hot asset with respect to the seller? Yes, so that's going to be yes. So to the extent we're taking a 754 step up on property, plant, and equipment, then the seller, we would be required to characterize, at least in my view, would be required to characterize on box 20, code AB, or whatever that is, that step up amount is a hot asset for gain recharacterization purposes. Because the buyer is getting the 754 write-off associated with those assets, which means fair value is higher, which means there was inherent gain that would have generated ordinary income, and that ordinary income should have been pushed to the seller. But the bottom of this form is, I believe, an overreach.
So that 8308 is a partnership form.
It is. When there's a sale or exchange of a partnership interest.
Do you need to fill that out if there's no hot assets?
My stance when I was closer to your age or Hoppin's age or whoever, in the end, because I believe that there's a penalty associated with not filling it out. And if there's a presence of hot assets and you didn't fill out the form, I think there's a penalty. You guys know what the penalty is?
You know, but there's always, there's always the underlying thought out there that if you don't fill this out, it's considered not a return, not a filed return, and it leaves your statute open forever.
Adequate, is it adequate disclosure? Yeah, I'm with Pete on this.
I've never heard that one before in my life. I've heard of adequate disclosure with respect to gift tax returns.
I think there's been, I don't know that it's been, like, I've heard it in trainings saying that the IRS will try to argue that you have an open statute if you don't file, it's not considered a filed return if you don't fill out everything correctly.
We'd have a lot of exposure as a firm if that was the case.
I don't know that they've been able to stand on that, but it's been threatened as people not wanting to do certain things, and the scare tactic in trainings have been, it's not considered a filed return.
Okay. I've never.
I don't know if that's again, I've heard it in trainings.
Is
as
the
a scare
IRS putting on a training?
Sponsored.
Sponsored by your good friends at the IRS. I've never heard that before. I've heard that in the context of a gift tax return. There's an actual rule out there for a gift tax return. If you don't have adequate disclosure for the value that's been assigned to a not readily valued asset, I mean, you need an appraisal, that adequate disclosure is required to make statute run. That is true. That one I know. But I've never heard that extended into a 1040.
I think it was that dipshit that came in a couple years ago that told us we had to take pictures of our home office and back out the treadmill.
Well, in my house, that's a clothes hanger, but yes. Okay, so let's see.
Are mineral interests that have been depleted?
Why the fuck are you asking me about mineral interests?
I'm just here for commentary, people.
All right, I'll answer the question, but it's going to be led with, I don't know.
Well, and actually, after you get done with these trainings, I have a client that has this issue. So
A mineral interest issue?
there's a redemption of one of the partners, and they are taking mineral interests with them on their way out the door, and we have depleted the mineral interest.
What are the two answers in the world, Sam?
Yes, and I don't know.
I'm sure as hell in the I don't know. Is the sale of a depleted mineral interest item a ordinary income item?
I don't know. I don't.
Immaterial.
think it is.
Immaterial? Inside, outside basis.
Inside outside basis.
Okay.
Don't worry, deduction.
So stupid question. My sense is everybody in the room kind of understood what that was. Is that fair? Leslie, did you understand what we just did? Kelsey? Alyssa? Sam? Brett?
Yep.
Brad? Noodles? Huntoff? I don't give a shit about the other two.
Wait, noodles, that's a new one.
Okay,
We'll tell you
just-
at lunch.
Okay. Okay, so that's 99.5. I don't think, do you guys want to do the examples more of 99.5, or are we good? Sam, you get to decide.
Do you need to waste time until like again?
No. I mean, okay, what Sam just said is, why wouldn't we do this? That's what she just said, I think is what just happened. Okay? So Sam, since you made the choice to do it, you get to call on whoever gets to do it. I want to hear the audible groan from whoever you choose.
This is hard.
What do you mean? You can choose yourself.
Well, you know what? Yeah.
Okay, let's do it.
Jim owns
Oh, are
ground.
you choosing somebody else?
No,
Okay, let's go.
I'm gonna get it wrong, but I'll do it. Jim owns ground with a cost basis of 200 grand and a fair market value of $1 million in AB LLC. Sam has $1 million of cash. Jim and Sam believe that they could partner together to develop the land. Sam contributes $1 million to AB LLC in exchange for AB units. What are the tax consequences to Jim? He gets taxed on the gain on the sale of the land.
So what did Sam cross purchase the units, or did he contribute? Okay, so the contribution, the question you have to ask yourself, in order for Jim to have a current income tax consequence as a result of the introduction of the member comes in one of two categories. One, did he receive any cash? Jim received cash?
Oh, no, not Jim himself.
Jim did not receive cash. So if Jim did not receive cash, that turns off one. Then the second is what we talked about in the formation class. Is this an investment partnership? Was there a transfer of debt in excess that would result in excess of basis? It would be those other items which come through the formation analysis to get that done. So does Jim have a current income tax consequence by virtue of Sam contributing money? He does not. Okay, what are the tax consequences to Sam?
No.
Nothing. Okay, so let's broaden the scope of the question. When the contribution to cash goes into the partnership, what is the tax fiction that's occurring, Sam?
Buying units.
Jim owns what? Let's start back at the basics.
Jim owns land.
Well, for tax purposes, correct?
Yes.
Okay, but let's start with legal reality. What does Jim own legally, not from an income tax perspective?
The business.
He owns AB LLC or something?
Yeah.
Okay. So how is that different than what we have with Pete and Brad? So we got Jim that owns AB LLC. Okay, that's legally, correct? That's what that first line says, does it not?
Yeah.
Okay, and AB LLC has what?
So AB LLC owns the ground,
It does legally,
but not tax fiction.
but not tax fiction.
Okay.
Okay. So AB LLC owns ground of $1 million with a fair value of $1 million and $200,000 of basis. So, what does Jim own from a legal or from a tax fiction perspective? The land. So, Sam contributes $1 million to AB LLC for 50% of the interest. Okay? So, there were two situations. What were those two situations, Kelsey?
Contribute property or buy units.
And which one are we in?
Contribute property.
Okay? So, if it was a sale where somebody got cash, there was a, let me take back up. Noodles, do we have a procedure that we have to follow?
Yeah.
The formation?
Mm-hmm.
Yes. But when there's a purchase or there's cash going across, there's something that has to happen first. So when cash goes across, there's an additional analysis that has to be done, and that's the analysis of sale or exchange. Okay? If there is no cash going across, we're under our normal procedures of what we have. So, from a tax fiction perspective, Sam, what does Sam own? Not tax fiction. From a tax fiction, from a tax fiction perspective, what does Jim own? Land. And Sam actually owns what?
Money.
Cash. So Sam's going to transfer his cash to who?
AB,
AB. And what's he getting?
land, / units.
So he's getting units. AB owns land. He's going to have units in AB. Okay? So what's the procedure? The 704 procedure.
The first step, you have to figure out what was contributed into the partnership.
What was contributed, Sam, from a tax fiction and reality?
Money and the units.
Land.
Land.
Are going into AB. Okay? So AB is receiving land, fictionally, and cash. What's step 2, Noodles?
Determine the fair market value of the property contributed.
What's fair market value of the land?
$1,200,000. $1
$1 million. And what's fair value of the cash?
$1 million.
Okay. What's step 2?
Well, that was step 2.
Or excuse me. 3?
Step 3, we determine the tax basis.
What's tax basis in the land?
200,000.
Tax basis in the cash?
$1 million.
$1 million. And what comes next?
Then we make our 704B, 704C, and inherent gain balance sheets.
You lumped a lot together there, didn't you? What's 704B balance sheet, Sam?
Cash of $1 million. Land of $1 million.
Okay.
And then Jim and Sam both have $1 million.
Okay. 704C.
Cash of $1 million. Land of 200,000. And then that.
Then that. And then inherent gain.
0, 800,000, then 800.
Okay. So, let's go back to this. Jim owns what legally, Sam?
Legally, he owns 80.
What does he own for tax fiction purposes?
The land.
Land. Okay, by virtue, and a single member LLC is a disregarded entity or is it a regarded entity? Single members, if tax fiction he owns it, it's disregarded. If you have multi-member, it's regarded, correct? So how did it go from being disregarded to regarded? That's where the tax fiction comes in. Disregarded means who owns the land when Jim owns the LLC. Who owns the land from a tax perspective?
Jim.
Jim. But legally, he truly owns AB. So let me ask this question. If Jim owned the ground, let's not worry about AB. If Jim owned the ground, who owns the ground? If you go down to the where people title land, who owns the ground? Jim. If Jim and Sam call the law firm and say, we want to form a new LLC. We're going to form a new LLC. Jim, I'm going to transfer my ground to the LLC. Sam says, I'm going to transfer my cash. Do you have to go down to the Register of Deeds and retitle the ground to the LLC? Is there an actual transfer? Yes, because you're forming a partnership. Did Sam actually transfer his cash to a bank account at the LLC? Yes. That is easy to recognize. Okay, I think where we ended was trying to wrap our head around tax fiction versus reality. And I was going down the path, if Jim owned the ground specifically, or Jim owned the ground and it was actually registered to him, no LLC existed, and Sam came with $1 million, And if they called a law firm and said, hey, we want to form an LLC whereby Jim is going to transfer his ground and Sam is going to transfer his cash, all the items are moving. There's an action that actually is taking place, correct? So everybody can see those actions are taking place. So now you have to be able to take those actions and pretend they occur on some level when tax fiction is required. And tax fiction is a single member LLC is it regarded, Kelsey, or is it disregarded?
Disregarded.
Disregarded and absent and check the box, which means tax fiction, who owns the ground?
Jim.
So if Jim owns it from a tax fiction today and it's in the partnership tomorrow, what is the tax fiction that occurred?
We contributed property to form a partnership.
Okay, Jim transferred the ground from a tax perspective into the partnership. Okay, and what were the two situations under 99.5?
You could contribute property or buy interest.
You can contribute property or buy interest. And if you contribute property, do we start with Nate's procedures right out of the chute, or do we have
Yes.
to do something else?
Nate's.
Okay, we start with those procedures. If we have a purchase of an LLC interest, do we have something else that has to occur?
Yes, you have to calculate the gain on Jim's, is it like a sale? Is that?
Yep.
Okay.
And then I have acquisition cost on the other side.
Yeah.
Okay, so when we say Jim owns ground with cost basis of 200,000 and fair market value of $1 million in ABC LLC, Sam has $1 million of cash. Jim and Sam believe that they could put together, they could partner to develop the land, and Sam contributes $1 million to ABC. Are we in the situation where we have the gain and loss calc, or are we in Nate's procedures?
Nate's procedures.
In Nate's procedures. And Nate's procedures say what?
First, we have to figure out what was actually contributed.
Okay, and are we dealing in legal reality, or are we dealing in tax fiction?
Tax.
Tax
Fiction.
fiction. Tax fiction, because what does Jim own from a fiction perspective?
From a fiction perspective, he owns the land.
He owns the land.
Yes.
Sam actually owns the cash, right?
Oh, yeah.
So if Sam contributes the cash to the entity, Sam is physically contributing the cash, correct? But the land doesn't have to move because ABC LLC already owns the ground, correct?
Yeah.
But we have to execute on the fiction. In a friend of mine's words, you have to live the fiction. And the fiction says Jim owns what, Noodles?
Land.
And after Sam contributes the cash, what's Jim own?
Shares in the entity.
A partnership interest.
Yeah.
Okay. So at that point, we have to do our procedure, which is what assets were contributed. So what assets were contributed?
Cash and land.
Cash and land. What's fair value?
Cash is cash. Land's fair value is $1 million.
Basis.
Cash is $1 million, and basis in the ground is 200.
Okay. Equity section. Or now we have the 704B, 704C, inherent gain balance sheet. We got all that, I think. Okay, so what's the tax consequence to Jim? Well, the tax consequence to Jim is he contributed his ground in exchange for partnership interest, and he had to go through the normal 704 procedures. That's the tax consequence to Jim. The same for Sam. You have to do the balance sheets. Sam, who you want to call in? What's this say, Brett?
Jim owns ground with a cost basis of 200,000 and a fair market value of $1 million in AB LLC. Sam has $1 million in cash. Jim and Sam believe that they could partner together to develop the land. Sam pays Jim 500,000 in cash in exchange for 50% of the AB units owned by Jim.
Okay. So the tax. Let's start with the tax. What's the tax fiction? What does Jim own?
Jim owns the land.
Okay. And Sam genuinely owns cash. And how much cash is in play?
500,000.
Okay.
Or he has $1 million, but he's gonna pay Jim 500.
Okay. So now we go back to, I said earlier that if you have this cross purchase, what's the tax fiction of that cross purchase? What is Sam buying?
Sam is buying land that Jim owns.
Okay. What's proceeds to Jim?
500,000.
What space is being utilized?
100,000.
How did you arrive at 100,000?
Half of the basis.
Half of the basis.
Based on
So the
fair market value is $1 million, and he's getting 500, so half of it.
Yep. And the gain?
400.
So now we're still in the land of fiction.
Yep.
What does Sam own?
Sam now owns land.
With what basis?
500.
Okay. So now we go into Nate's procedures. What's step one, Nate?
Determine what was contributed.
What was contributed, Brett?
They both contribute land.
They both contribute land. What's next, Noodles?
Then you have to figure out the fair market value.
What's the fair market value of the land being contributed or deemed to
Million.
be contributed?
$1 million.
For who?
Total.
Total. And so what's each person contributing?
500.
500 each. What's next?
Then you figure out your tax basis.
What's Jim's tax basis?
Jim's is 100.
Okay, which was, he started at 200. 100 was utilized to the sale or exchange, correct?
Correct.
And then what's Sam's basis?
500.
Because he
what bought
acquired it
for.
from Jim. Okay. What's next?
Next, you find you make your 704BC inherent gain balance sheets.
Okay, what's my 704B balance sheet, Brett?
500 for everyone.
500 for the ground A, ground B, and the equity.
Yep.
Okay, so, or Jim ground, Sam ground, and equity. So what about the 704C?
704C would be 500 for Sam for both land and his equity, and then 100 for Jim's land and equity.
Okay. Does that make sense to everybody on some level? How often do I see this?
So you probably see the first one more than the second one.
Maybe. Maybe
So I
not.
guess, like, why wouldn't you do the first one and then just distribute out the cash so you don't have a gain to report?
We're going to cover that. It's called 707. Disguised sale rules. I mean, people have tried that. It doesn't work. Okay? But, so let's talk about this for a second. Because I use this all the time, and some of you, I think, might be familiar with this. Okay? Let me ask a stupid question. I think we covered this in 2. Maybe. If I have S1 that's owned by A. S1 is an S Corp. Can anybody tell me what this transaction is where A contributes S1 in exchange for S2 stock where at the end S2 owns 100% of S1, A owns 100% of S2, and there's a Q sub election made. Anybody know what that transaction is?
F reorg.
It's an F reorg. How often do we see an F reorg? A lot. I mean, I wouldn't call this M&A 101, but this is done all the time. So let me ask a stupid question. Let's go back to S1. Who can tell me the characteristics or the rules that say that allow a corporation to be classified as an S corporation? What? And it's a not definition. Anybody?
Are you talking about like the 100 shareholders
100
stuff?
shareholders. Can't have more than 100 shareholders.
U.S. citizens?
U.S. citizen.
Yeah. Qualifying trusts
Could
or
be a green card. I think you can have a green card. I can't remember. Go ahead.
qualifying trust or estates?
Qualifying trust or estate.
Not a partnership?
Has to be an individual. Okay. And two classes you can only have one class of stock. Everybody remember that? Okay, so let's say, Mr. Huntoff, let's say that there might be some beef concern somewhere. I'm not sure exactly how all this really worked, honestly.
Okay.
Okay. And the beef concern is an S corporation. And that beef concern has a knock at the door from a venture capital company that says, we're willing to give you, Mr. Huntoff, $10 million. And what we want is 40% of the company. I'm just making stuff up. Okay. And venture capital is a partnership. And you said the venture capital as a partnership would not be an acceptable shareholder. And if that's not an acceptable shareholder, what would that do to my S election?
Blows it up.
Blows up. And now how am I taxed?
C Corp.
Okay. So John says, I want to keep flow through status. You are an inappropriate shareholder. And embedded in S1 is lots of operations. Okay? I mean, stuff that is hard to transfer. And you can't own 40% of me or you're going to bust the S election. So, what's an F reorg? Can you articulate what an F reorg is for anybody that doesn't know?
Not confidently.
A mere change of form. That's all it is. So an F reorg is S2 owning 100% of S1 with a Q sub. Is Q sub a disregarded entity or a regarded entity?
Disregarded.
Disregarded. And does anybody remember that the tax fiction, because we talked about tax fiction in 2 that said all the assets and liabilities that are still owned by S1 are deemed to liquidate up into S2. And that S1, by virtue of that liquidation, becomes disregarded. Does that seem familiar at all? Okay. So if somebody knocks on the door and says, I want 40% of this company, an F reorg with another step is a possible solution to allowing them in without busting my S election. So what we can do is take S1, contribute S1 to S2, whereby A owns 100% of S2, S2 owns 100% of S1, and a Q sub election is made. And let's do this for a second. S1 does this on December 31st of a given year. And S1 let's say on November 30th. S1 earns $100,000 a month. Hey, math girl. What's $100,000 a month? What's that net income?
1.2 million.
1.2 million. Okay. So prior to S1 being contributed to S2, and this being the ownership structure, how much was earned through the year? And
One
it
point-
happened on November 30th, or
One-
11 months.
1.1,
1.1. How much is yet to be earned?
100,000.
100,000. So while A owned S1, 1.1 of revenue was earned. While A owned S2 and S2 owned S1, $100,000 was earned. Who files a tax return and how much is reported on that tax return? Anybody got a guess?
S2,
S2 what? File its tax return?
yes.
And how much is reported on S2's return?
1.2,
1.2. An F reorg is a mere change of form. A owning S1 is exactly equivalent to A owning S2, which owns 100% with S1 with a Q sub election. It's a mere change of form. And there was that form, actually I can't remember. What's Q sub? 8869. There's the form 8869, question 14 that says, is this a F reorg pursuant to Rev Proc or Revenue Ruling 2008-18, which says this is a mere change of form, which puts the IRS on notice they shouldn't expect a return from S1. They should expect a return from S2 with an entirely new EIN number and 1.2 million of income for the full year. So why am I bringing all this up? Because this seems not pertinent at all to what we're talking about until it is. Okay? So once we get into the structure, Brett, do you know what formless conversion means? What I mean by that?
You don't have to file 2553. Oh, that's S corp. 8832.
Okay. Benny, what's formless conversion?
It's where you convert your tax status without actually.
Your tax status. What's tax status mean? Hoffman?
In Pete's words, it's the attorneys wave the magic wand
They do. They wave a magic wand.
and turn the an S corp into an LLC,
They turn not an S corp, just an Inc.
an Inc into an LLC.
Okay, so A owns S2. And let me ask you a question. Is S1 and Inc. Q sub disregarded, Brett?
Yes.
Okay. Is a single member LLC disregarded, Brett?
Yes.
Okay, so when we wave the magic wand and go to the Secretary of State, it's truly a formless conversion form. You go to the Secretary of State and say, I no longer want S1 to be an Inc. on your books and records. I want to change it to LLC status. And that conversion from Inc. to LLC status is the same DNA. S1 has the same DNA, has the same legal history, it has the same EIN, it has everything bad associated with it, but it's no longer Inc. on the books and records of the state. It's now LLC. So what we've done is we started at a point where S1, somebody wanted 40% of S1. And if they bought stock, A's stock, we would have busted S1's S election. And if we busted S1's S election, is that a good thing? A is not interested in that. So the solution is A transfers the stock to S2 in exchange for S2 stock, whereby A owns 100% of S2, S2 owns 100% of S1, Q sub election, which makes S1 disregarded for tax purposes. Then we go to the Secretary of State. We no longer want to be an Inc. We want to be an LLC. And in comes 99.5. What does S2 own, Sam? Which is now what kind of entity? LLC. And when we look at revenue 99.5, 99.5 is addressing $99.5 is addressing A single member LLC can go into multi-member LLC. So now we have a single member LLC going to multi-member LLC. And now here comes the VC. The VC transfers to S2 10 million. S2 transfers 40% S1 units. Does that look like anything what we've been doing? Is that situation 1 or situation 2?
One.
Situation 1. Situation 1 says what, Brett?
You purchase ownership interest?
Purchase LLC interest. I use this all the time. Okay, so can you see the utility of not wanting to bust the S election? Can you see the utility of VC wants to buy 40% of this? And then structuring into an F reorg to get this to disregarded status. And once I get this into disregarded status, I can change it from Inc. status to LLC status. And by virtue of converting it to LLC status, now I have a currency called LLC units that I can use to transact on. And now I can sell 40% of my LLC units for $10 million. And that means I've sold, pursuant to this RevProc, so let's do it. Let's say S1's balance sheet is cash of 100, AR of 200, land, let's see, 700, equity, 1,000, right? And we'll change this to, instead of 10 million to 10,000. Okay? If Brad, what's my fair value? I'm selling 40%.
So it would be
No, let's make it 50%.
20,000.
It'd be 20,000 of fair value. Correct? What liabilities do I have?
None.
0. So I have 20,000 of total. So this now comes up to 20,000. Correct? So I'm gonna have 100 of cash, 200, and just to make life easy, I'm gonna say 700 of land, and goodwill happens to be 19,000. Everybody good with that math? Is everybody with me? Okay. So we're now going to sell 50% of this. So let's go back to the simple land and see if we can work our way through this. Okay. Brad, what's the fact pattern here?
Are we doing the same one we did last time?
Yep. Jim owns.
Yep. Jim owns ground with the cost basis of 200,000 and a fair market value of $1 million. In AB LLC, Sam has $1 million of cash. Jim and Sam believe they could partner together to develop the land. Sam pays Jim 500,000 cash in exchange for 50% of the AB units owned by Jim.
Okay. So what is the tax fiction here? What does Jim own?
Jim owns land.
Okay. So stupid question. Let's correlate to what we have here. Who owns what? A owns S2, S2 owns S1. Who owns what? How do we diagnose this?
S2 owns all the stuff, the cash, the AR, and the land.
S2 owns the cash, AR, and land, and has self-created goodwill. S2 owns that, correct? So what happens up here next? What's the step that we have to follow before
Oh, gain loss calc.
gain loss calc? Okay, so how much of the land did Jim sell as a percentage? Half. And you did a gain loss calc on half. Okay, so and this might be better if we just go ahead and put this into a spreadsheet, because so we have cash, what did I say?
500,000.
No, up here.
Oh. 100,000.
I have AR
200.
200,
Land of 700. Which totals 1,000, and then equity of 1,000.
okay? Equity is
1,000.
Oops. Is 1,000, correct?
Yep.
Okay, and we're saying that our, what the hell is it? This is tax basis. Okay. Cash is cash, so we're saying, well, our equity section we're saying is how much?
20,000.
20,000. Where is it? Okay, which means, and I said AR was what it was, land was what it was, and this is 19, correct?
Yep.
Okay, so if we sold everything, we would have a gain of 19, correct?
Mm-hmm.
How much are we selling?
Half.
Okay, so we're selling, you're saying 50%, correct, Kelsey?
Yep. Yes.
0.5. So, I'm going to take this up one. Tax basis, fair market value, gain. Okay. Times 4 times F4 okay. And then so let's talk about what just happened. 50% of the stuff just got sold, did it not? So going back to just the simple piece of Jim sold his ground, we took 50% of one asset and compared it to 50% of his basis and did the gain loss calc, correct? In this case, we know we have a universe of assets, which in this case happens to be cash, AR, land, and goodwill, that we know that we have to buy at 50%. Okay, so we now have this gain, all right? Now, Now what happens? Okay, so now we're through the sale of the ground, are we not? Everybody's correlating to what's happening with this transaction to the simple land. Okay, then what happens, Brad?
Then we have to, make the 704 B and C capital accounts.
Okay, we have to identify the assets being contributed, right? Isn't that step one, Noodles?
That is.
Okay, what's second? Let's talk about what those are, and then let's go do it.
Second is, determine fair market value.
Okay.
Next is determine tax basis.
Yep.
And then we make our 704 BC and inherent gain balance
Okay.
sheets.
So in the case of the cross purchase, the deemed cross purchase of the land, Sam's basis in the ground was what, Brad?
200 or
Was 500.
oh, okay.
And Jim's was how much?
The 100.
100, because we utilized half of the $200,000 basis in that gain loss calc, correct?
Mhm.
Okay, so let's now correlate that back to here. Okay. This, how much basis does the VC have in cash? How much does the VC have in AR, and how much does the VC have in land, and how much does the VC have in goodwill? Basis. Kelsey?
Is it the 50, 100, and 350?
And?
0 for goodwill.
No, the venture capital actually bought 50%. They paid $10,000. So let's flip this across because I did you a disservice. So the VC actually paid, did they not pay $10,000? Right here?
Yes.
Okay, so they bought a 50% interest of the assets. The same way Sam bought 50% of the land. So since the VC bought 50%, what's the basis they have in the cash, AR, land, and goodwill?
50, 100, 350, and then the 9,500 in goodwill.
Okay, and S2's gain is how much?
The 9,500.
The 9,500. The same way Jim's gain was 400. Okay, so we've identified the assets being contributed by the VC. What assets are being contributed by S2, or deemed to be being contributed?
The cash, the AR, and the land.
And?
Goodwill.
Yes. So let's go back to Jim. What was Jim's basis and what he contributed?
100,000.
And how did we arrive at that 100,000?
Because we calculated his gain, which used half of the 200,000 of his original basis.
Okay. So how would we arrive at the basis in the S2 assets that are remaining behind?
Half of what's being contributed, because the other half we used to calculate the gain.
So are you saying, Kelsey, it's this times, I'm gonna put this right here, plus 1 minus this. Okay, and we're gonna play with this for a second. Are you saying it's this basis times the amount of basis not used?
Yes.
Okay, F4 Okay. So I have $50 of basis in cash, $50 of or 100 of basis in AR, land 350, and I'm no basis in the goodwill. So going back to the very, very simple example, Jim had a piece of ground. He sold 50% of it for 500,000. We utilized half the basis in its gain loss calc, which resulted in Jim's case of $400,000 gain, but in this case, it's 9,500. Jim's base or Sam's basis, or in this case the VC's basis. Sam's basis was 500,000 because that's what he paid. VC's basis is 50 in cash because bought 50%, 100 in AR, 350, and 9,500 because they actually paid for 50% of the assets. So now we've identified the assets, right, Noodles?
Yep.
Now what?
After identifying the assets,
Yeah.
then you find your fair market value,
Okay.
which, yeah, then you find your tax basis. Then we make our 704 B and C
Okay.
balance
So
sheets.
let's stick with that. So what's the fair market value? Okay. Fair market value. What's fair market value of the VC's assets?
10,000.
What's fair market value of S2's assets?
10,000.
What's the tax basis of the VC's assets?
500.
What is it, Kelsey?
10,000
Why?
because they bought half of the assets.
The same way Sam bought half the ground.
Yeah.
Okay. So what's the tax basis in S2's assets?
500.
500. Okay. If we talk about this, we sell one asset. All the moving pieces are a little bit easier to spot. Okay. So now what's the next procedure? Noodles.
Now we make our 704 B and C balance sheets.
Okay, 704 B. And then I'm going to come over here and grab this. Okay, so if I was going to let's do this just for fun. Okay? If I was going to say I was going to color code any columns over here to populate R, what columns would I color code, Noodles? Melissa?
So fair market value. So like the 50, 100, 350.
What columns? Is it H, I, J, K, L, M, N, O, P? Which columns?
O.
O? Okay. And then which columns, which other column? Because this is S2.
K.
S2. And this is VC. Okay, which column? K. Okay. All right. So if we go, now we're going to draw from those, right? How's everybody feel about that? Now, if we have 704C, Melissa, who you want to call in?
Leslie.
Leslie? if I was going to color code this column to green, which columns over here would I draw from to pull over?
Would be tax basis, would be J and N.
I think it's J and N. How you feel about that, Melissa?
Wouldn't you need to add in the 9,500? Since that's basis for VC.
Okay. So and I probably need to say VC and S2, right? Because that's something that we should have been doing. And this VC should have pulled from this column. And this should have pulled from this column, correct? So VC equity, you're saying, Alyssa, is pulling from this column, correct?
Yeah.
And you're saying this is pulling from this column, correct?
Yeah.
And now we have inherent gain, do we not?
Yes.
That went the wrong way on me. Hold on. All right, I did do it. Okay. You fucking moron. Okay, so this is something we do all the time. And why do we do this? Let's go back to the top. You have a party interested in buying S1. John, is this actually kind of what happened?
Yeah, it is kind of what happened.
Okay,
It is.
I have no idea.
Yeah.
Right? This is 100% speculation on my part.
Yep.
So you have A owning S1. You have VC that wants to buy S1. VC is going to do what to S1 if they buy it, Sam? Below the S selection? We don't want that, do we, Sam? We don't want that at all. So we say, okay, we know a way around this because you want 40% of it. We're going to have S1 contribute to S2. S2 owns 100% of S1. S1 does a Q sub election. The mere action of contribution of S1 to S2 with Q sub election, that's good F reorg. On 8869, question 14, is that the question number, Benny? Just say yes. Yeah, and it says this is an F reorg pursuant to 2018. Sam, is this disregarded or regarded once Q sub is made? Disregarded. Since disregarded, we go to the Secretary of State. We convert the Inc. to LLC status. Inc. to LLC status. Now S2 owns a single member LLC. By virtue of going through this process, gets us into 99.5. Because now, when VC comes in and buys 40% of the interest, and we're going to change this, buys 40% of the interest, then they're buying LLC interest. That's situation one under 99.5, whereby VC is coming in and they're deemed to buy 40% of the assets. They're deemed to buy 40% of the assets, and we'll come back, that's what's going on here. They paid $10,000, correct? The $10,000 has to be allocated among the assets, 50 to cash, 100 to AR, 350 to land, plug to goodwill. Just like with Sam and Jim, Jim still retained half of his basis, which was 50, 100, and 350. Okay? And then, pursuant to the procedure, we've identified that the VC has fair value assets and basis, because they bought half of them, of 50, 100, 350, 9,500, just like Sam had it. We know, just like Jim, half the basis, which was coming from a column over there, still is with S2, then we say, okay, well, our 704B is the fair value and the fair value for 20 million or 20,000, and then 704C, we have to reflect on, or we have to capture the purchase portion the same way we did with Sam. Sam's number was 500,000. In this case, this is 10,000. So the VC and Sam are the same. Jim kept half his stuff, so he retained basis. So Jim had 100,000 of basis. In this case, there's 500. You take both those, put it in 704B and 704C balance sheet, and that's how you use an F reorg in 99.5 to get into a state, a currency status that doesn't bust your S selection. This happens more than zero. And actually, do you remember this? Does this feel like maybe like franchise special lanes?
Yeah.
Yeah.
Yeah, that kind of sucked.
So you've seen this.
Yeah.
Okay. And that particular client, okay, this is baffling to me. Do you remember what was capitalized? The value that was capitalized in 2018?
Mm-hmm.
So somebody put $1,000, $1,000 into a company. 800 by one party and 200 by another party. And when it sold in 2022, how much did it sell for? Hold on. How much do you think it sold for in 2022?
Say the biggest number you've ever seen.
Do you know the number?
You told me this story
100 times?
recently.
Oh.
Is this from last week?
Yeah.
Yeah.
What's the number?
It's really big.
It's really big.
145 million.
You're the first person that's ever guessed over, and not by much. 140.
Thought I heard you tell a story once.
Okay. But $1,000 in 2018 converted into 140 million. And that's the return that you did. And it had this in there.
Is that complete? Complete nutrition?
No, but it's one of the former owners of that.
How did they manage to like they put $1,000 in and then they sold it for that much? How did it just went up?
I
that
have
much?
no idea. And Leslie, quite frankly, if I knew, I wouldn't be here. I mean, because my goal is to what?
Retire.
Retire, yes. And if I had the ability to have $140 million, do you think I'd be here? No, I would not. Okay, so let's change our number. So
You've changed, Pete.
do what?
You've changed.
Used to do it for the love of the game.
Yeah, uh-huh. Okay, so what happens if the VC, we change this to 0.4? This automatically populates now to show your tax basis consumed at 400, original tax basis with 1,000. That leaves 600 of the basis remaining, which populates all this. And let's see, let's pull that back up. This portion of this analysis, where we have rolled and sold, is exactly that. I have to deal with rolled and sold all the time, because in this case, in the spreadsheet case, this is the sold portion, the 40%, and the sold portion has a gain-loss calc associated with it. And the gain-loss calc, since there's a gain-loss calc, the purchasing member has basis equal to fair market value. Basis and fair market value are the same. Then the sold piece of it is, well, what basis was not consumed enrolled into the next venture so I can get to my tax basis equity of 600. I got a bust in there somewhere. I don't know what that is. I got a problem there. Oh. Whatever. I got a formula there. I have 600 of tax basis coming over. I changed the overall value. So I have to know what is rolled versus sold. The purchased / sold piece is going to populate the purchasing partner side. Fair market value and basis are the same. Then I've got my rolled piece, which is the proportional amount of basis that was not utilized pursuant to the sale, and it rolls up into an entity. How often do I use this? I use this all the time. I mean, you saw it in standard, and you would have seen it in franchise fast lanes. You see the utilization of that a lot, and knowing that you can preserve your S election by executing F reorg, getting it to single member LLC status. Single member LLC status opens the door to revenue ruling 99-5. And Brett, what's 99-5 address?
Single member LLC to multi-member LLC.
And there's the two situations. Correct?
Yeah.
Which one is contribution and one is purchase.
Yes.
And so when I think Brad said earlier, well, the one that's probably most common is the contribution. I think you said that, right?
Yes.
Okay. In my view, most likely the most common is going to be rolled versus sold and purchased because of all these transactions. And that may just be by virtue of the stuff I see. That doesn't mean that my universe of data points is the world's best.
So if they sell now for like 100,000,
Do what?
like in this example, if they sold for 100,000 subsequently, S2 would have the first 11.4 of gain. Is that correct?
Yeah. 100%. So 704 is pervasive everywhere. An S corp, did I say an S corp has to have memory? Why does an S corp have to have memory? Sam?
Per share per day.
Per share per day. There's none of this tacking or tracking of inherent gain to a particular partner. And a partnership, though, on the other hand, has to have a memory. I don't even want to talk about what just went through my head.